How's it going, everybody? Thank you for being here. Today, I have the honor to do. Do people say that? I have the honors to. I'll try again. I have the pleasure today to present to you Ore Day 2023, that is. And I would have also liked to have the pleasure to explain to you what Ore Day exactly is, but truth be told, I'm not quite sure yet. I mostly said yes to hosting this because that way I could get away from the old misses for a few more hours over the last week or so, and finally also make some money off this natural resource space, which I haven't been able to do so far. So instead of me doing the work here and explaining, here's the founder of the Ore Group, Stephen Stewart, explaining what Ore Day is and why the Ore Group does it. All right, Steve, what are we doing here? What is Ore Day?
Well, Ore Day is an opportunity for the Ore Group of companies to communicate its various messages. And it's something that we created 2 or 3 years ago, and it's evolved into almost into a brand unto itself, where we invite high quality, sophisticated people like Zoltan, like Lobo, like Justin, and others to come and inform and educate people on the mining space, and more particular, I should say, the metals space, which is how the Ore Group ultimately begins its investment thesis, which is really to select a commodity and then invest in it by acquiring an asset or a particular individual who is an expert in that, and then getting behind them, financing them, and moving them forward. And so Ore Day is really about showcasing each of those companies. You can see those companies in the background there, and we'll be talking about them throughout the day. And it gives us a platform to communicate directly with investors, and it allows us to stand out.
I totally agree with you. I've been noticing what the Ore Group does, and I like this. Obviously, this is why I said yes to participating in and hosting it, because not enough companies do that, are they? I think that more companies should be doing it. And there's, on the other side, you have people saying, "Oh, your share price is down. What does this video do for me?" If you want to speak to that, you can speak to it, but I think the answer is pretty obvious.
Well, it's about communication. I mean, the video itself doesn't necessarily drive a share price up or down, but it does facilitate. I think communication is critical, and trust, which develops trust. We are telling investors exactly what we're doing. Ultimately, at the end of the day, if you're not delivering drill results, success in developing your project, and all sorts of other things that go along with developing an exploration and development project, that's the key. Nothing drives your share price like good news. So I don't suspect, or did I ever anticipate that our videos are necessarily going to be the sole driver of our share price. Now, there's no question you can get, a short-term pop if you put out a video that's great and it communicates the message effectively, because oftentimes it really is about crafting the message and communicating it effectively. What we do is second nature to me and my team. We live and we breathe this sort of thing, but to be able to communicate that simply, taking something very, very complex, and what we do is extremely complex, and there's a lot of moving parts, and being able to distill that and communicating it to the masses. I always tell people here, communicate to the 99%, because those are, 99% are our investors. It's not necessarily geologists, and a lot of the news that we create is generated by and written by geologists, and that goes over the head of the 99%. So how do we distill the important parts and communicate that effectively, so that this is not meant to supplant fantastic drill results. It's meant to support fantastic drill results and facilitate communication, trust with our shareholders.
This is the third year you're doing this, if I'm not mistaken. Are you going to keep doing it in the future as well?
Well, absolutely. That's my intent. I've gotten, really good feedback from people. I encourage feedback. Leave us comments. Let us know how we're doing. Let us know if you think, how we can do it better. But I think ultimately it's a brand. I think Ore Day is a brand. It has value unto itself, value to the companies who participate, all of our Ore Group companies. I think last year's got 4,500 views. I think this year we're going to hit it out of the park. We have the best lineup we've ever had. I think we've evolved into having someone like yourself host it, which is fantastic. I've been a big fan of your channel, Resource Talks, and and you do a great job of interviewing people objectively, and asking difficult questions. You have given me no real insight on what you're going to ask me, and I think that adds value. So my attitude when am interviewed by someone like yourself is just throw whatever you have at me. I think that sort of comes through, so it's not artificial, and I think that adds value. And so with that, Ore Day will continue to grow and thrive. And as I said, I've got big plans for it. So it's not necessarily just going to be a once a year thing. I think it has a lot more potential with a little bit of thought and innovative ideas.
Sounds like you're about people, projects, and capital.
Well, I think I've heard that tagline somewhere, but that's, that sort of, I didn't have to think too hard or too long about coming up with those three things, because that's what it's all about.
Thank you for hosting this. Thank you for giving me the opportunity to be the talking head in this one. And I'm looking forward to your presentation later about Orefinders and Mistango.
Fantastic, Antonio. I'm very pleased you're joining us for Ore Day this year.
All right, now that the boss is out of the office, it is time for us to start having some fun, which in my case involves talking about macroeconomics, which, as I'm saying this out loud, I'm making it sounds like I should probably rethink what fun means, and I might have to make some better life choices. But nonetheless, I sat down with Zoltan Pozsar, which is quite fun, to talk about inflation, deflation, where the economy is headed, whether the dollar is on its deathbed, and what all of this means for commodities, which Zoltan, by the way, has become increasingly more bullish on over the last 2 years. So I guess here's that conversation. Hi, Zoltan. Welcome to Ore Day, and thank you for investing your time in the Ore Group, sir.
Thank you very much for having me.
Pleasure is all mine, of course. The Ore Group is really happy to have you. Because we're going to be talking about macro, one of the more interesting topics here. Let's take it from the top, I guess. Let's say we get on a plane, 40,000 feet in the air. We look at the state of the global economy and geopolitics. What are we paying attention to, and what are we seeing there?
I think the things to pay attention to is that geopolitics is really important these days. I think we've spent a couple of decades as investors focusing mostly on macroeconomic variables, fiscal policy, monetary policy, corporate earnings. And we did that in the context of a unipolar world order, where great power conflict was not an issue. And today, I think what's fundamentally different is that two great powers, the U.S. and China, are one is the incumbent hegemon, the other is the rising hegemon, and world order is being renegotiated in the process. And when you think about that order, it means the balance of power in terms of commodities, in terms of technologies. The question of money, the dollar supremacy, how do you renegotiate the dollar's supremacy? Why does the system work? Why it doesn't work? So these are all big generational questions. The last time we had to think about any of this stuff was during the earlier part of the 20th century, the Spanish Civil War, the interwar period. So this is what's complicating things. And of course, if you just want to stick to macroeconomic variables, inflation is obviously the big bogeyman, so to speak, because inflation hasn't really been a big issue since the 1980s. Chairman Paul Volcker has successfully slayed inflation for many generations to come. But, when great power conflict rears its ugly head, inflation is always something that we suffer as a result. And so here we are. This is not your parents or your grandparents' macro.
I've heard that a lot, and you're right. Geopolitics seems to matter more and more. All the topics I want to touch upon, by the way, that you just mentioned: inflation, potentially an economic war, currency war, post-dollar world, and all these things. But I've been wondering, out of the two most discussed things right now, I guess would be the liquidity conditions and the state of the economy. Which one of those two do you think matters most right now, or do they matter equally?
I think they always matter equally. The real and the financial world are right on top of each other. Just if you want to think about it in simple terms, there are supply chains, and then on the back of it there are payment chains. Look, I think this the supply chain of things, the supply chain part of things has been under strain, so to speak, ever since 2019. I mean, if you remember, we started with a trade war under President Trump, and then we had a pandemic, then we had lockdowns, supply chain disruptions, a massive fiscal and monetary response to that pandemic. So we basically stimulated demand way above where the level of supply was. Commodity markets are today, I think we could practically say, in disarray. I mean, there's a big basis that crept in between, commodities that are kind of homogeneous. If you think about the fact that you have oil that's flowing east priced in dollars, and then there's oil flowing west priced in dollars, and oil flowing east priced in currencies like renminbi or dirhams or gold even. We can talk later about the deal that Ghana has made with Russia in terms of paying for oil with gold. These are not usual circumstances, and so liquidity, I would say, is cracking. And when you ask about the state of liquidity, liquidity is a big thing, like the world economy is a big thing. So I think we need to distinguish there between liquidity in the treasury market, which is not great. I think we can understand that from various angles. Just the fact that the size of the market is very big, but the dealer's ability to move treasury securities around is just not what it used to be. We can also look at the fact that foreign central banks have stopped buying treasury securities, and I think that's more so the case since the outbreak of the war in the Ukraine. The liquidity is fine in money markets simply because there is so much money in the system, but I think it's a situation where that liquidity is basically causing inflation problems on the other side. So it's a very complex picture. But to perhaps summarize it, it used to be a Swiss clock that's mostly on time, and now you have all sorts of mechanical issues, both in the real world and in the financial world. And I think we are living through the consequences, and we are managing the consequences.
The way I think a big wake-up point for me was one of your pieces where I read that the only reason why we could afford all that, I guess, quote unquote, money printing is what people call it over the last decade, was because of the deflationary pressures that we've been having. And that's now gone, you say, because of this bifurcation of the market. That's right? Precisely.
The QE as a policy, printing money, started in 2008. And if you think about the world back then, it was still the case that we had, cheap capital, cheap commodities, cheap labor, supply chains that worked well. Great power conflict was at bay. And it's precisely these things that have changed. So if you think about it, it's one thing to print money, ultimately the goal of which was to try to inflate asset prices, to get house prices up and stock prices up in the aftermath of the great financial crisis in 2008. It's one thing to do that when the real world is dealing with a problem of plenty. When the real world is going to start dealing with a problem of shortages, printing money is not optimal, to put it mildly. And when you look at the post 2020 world, the issues that you see is that, number one, capital is no longer cheap, commodities are no longer plentiful, supply chains are no longer functioning properly. And most importantly, which is the crux of the matter for most economies domestically, the labor markets are not what they used to be, simply because the pandemic has changed the contours of the labor market. I don't know if you want to talk more in detail about the labor market, but I think if you just think about the fact that a lot of the baby boomers that were still hanging on as participants in the labor market before the pandemic, they retired in large numbers after the pandemic, and so you basically have this kind of pre-pandemic postponed retirement of baby boomers just kind of come back with a vengeance during the pandemic, and we are suffering the consequences. The consequences of that, and of course, the stimulus measures have also changed labor force participation rates on the margin, and so today we are stuck basically with a shortage of virtually everything that determines inflation in Western societies.
It's, I don't know if you saw that this morning, by the way, but the PCE report came in much hotter than expected. It was reported at 1.8%. So much higher than what we saw last time, much higher than what people were expected. And I was reminded of this. There's a great point that Lynn Alden, she's a macro analyst, that she made in her most recent newsletter. She was saying that the current monetary policy towards inflation is sort of like holding a beach ball underwater. It's ready to pop back up once the holder lets go.
Yeah.
And so,
well, look, yeah.
What does that mean?
Yes, there is a I forget who said it, but there's a saying in markets which is that inflation expectations are well anchored when nobody talks about inflation. Okay, so at a time when you cannot really see clients without talking about inflation, or you can't record this discussion without talking about inflation, it means that something is up. I mean, if you just want to take a very objective view, inflation has been an issue for the past 3 years. Okay, it's starting to impact inflation expectations. When you peel the inflation onion, everybody understands that there's basically 3 parts to it. There is headline inflation, which is basically food and energy. There is goods, which is very volatile. Some items are up, some items are down. Some are inflating a lot, some are outright deflating. And then there's the services part, which is largely a function of labor costs. And let's just start with the labor costs. The labor cost component is troubling because the labor market is not falling off the cliff. Unemployment is at a record low everywhere practically. Wage growth is holding up very well, around 4 or 5%. So that basically tells you that core services inflation, stuff that determines the price of services, wages, the things that determine the pace of services inflation, is trending around 4 or 5%. So that's way above the Fed's targets. Okay, then goods up and down. Let's just forget about goods. The important thing on top of a tight labor market and firm wage dynamics is the fact that food and energy are basically stochastic variables. Okay, everybody understands that energy is going to be something that's potentially going to get caught up in geopolitics, because energy is always very geopolitical, especially when the world is going through transformative change. Energy markets, alongside other commodity markets, are extremely tight because basically just finished a decade of no investments in oil and gas fields. So we can revisit this topic. And then food is a derivative of energy because we are basically living in an age of industrial agriculture, where you need energy to grow things, you need energy to transport things, you need fertilizers, and so all of these things are basically pressuring inflation. And if you want to be very objective, and I think the Fed is very good at not overthinking things, and I think they are quite objective about understanding the situation. When you have a situation like what we have today, where food and energy price inflation is stochastic and the risks are more to the upside than to the downside, and you have a historically super tight labor market, those are the only things that matter for inflation and for inflation expectations. The way I like to put it, people don't go on a strike and you don't ask for higher wages when the price of flat screen TVs goes up. you are going to ask for all that when the price of food, fuel, and shelter are up. But that's basically that's the basic setup, and so it's a struggle for the Fed because a lot of these things are out of their control, and they have done a lot. I mean, they have raised interest rates from 0 to 5%, and we don't really have much progress to show for it. I mean, the interest rate sensitive parts of the economy have slowed. Housing has slowed tremendously, but in terms of the indicators you would have hoped to have responded by now, inflation coming down more, unemployment going up more, wage pressure slowing down more, we don't really have any of the results yet.
So that means that the Fed will have to keep pushing that beach ball underwater.
Exactly. So that means that the Fed is going to have to deal with these pressures. I think for the time being, you have to think about the Fed as an institution that has floored the terminal rate, so to speak. The rate at which they are going to leave policy rates at the peak of the hiking cycle. They floored the terminal rate at 5% for the time being. And Chair Powell was very clear about the way forward. The way forward is very simple. It depends on the pace of economic momentum, and it depends on the pace of inflation. If the economic momentum doesn't slow, and if there are upside surprises to inflation, and if oil, for example, goes to 150, you should have no doubts that the Fed is going to respond to that by hiking interest rates higher and keeping rates higher for much longer than what the market anticipates.
So it is higher for longer. Are they focused on that though, or are they focused on because there's talks about currency war, the dollar being weaponized and stuff like that?
Well, look, I mean, I think those are separate considerations. I mean, for the U.S., it's always been the case that it's our currency, your problem. There's always collateral damage when we hike interest rates. It's the dollar gets stronger. It's more expensive to buy commodities. It's more expensive to service debt. Exchange rates get pushed around, but ultimately, the Fed has a dual mandate. It doesn't have a triple mandate. The dual mandate is stable prices and full employment. The triple mandate perhaps would be global financial stability or something like that. Global financial stability is something that either happens or it doesn't. But, just to give you a sense, even the dual mandate right now is just a singular mandate. The full employment mandate is not something that the Fed is targeting right now because we are beyond full employment. So the only thing that they are focused now on is to get inflation down to 2% as soon as possible. And we needed to be there yesterday. And we're still far above it today.
So they're not really focusing on the world de-dollarizing and trying to fight that.
No, because again, it's as I like to say, not just finance, but life, I guess, is hierarchical too. So you have your list of items you focus on, and there's a pecking order. So the most important thing is restoring confidence in a dollar as a store of value, which means inflation has to be down at 2% and real interest rates have to be positive. It's very important, right? I mean, if you think about what Paul Volcker did, for example, I mean, he did it in a very dramatic fashion, but that's precisely what he has done. He raised interest rates sharply to slay inflation and to bring real interest rates positive such that there is confidence in a dollar as a reserve currency. We are doing some version of that. I mean, obviously, we have an economy that's far more financialized. So you can't go from 0 to 20 in one shot, this is essentially what Paul Volcker did. I don't think that we will have to go to 20, but you obviously want to do it a bit more carefully because you don't want to damage the financial system in the process. But again, we've traveled a long way, but it doesn't mean that just because we've had all this pain in stocks and bonds last year, the Fed is not going to keep on pushing rates higher if it has to. And I would also say one more thing, which is that there is this debate in financial markets about is Jay Powell Volcker or not? Does he have what it takes? And I think we should not overthink that. I mean, as a public servant, Jay Powell knows exactly what he is going to be remembered for in history. And the single most important thing you need to keep in mind about the current Fed chair is that he started this hiking cycle by saying that Paul Volcker is my hero. Okay, so once you start your inflation fight with that manifesto, so to speak, that basically means that you are trying to defend the legacy of a man who has given the world the concept of central bank credibility. The reason why central banks have a credibility today is because of Paul Volcker's achievements. So once you say, that's the standard I'm trying to live up to, if you do not deliver 110% of that, you will have damaged central bank reputation for a generation. So this is a central bank chair that, has a mandate from the White House, which, President Biden said that, inflation is public enemy number one. The Fed is going to slay inflation. And so, when the political and technocratic parts of inflation fighting are aligned, they are aligned. So, make no mistake about this. The Fed is going to do the tough job. It's just, they are taking a bit longer than Volcker did. But again, that's because you just have a far more financialized economy, and you have to treat it with a bit of a patience. But we are making progress.
But if it's not 20%, you said higher for longer, what would you guess it would be?
Look, I mean, it's just very simply, if you look at what the Fed and other central banks have done in inflationary periods in the past, what you always do is you raise interest rates to a level where interest rates are above the rate of inflation in a spot sense. So if inflation is 6% today, interest rates would be at 7% because then you have real interest rates today. So you're slowing economic momentum today. What we have been doing is we've been raising interest rates, but in a spot sense, real interest rates are still negative. Fed funds is, 4.5%, 5%, but inflation is above it. Okay, so real rates are positive in a forward sense. So assuming inflation slows as expected and assuming we are going to keep interest rates high for X period of time, ultimately we are going to get to positive real rates. And so we are kind of hoping for that. And so we are in this game of trying not to do too much and not to cause too much damage, not to do unnecessary pain to get things done. But I guess if that strategy doesn't work, what the more drastic measures are going to mean. You're just going to have to keep raising rates until real interest rates are above the rate of inflation.
Real interest rates are generally not great for commodities, right?
They're not great for commodities, but commodities, I think, are have their own unique story. The two standard narratives about commodities in a period like this. The Fed is hiking, real interest rates are positive, the economy is going into a recession. The standard narrative about this is, well, look at what happened in the 1980s after Volcker raised rates. And look at what happened after 2008, after the great financial crisis. Commodity prices collapsed. So, if you're going to have a recession, the same is going to happen this time around. There are two reasons why that view is not correct. I'll tell you both. The first one is that both during the 1980s and 2008, you've had a decade of investments in commodities, all sorts of commodities, oil, gas, copper, that you needed for industries to grow. The 1980s collapse in oil prices after Volcker has raised interest rates and the economy has fallen into a recession. The genesis of that was that OPEC had a price shock in the early 70s, and there is a saying, the cure to high prices is high prices. Oil producers in the rest of the world have responded to those high prices by producing more. So the practical implications of the OPEC price shocks were that the UK developed the North Sea oil fields, Norway developed the Norwegian Seas oil fields. Actually, if you go to the website of the Norges Bank, which is the sovereign wealth fund that manages the oil wealth of Norway, there's a beautiful chart that shows the number of rigs and the number of barrels of oil produced by Norway. And that metric skyrockets in the mid to late 70s, right? Similarly, you had a lot of drilling that happened in Canada and in the oil belt of the United States. So, we had the price shocks, we invested, we pumped, and by the time that recession came, demand for oil fell, and we were basically swimming in oil. The same story in 2008. Everybody knew that when China was welcomed into the world trading system in 2000, they are going to consume a lot of commodities as they beef up their manufacturing base. And so you've had a decade where you've had oil and gas exploration, ore mining, copper, you name it. We all needed that to feed China's voracious appetite. Then came 2008 and a financial crisis, a recession, demand collapsed, but we were swimming in commodities that we have invested in and we were able to produce, but there was suddenly no demand for it, okay? And so let's look at today. Today is different first, because we just had a decade of practically no investment in oil and gas, okay? We've had basically the past 10 years where, the big story in oil was the shale oil revolution in the US. But when you look at the state of shale oil today, it's not an industry that is producing more on the margin, but production from the existing shale fields has peaked. So production is falling, it's not growing. New drilling in shale fields is low because investors have been burned when shale drilling started. A lot of supply came, prices collapsed. And the shale producers are trying to reestablish credibility with investors. So what they are doing is they are protecting their current cash flows, and they're trying to benefit from high prices for as long as they can, because that's what the investors want. When you look at oil majors, again, they are not investing in oil and gas, but rather they are buying back their capital because it's just an uncertain outlook for the demand for oil, for the policy responses of governments when it comes to fossil fuels. You're going to have to kind of do this big pivot from fossil fuels to clean energy by 2030. So these are all things that are complicating things. And so this price signal that used to exist in the past, where the response to high prices was more production and ultimately the result of that was lower prices, that feedback loop today is broken. And this is not just oil and gas, but this is basically true for copper. This is true for lithium and a number of other things where to just economically get copper out of the ground is becoming more and more costly and complicated because the kind of easy to get the deposits have been depleted globally. It takes years to get new copper mines online, and commodities are also getting caught up in geopolitics. I mean, just think about the body language we get from OPEC plus. It's less production, not more. Look at the body language we get from a number of countries that produce lithium, for example. There are countries that nationalize lithium resources. There are countries that are proposing to have an OPEC for lithium. There are countries that are saying that we are going to put a tariff on lithium exports if they are exported in pure form, i.e. as powder. But if you turn it into batteries locally, there will not be tariffs on that. So, it's different because typically commodity-rich countries just export their stuff, but they don't renegotiate the way things are done in terms of, basically the themes that I told you is that, some countries that are sitting in a bunch of commodities, they don't just want to be a part of the supply chain, they want to be a part of the value chain. So there's a big deal because the industries that are basically dependent and are consumers of commodities, they want those industries to come to where the commodity is. And so this is one thing that complicates the commodity. I'll come to the second one in a second. So just to summarize, it's a lack of investments. It's the geopolitics that's getting more complicated, and it's the renegotiation of where you are in terms of the supply chain and the value chain. And all of this basically means that commodities are kind of getting encumbered at the source. So that's the first thing. The second thing that's going to make this recession or the risk of recession different from the past is that, and again, this is something that the markets tend to be blind to in general. A recession is usually defined by two things. Consumer spending falls off the cliff, as does business investment in like a cyclical sense. But anywhere you look, you can't escape the theme that governments in the Western world, let's just call it the G7, are pouring trillions of dollars over the next couple of years into three themes. One is rearming, the second is reshoring, and the third is energy transition. Okay, so the practical examples would be building, battery plants and electric vehicles in the U.S., building chip fabs in the U.S., subsidizing the energy transition in Europe and the U.S., Japan building the third largest military by 2025, Germany and France doubling their military budgets. If you listen to earnings calls of the CEOs of defense manufacturers, they are all trying to build extra factories to basically be able to restock faster whatever drawdown we have seen in military inventories since the outbreak of hostilities in the Ukraine. So, and but the price tags on some of these, $400 billion for the Inflation Reduction Act, $50 billion for chip fabs. But that's just the government's contribution. Then there's going to be private capital that's going to match that government contribution. So there's two things here. All this is going to push demand for commodities high, okay? Because I think we are basically at the cusp of an investment renaissance. And, this is going to be one force that's going to push against all these recessionary kind of impulses that higher interest rates are giving us. It's certainly going to slow consumption, but I think this investment offset is going to be quite powerful, perhaps to the point where we won't even have a recession, right? Because again, consumers can slow, but if industry rips, and if some of these things get brought forward, they get doubled inside, they are done with an urgency. And they will have to be done with an urgency because all three of these, whether it's supply chains or rearming and rewiring the grid, there is a sense of national security and supply chain resiliency to it. So we can't really do it by 2030. We needed to do it yesterday, you see? Mm-hmm. So you put these two themes together, you have constrained commodity markets from a supply perspective, a golden age for demand, so to speak. And I would just say that you just look at the laundry list of things that I think we will have to get done. You basically see a commodity super cycle in embryonic form, but it's going to grow. It's going to grow very fast. You wrap it with a more complicated geopolitical environment, and I think you basically set the stage for a big bull run in virtually all commodities, whether it's old industry or green industry or fossil fuels. Constraints are what they are, and geopolitics is what it is. Usually when you have great power conflict, those periods are very good for commodities, because great powers like to fight over the control of commodities.
So is that what states of heads of state are doing right now?
I think yes. I mean, if you just take a look at a very high level, what is a great power conflict defined by? You have your spheres of influence. One is defending its sphere of influence, the other is expanding it. You need a strong economy. Strong economies are built on industry. Strong economies and strong industries give you the tax base for a muscular military. Okay, all these need to be supplied with raw materials. So you need oil, you need gas, you need rare earths. You need to secure these things on long-term contracts. Have countries been doing that? Yes. I mean, for example, we've had, you just look at the flow of commodities. I mean, commodities out of Russia are flowing all east, okay? if you look at the comprehensive partnership between Iran and China, for example, which was signed in 2021, I mean, that's a 25-year oil deal. When you look at the essence of what the China GCC summit was about, it was about establishing, long-term oil trading relationships between the GCC countries and China, all priced in renminbi. When you look at Africa and Africa's commodity riches, great powers have been all over Africa for the past decade and a half, and so that control of resources there is at stake. So, I think it's important to recognize two things here. Number one, this conflict between the great powers has been on for quite some time now. So this great game and the new Silk Road and Belt and Road and all this stuff has been like a decade-long theme. And so the contours of commodity encumbrance, securing commodities, expanding your sphere of influence have been happening for a while. It's just that perhaps the war in the Ukraine has brought it to the front lines. It's very it's far more tangible. It's easier to cover, and it's something that you can identify with more as an individual, as a market participant. So, some people think that, this kind of great power conflict started somehow over the past year. In fact, I think it just, the past year just highlighted the fact that there has been this conflict over commodities and spheres of influence and great power conflict for a while. It's just that it's more front and center, so to speak. And again, I think the discourse about commodities has changed tremendously over the past year, because when you think about the fact that reshoring and rearming were not a topic 12 months ago, and when you think about the fact that energy transition a year ago was still conceived as something where energy was cheap, capital was cheap, and world order was unipolar, so it was not going to be an issue to secure the commodities to pull off energy transition. I mean, basically the past 12 months have just added this three items to the demand side of the commodity sector. And so, it's a big topic, but the world has basically changed 12 months ago to the benefit of commodities.
So it's nothing like the 40s, it's nothing like the 70s, it's a complete new type of situation.
Well, it's nothing like the 70s, because the 70s was an oil crisis. Today is an energy crisis. It's a gas crisis, it's an oil crisis, it's an electricity crisis. It's to the point where marquee companies like BASF in Germany is downsizing operations at home and is moving operations to China, for example, as a result. Again, the 70s were the price to capital signal worked. If prices went up, people drilled and we had production. So we knew what the solution was going to be. Today, we are not doing that. We are also keenly aware that the industries to pull off energy transition are still being built. Okay, and the timeline is quite ambitious, and we are in a rush. In the 70s, the kind of Cold War, I would say, was winding down. So by the 80s, we were starting to feel the benefits of the peace dividend. Okay, so the peace dividend is gone today. And so, it's a bit more like the 1940s, where, you have the incumbent and the emerging great powers, and you're basically putting embargoes and restrictions on access to commodities. And so, what one country's commodity problem is another country's technology problem, right? Because the commodity encumbrance we talked about, for example, there is a very strong parallel to that in the technology domain, which is basically the technology blockade that the U.S. has been putting around China quite methodically. And so, everybody is going to basically pour money into industries that are going to give you self-sufficiency in areas where you do not have that self-sufficiency. But that is an investment boom, which is something that I like to remind to people that just see a very long and deep recession coming, because this will be a slowdown that the Fed is trying to engineer that might lead to a housing recession and a housing investment decline. But I think it's going to be offset by this industrial revival in the US and other countries in the West.
How long could that go on for? Like if we call this a commodity super cycle, how long would that be? Is it 10, 20 years longer? I don't know.
Cycles last a long time, a couple of years, 5 years at least, 5 years at least, because again, it's a step change up in demand and a neglected supply side and a geopolitically fraught environment. You have not seen this in 100 years. China coming into the world trading system, I think, was easy because there was the price signal, we responded to it. Geopolitics was okay. And all you need to worry about was figuring out the way to meet demand. And demand is not something that came in a rush. China was a part of the world trading system. We'll build factories. We'll move population from rural to urban areas. We'll do it over time. And they did it over time. Today, we are doing things in a rush. We don't know where the commodities are coming from. And the countries that are controlling the commodities are complicating things.
So from a commodity perspective, and I'm sorry if I'm being so hung up on commodities, but they often say that commodities and the dollar are inversely correlated, right? But if we're talking about de-dollarization, could we see I'm a little bit confused as to what happened. Like, can the dollar and commodities go up together is basically what I'm trying to come down to.
Well, the dollar is a beauty contest, and it's a complicated question. My framework for this is always that when you think about the dollar is money, one particular country's money, and it has many dimensions. This dollar, it has 4 prices, and these 4 prices of money are par, interest rate, foreign exchange, and the price level. Okay, so I'm going to be a bit pedestrian, but I think it's important for you and the audience to understand this. Par is just the fact that I can wire money to you, you can wire money to someone else, and basically when you wire money from one bank to another to yet another, $100 is $100, and that's par. Okay, so money is par on demand. You can move it around. The value of money doesn't get impaired just because you shift it around between currency and banks and between bank deposits. Interest is the price of money today versus the price of money tomorrow. If I lend to you tomorrow until money tomorrow, you have to pay 5% because that's where overnight interest rates are. The Fed sets it. Then there's the exchange rate. There's the dollar and the rest of the world. The dollar is going to be strong versus some currencies, weak versus other currencies. And then, of course, there is the price level, which, since we're talking about commodities, let's just say that the price level is what $100 buys in terms of oil or in terms of gold or in terms of lithium or whatever ore you want to think about. Okay. And so when you ask what the dollar is going to do, I think the dollar is going to be strong potentially versus other G7 currencies. So versus the euro and versus sterling and versus the yen, it's not hard to imagine the dollar is going to remain strong because, it's just going to be a function of interest rate differentials. Some countries are going to again, like if you just think about the context in which we talked about the US, that inflation will be persistent. We will have a lot of investment. inflation is going to be suffering from persistent upward pressure. So maybe the Fed is going to have to go to 6 to 7%. But if industry is migrating away from Europe to the US, growth in Europe is going to suffer. So they won't be able to raise interest rates that much. So that brings a bigger interest rate differential. So you get a stronger dollar versus the euro. It's easy to imagine like that. The part of the conversation we've had about commodities, we are basically saying that commodity prices are going to go up a lot, okay, because of supply-demand imbalances, because of geopolitics, all of that. That basically means that the dollar is going to get devalued versus commodities. Okay, so when that price level goes up, it just means that the dollar is weaker versus commodities, stronger versus the euro, but that just means that the euro is even more weak versus commodities. And then there will be the countries with currencies that have a lot of commodity backing. Think about Brazil. Think about Russia. Think about India for a different reason. We'll come to that in a second. And think about countries like China, which is basically encumbering all these sanctioned commodities, so to speak. And just think about oil, where you basically are getting Russian oil on the cheap, and you are paying for it you are paying for them with your own currency. You're getting Iranian oil for cheap, and you are paying for it with your own currency. You are going to have long-term contracts with OPEC countries, and you are going to ultimately pay for all that with your own currency. When you think about the fact that a country like China or a country like India were always in a position where they had to produce something and hustle to export things, to earn dollars, so that they can turn around and spend those dollars on commodities that were invoiced in US dollars. When that dynamic changes to a world where, well, as China, I can now pay for oil with my own currency, because some countries that are selling oil won't take dollars. And so, my currency is a better alternative for them. When India and China are becoming middlemen between Europe and Russia, importing LNG and oil, paying for that with their own currency, and re-exporting either the raw commodity or the refined product, diesel or heating oil or what have you, back to Europe for a spread, for euros and dollars, that's basically a very different dynamic in foreign exchange markets, because you no longer spend foreign exchanges. You're not a conduit for another currency to do things, but you basically harvest value, which benefits your own currency ultimately. So what does the dollar do in this context? The dollar gets devalued versus commodities. The result is inflation. The result is higher interest rates. The dollar is going to get stronger versus currencies that can't raise rates as much. And the dollar is going to be weak versus currencies that benefit from all this, great power conflict and the changes that are afoot. So, what's the dollar doing? And usually the answer to that is you look on Bloomberg and you look at the DXY, which is a dollar index. But the dollar index is predominantly weighted against euro and yen and sterling. So depending on, that's why I said it's a relative beauty contest and the cleanest dirty shirt in town. When you want to evaluate something, is it good or bad or strong or weak, you have to have the right reference point. And I think a lot of investors are using the wrong reference point, and they are taking comfort in the fact that, well, the dollar is strong relative to what? And so, this is something that's going to impact your portfolio construction, because ultimately, as a bond investor, you basically have to grapple with questions like, okay, well, do I buy bonds today, or do I keep my money in cash? Do I buy developed market bonds? Do I buy more EM bonds than developed market bonds? Do commodities have a place in my portfolio as an ultimate inflation hedge? How do I express that? Do I buy the equity of commodity producers, or do I buy the physical commodity? Do I buy it at a futures exchange? If you're on a futures exchange, which one? If you want to buy gold, do you buy the exposure to a gold producer, or do you buy physical gold? Well, the last time we've had great power conflict, President Roosevelt seized gold assets. So is that safe? So how do I express these views? But these are all big questions at a time like this.
So where do you start if you were constructing a portfolio right now? You start by looking at the geopolitics. What do you start thinking about?
Well, I think, you start by reading history books. The rise and fall of great powers, Freedom's Forge, The World for Sale, which is a more recent book about how the commodity world works, the story of Glencore and other commodity traders. Wartime stuff. When you have to marshal industry in short order, what is it you do, and how do you pull it up? And it's very important to highlight this. But last year commodities had a very good year across the board, and stocks and bonds had a very bad year across the board. And the last time we've had that, during the interwar period and during the 70s, we were going through monetary change. In the 70s, we abandoned the gold standard. In the 30s, you went from sterling as the reserve currency to the dollar as a reserve currency. And so that's, these periods always coincide with a big inflection point and big monetary change. And, the 30s and the 40s were obviously also a period of great power conflict and upheaval in the world. And again, so when prices are doing this, commodities are outperforming and stocks and bonds are that something is up. So I think when you know that something is up and it's not really clear where things are going, I think cash is king. And cash is king, especially in the context that cash now pays a decent interest. It's 5%. The curve is inverted, so front end yields more than the back end. So now it's just a judgment call as to, should I buy the long end because the Fed is going to cut interest rates tomorrow? But I just told you that they are probably not going to, and in fact, they are going to raise rates higher still. Do I buy commodities as an inflation hedge? Yes, because there's not enough inflation protected treasury securities going around for everyone. It's complicated to use a thin market as a hedge for the entire system. How do you approach investing in commodities? Do you buy the thing itself, or do you buy commodity linked equities? I mean, when you look at the oil price, for example, it's gone up in the beginning of last year when the conflict broke out, but it kind of came down since then. But when you look at the price of energy majors, the stock price of energy majors, those have rallied tremendously. So that's how you get the duration components to oil prices. Oil prices today are up and down, and they are not doing anything crazy yet. But what the stock price of ExxonMobil and Chevron are telling you is that over the next 5 years, oil will stay high, and it has the risk of gapping higher. So that's what those stocks are telling you. So I think 60-40 is something that you need to rethink. I mean, that's your standard X amount in bonds, X amounts in stocks. And I think you need to buffer that on the margins with cash and commodities. And I think a combination like that is going to perform much better than the 60-40 mix, which, if you think about it, is something that became fashionable in the post-Volcker era, where the dollar was the undisputed reserve currency and every central bank in the world was buying treasury securities because they were keeping their exchange rates weak and exporting deflation. It's not that world anymore. So
the new 60-40 would be what stocks, commodity stocks and physical commodity instead of stocks and bonds.
20-40, 20-20 something to start.
Okay.
Trim that 60-40 on by 20 on either side, and that would have done wonders to your portfolio last year. And look, it's a sign of times. You know, you can't really read the financial press without reading about asset managers and hedge funds hiring away, you know, the commodity index traders from banks, hiring away commodity traders from commodity traders. You know, so fast money, so to speak, is homing in on this theme. You know, it's I talked to hedge funds that basically, since the outbreak of the war, stopped trading nominal assets. You know, give me real rates, give me commodities, give me commodity-linked equities. So I think change is afoot. The world is complex, and I think commodities are going to be a very, very important part of the shape of things to come over the next 5 years, for sure. I mean, it's always discount the future faster than the future happens, right? But I think that's going to be a theme that's going to be very important. You know, I often say the joke that, you know, I'm an interest rate strategist. I look at bank balance sheets and reserves and, you know, think about reserves as if they were oil or gold or some ore, and like, where is it? How can we move it from here to there? And I think I've spent most of my time last year educating myself about commodities, where they are, who controls them, who wants to kind of move up the value chain, how is this thing impacted by great power conflict, and what is it that central banks can do about it, or not. So I think money used to be very important, but now commodities are way more important. That for those four prices, you know, par, interest, foreign exchange, and the price level was always at the bottom. Commodities were like this mean reverting thing that you didn't really worry about too much. The prices went up, more supply came, so it came down. I need to invert that. The price level is the most important, and I think the commodity question is your starting point, and everything else will follow from that.
And so the cure for high prices is high prices dynamic. You don't think that's going to be as big of a thing as it was in the past?
The cure for high prices in a peaceful world, in a unipolar world, is high prices, because, you know, capital responds, you drill more. The cure for high prices in a world where the world is no longer unipolar, a great power conflict is back, things are, and where basically the incentive structure of the capital side of commodity producers is broken, right? Is state intervention in any form. I mean, how do you incentivize hands-on that shale producers drill more? I mean, we've been trying to do it verbally to no result. So, you know, things can happen along the spectrum. The end of the spectrum is, you know, the state just forces you to drill. When you think about securing lithium for EV batteries, you forge alliances with countries. You ask minority shareholders in lithium mines, for example, it happened in Canada, to divest those minority stakes, because this is an asset now that's a matter of national security. So I forget what your question was, but yes. So the cure to high prices is peaceful. The cure to high prices is statecraft, I would say, at this moment in time, and it's going to be part incentivizing capital, part statecraft, where you basically encumber resources and you try to control as much as you need, as much of what you need.
I see that we're almost running out of time, and I want to be respectful of your time. I was just wondering, have you looked into some of these more niche commodities like uranium? There seems to be a lot of talk about that. Some billionaires are moving into it. Have you been paying attention or being interested in uranium?
I have been reading about it and keeping an eye on it. I mean, the story is pretty obvious. And again, as you said, the billionaire is moving it. It means that that smart money on the margin is punting. Okay, so we have this energy transition thing. It's going to require a lot of energy to build the clean energy infrastructure. We don't seem to have that energy because we don't really know where just oil is going to come from meeting standard demand in oil, standard growth in oil demand this year. So yes, nuclear is going to have its renaissance. And for that, we need uranium. And so when you look at the reactor manufacturers and the technological advances there, and the fuel for all that stuff, I think that's a sub theme of this larger theme that we have talked about. But uranium is a niche one, lithium is a niche one, oil and gas is obviously the elephant in the room. But copper ores. I mean, when you think about rearming, which basically means you are just kind of like, even if you just do it from a deterrence perspective, you are getting ready for what? I mean, you need a lot of iron ore for that. I mean, it doesn't really matter if China is building apartments and needs metal for that to build the metal beams, or if you're building tanks or artillery shells or stuff you're going to blow up. I mean, that type of very low productivity, but it churns a lot of economic activity. And then there's even gold, which we didn't talk about, which is important because it has the potential to kind of creep back as a neutral reserve asset in a world where we are renegotiating world order. But it's once you kind of look beyond this cyclical fear that dominates, for the wrong reasons, as I explained, right? Because this is not the 80s and this is not 2008. Once you kind of move beyond that, I think there is tremendous value in commodities on that 5-year horizon. And that's how you need to understand interest rates. That's how you need to understand inflation, and that's how you need to understand interest rates on a 5-year horizon. It's like, it's funny, but like, finance is about discounting the future. And for an industry that is supposed to discount the future, we pay way too much attention to what the last CPI report about last month said. And we, tend to assume that all this bad geopolitical stuff that has been happening since 2019 is not going to continue to happen going forward. So we make convenient shortcuts, and then, assuming the world is a peaceful place, assuming great power conflict gets resolved, assuming Goldilocks, inflation is going to be by 2% by the end of the year, and the Fed is going to cut back down to 2% like those old times. But I'm afraid it's not going to be like that.
Right. I've been wondering also what role interest rates play in the financing of these commodity companies because of the weighted average cost of capital going up. But these still remain risky businesses to finance, right? I mean, mining is a risky business. So how does the higher interest rate influence that?
Yes, well, it's a risky business. And I think you need to distinguish between who is going to finance it. I mean, just think about some of the things that are, let's take a look at this in the West, and let's take a look at this in the East. In the West, the whole rearming, reshoring, rewiring the grid theme is a matter of national security, supply chain resiliency, those types of things, not interest rate sensitive. Very, very important to keep in mind. If the Fed raises interest rates to 10%, we are still going to be doing this stuff. And famously, when you look at history, I mean, I just finished reading Chris Miller's Chip War. I mean, I had no idea, but Fairchild Semiconductor, the company that was a predecessor of Intel, in the 80s when they started to make semiconductors, they were borrowing at a rate of 20%, smack in the middle of the Volcker recession, because they figured out something that they thought is going to run the world 30 years from now. So when you have the right idea and you have pricing power and people are going to kind of buy the stuff you're building the factories for today, the cost of capital doesn't really matter. Cost of capital certainly won't matter when it comes to energy security, military security, and supply chain resiliency. If you think about a company like MP Materials, the Mountain Pass mines operator, where basically the idea over the medium term is to not only mine rare earths, which is we had a rare earth mine in the US, but it was closed down. We reopened it. We're still exporting the rare earths mined there to China for refining, and then we re-import it. So the idea there is to mine the rare earth, refine it in locally, and also turn it into final products locally. So that whole vertical integration. That company is not going to be disturbed if capital costs are going to be 10%. Because in fact, it's not a risky business. It's a very safe business given the geopolitical context. And then, you have the countries that actually have the commodities, Brazil and Indonesia and the Philippines and China and the Middle East. And you're just going to invest in it on your own. But if you invested in it on your own, it's no longer a kind of global effort where a global oil major or a global commodity producer or a global, battery manufacturer or a company like Tesla co-invests with you. It's going to be a situation where it's your capital, it's your commodity, and it's their problem. So this theme that I have come up with last year, that it used to be our currency, your problem. We're kind of getting into our commodity, your problem type world, where the ugly truth about commodities is that a lot of it is coming from places that are not in the West. So the biggest consumer of commodities is our EM countries in the global East and the South.
So the bifurcation of the market can really be a thing in commodities. I mean, can really become increasingly a more important topic over the next decade or so.
I think so.
Okay. Well, you're giving me lots of food for thought. I guess macro is a topic that you never really are finished talking on. So I think this is a good starter point to start talking about commodities with the OR group. Is there something that I'm missing, some important development in commodities that you think, or in the global macro that I'm missing that you want to talk about?
Anything in addition to what we already talked about?
Yeah.
I think we covered the ground well, and I think we have touched on all the important supply, demand, geopolitical, and macro topics. So I think this is going to be a good period for commodities.
Yeah, this was a very good overview. Thank you for putting all this into a nice, easy to understand picture, and thank you so much for investing your time in the OR group.
Thank you very much for having me.
All right, moving on. I pretty much got a carte blanche for this event for some reason. So I get to decide and dictate the pace and order of the speakers of OR Day this year, at least. Again, for God knows what reason. But the things I like: uranium. I'm also a shareholder of Baselode Energy, which, by the way, is the OR Group's uranium exploration company, and it is also the biggest company in terms of market cap that the OR Group has. Baselode is currently looking to grow its recently discovered Akio deposit on the edges of the Athabasca Basin, as well as potentially find more uranium deposits at one of their other 3 projects, all of which, by the way, close to the edges of the Athabasca Basin. Not because there was no place in the Athabasca Basin, it's pretty big, but because Baselode is running with a very interesting strategy called Athabasca 2.0. But if I try to explain that to you and what that means, I probably won't get to host any more of these events, and I can really use it. So we're about to hear what Baselode is spending my money on from James Sykes, their CEO, right after which, by the way, we'll be hearing from Justin Huhn, the Uranium Insider. So I guess if you're thinking about skipping here, don't. Okay, first of all, it's rude, and it's also it's bad luck. Some may even say that it would cause 7 years of underfeeding and negative tails assays. And although I have no idea what I just said, it sounds bad. Okay, so let's just listen to James here first. He's a good guy most of the time. All right, James, I'm reading your bio here that I sort of took off your website of Baselode, and it says that over the past decade, you were directly and indirectly involved with the discovery of about 500 million pounds of uranium in the Athabasca Basin specifically. What does that mean exactly, directly and indirectly involved in the discovery of it?
Directly means I was part of the team that made the drill discovery, and indirectly means that I was part of the team that went off and drilled it.
Okay,
so I guess the indirect discoveries would be things such as Denison Mines with the Phoenix and Griffin discoveries. So I was part of the exploration team that put some information in towards them focusing in on those areas, especially Griffin. I had relogged drill core and noticed the clay alteration that looked similar to Millennium, and it had radioactivity down there, mineralization. And so eventually, after I'd left Denison, the team did like the area, and it was a big follow-up anyway, so they went on and made a discovery there. Whereas something like NextGen, the direct discovery was being with the team that made the discovery and being part of the whole drill targeting right from day one, getting out there and just setting everything up and watching the drills go.
How many people does it take to do that?
To be honest, it could take one person. It depends.
Okay. Well, you're not doing it alone this time with Baselode. Who else do you have on there? What have they done?
We've got the whole org group behind us, and so as far as the whole office management and really the accounting side of things and the broker side of finance things, I do a lot of that too, which the org group behind us take care of a lot of that. And on the technical side, I've got Cameron McKay, who's our VP exploration, and he's had a lot of experience with Pierpoint Uranium, working on the projects over there, contiguous with NextGen's Rook claims, which host Arrow, and he's been a part of a lot of discoveries on the Pierpoint side of things. So he brings that background to Baselode.
Is Pierpoint mad at you that you stole him?
They actually let him go. I didn't steal him. It was
bad for them.
COVID. He was unemployed. I was looking for somebody because we just started up Baselode, and his name came across my desk. I reached out to him. We hit it off right away, and the rest is history.
I noticed that you were when you left, I guess last time with NextGen, there was a period that you were not doing. I sort of looked at your profile on LinkedIn. There's a period that you were not working in geology, and then you came back. Why did you leave and then come back? What was that about?
I left because I wanted to try something new. I was disheartened after the whole leaving NextGen side of things, and just thought, well, let's see where life can take me. So I tried a couple of things, and my heart just kept coming back to geology. So I decided, all right, let's get back into geology. Let's make another run of things, because I thought I had the skills to, that would benefit a company making discoveries. And I think that's proven true.
That's being proven true, absolutely. And now you're back in the Athabasca Basin is what I was going to say. This time, though, you're looking for uranium that's hopefully closer to surface. That's what you found at Akio, and than what you've previously worked on. As you hope, I guess, that it will be mineable during this cycle. You even call that strategy Athabasca 2.0, if I'm not mistaken. Can you maybe walk me through that strategy and elaborate on why you think it's better than 1.0?
Yeah, 2.0 really goes back to the roots. So in theory, we can call it Athabasca 0.0. When you look at the history of the Athabasca, all of the mills and all of the first mines that were where you extracted uranium from were all open pits. There was some underground adit access mines as well, which the open pits really built the Athabasca. They built all the mills. If it weren't for the McLean Lake Mill, Cigar probably wouldn't even be in operation. Same with McArthur River. If it weren't for the Key Lake Mill, Cigar Lake Mill probably wouldn't be in operation. But those mills were already built for those mines to have uranium extracted from them. So I noticed that. I came across a seminal paper almost 10 years ago, one of my old bosses, Bill Kerr, and another seasoned veteran, Roger Wallace, who's been part of a number of Athabasca discoveries between the 60s and 70s, they got together and they wrote this paper, and it just made a lot of sense. Why are we looking for these deep uranium deposits with sandstone cover that don't get mined because they've got water issues? Why aren't we looking for these shallower hosted deposits where you can have a bit of sandstone, yes, but you can also have no sandstone, and you can go back to the tried, tested, and true methods of basement hosted mineralization. So I took that to heart, and after seeing what Fission Uranium with their Triple R discovery, there's no sandstone on top of that. So it's one of these Athabasca 2.0 discoveries. So I just kept thinking about it, and the idea really just spurned from all of that. And I guess the big difference, and I think why a lot of people may not have started exploring this far out as to where we are, is because there was just old thinking about how that basin works, and a lot of the old geologists or the seasoned vets, they say that the basin it's uniform. So when you hit the basin edge where it is today, you'd expect the unconformity to keep going up and up and up. So if you're this far out of the basin, you're going to be a kilometer beneath the sandstone where it would have been. But if you look at a lot of basin topographies nowadays, even ones that are forming nowadays or ones that formed historically, yeah, you do have that. But at some point, they all become horizontal and expand out. So that's that slight little change that we've made, which has allowed us to look at further targets away from the current Athabasca Basin edge, is just realizing that the Athabasca Basin could have been right there. It could have been right at these locations, just everything's been glaciated and removed.
Okay. Did you ever answer that question for you? Like, why are most companies then not looking for that, but they're looking for the 1.0?
I think it's an easier target. To be very honest, working with the sandstone it's a gift in uranium exploration, because the sandstone is a blank canvas. It should have no geochemical anomalies. It should have no geophysical anomalies. So when you do surveys such as resistivity, you can pick up the clay alteration within the sandstone. And when you drill these things, you can pick up geochemical anomalies within the sandstone. So it makes exploration just that much easier. Whereas when you're in the basement rocks, everything's tighter because sandstone's loose, not unconsolidated, but the sandstone materials are not as tight as basement rocks. So you can get larger alteration plumes, much larger than what you'd see in the basement rocks. Whereas basement rocks all have to be sheared and fractured and veined. So everything's really tight. So you're looking for much smaller features, needles in a haystack versus, a barrel of needles in a haystack.
Mm-hmm. Does that make your strategy higher risk though?
I think, yes, I would have to admit that for sure. We limit that risk by using applied geophysics and knowledge that both Cameron and myself take from our previous exploration companies and discoveries that we can apply to these grounds. So everything really comes down to the first stage of what we've done, and that was staking what we thought were all the right projects, ones that we saw these potentials for structural controls to allow fluid migration within these areas. And I think with the discovery success that we made at Accio with the first drill program, I think that really proves to be true.
So I guess to be going out and staking that ground, you sort of had I guess if we assume that this Athabasca 2.0 type deposit was a cake and it had an ingredient list, what would that list look like? And also, how many items off that list have you managed to cross off already?
Basically all of them. We've staked some more ground, so I won't, and that we call that Project Bear. So I won't really talk about Bear because we haven't touched it yet. We've done considerable amount of work on 2 projects so far, and that's Hook and Catharsis. Both of those projects, yes, they're all staked with the same criteria and the same methodology. So that's menu list number 1, or ingredient list number 1 is your staking. So you want the right project in the right area, and we really focused on areas that were close to pre-existing infrastructure. So uranium mills that are already there play a big part, because if you do make a discovery, you want to limit the amount of capex that you have to put forward. Plus, you've got roads there and power lines. And we looked at areas that didn't have infrastructure and said, okay, there's targets up there, but if you make a discovery up there, what are you going to do? Can you really get that into production in a timely fashion? So there was, even within that first ingredient, there's a lot of sub-ingredients that we had to waylay and really help us focus into where we wanted to look. After that, then it's simple a matter of flying geophysics on the surveys. We limit the geophysical surveys that we acquire. We're big on gravity. We're big on EM, and EM can come in different ways. Resistivity and EM are just basically the inverse of each other. So we've kind of adopted the use of MT, which is a form of resistivity, therefore a form of EM, just to make things convoluted for everybody watching. But what it really does is maps out these deep structures. And so we've taken a lot of that and applied it to our target areas. And again, you look at the magnetics and really just overlay everything on top of that. Ingredient list done, you have to go out and drill. Yeah, we've accomplished all of that for Hook and for Catharsis. Because we're in the basement rocks as well, we do like to get out there on the ground and see what the geology is like, give us a little bit of an indication for what we can expect to find with diamond drilling, and try to put two and two together. We can also fly airborne radiometric surveys, which we have done on Hook, and from that we can start picking up certain clues that could indicate where glacial geology, so the last geological event in the area, which was glaciers coming through the area, plowing everything off, and then leaving deposits of rocks behind as overburden, we can start picking up clues from what happened during that event with the radiometrics.
Okay. What about cooking time? How long does that process to make that cake? How long does it take? And for the Athabasca 2.0, I mean, from start to finish, including, as you said, hopefully putting up a mine there, how many years would that process be?
It's a good question, especially in the way today's governments and regulatory process work. They're not the 70s, they're not the 80s anymore, so things have changed. However, if you look at some of the more recent open pit mines within the Athabasca, those would be the Sioux deposits, which Orano owns. Those were mined in the early 2000s. They shut down the mining operations, I believe it was either 2005 or 2007. I think it was 2007. But from what I know, those discoveries were made not too long before then. So it was basically a 5 to 10 year from discovery to production side of things for those open pit mines. So we think that, and with that only being 20 years ago, we still think that those regulatory processes do exist, that we could, with an open pit mine, you can expedite the process and bring it into production in a very quick and timely fashion, as long as there are no environmental issues, so long as you've got the indigenous communities on board as well. All the ducks basically have to align. But if they do, then it should be a streamlined process. Should be, yeah. That's
what it should be, and what's going to happen. Lately have been two different things, so that'd be interesting to watch. Provided though, in the Athabasca Basin, I guess the average grade would be at around 4%, and what makes it attractive is that those are small deposits. Like, NextGen is supposed to be a large producer once, and if they get it into production, but it's not that big of a deposit if you compare it to like a copper deposit or something else, just because of how high grade it is. Now you've shown lower grades at Akio on the Hook project, on the Hook property, though they're closer to surface. But would that mean that you have to compensate for it in size, just as a traditional mine?
Slightly, but it also depends on the scope of what you're looking for. Are you looking for these 100 million pound deposits and you'll ignore something that's not as large? Are you looking for these MacArthur style of deposits? There's a lot of factors in play there. Again, we go back to the history of open pit mining within the Athabasca. Rabbit Lake, average grade was 0.3%. They mined out 30 million pounds. You go to Clough Lake, where they had 5 open pit mines, variable grades from 0.2 up to over 1%. But they mined about, about 25 million pounds open pit out of 5 different open pit mines. Some of those open pits were even less than 1 million pounds, but they still pulled them out of the ground. So, why would you do something like that if it's not going to be economic, is what goes on in my head. You look at all the underground mining operation that was going on at the Beaver Lodge, so Uranium City area, all of those grades, average grades were below 0.3%. Those were all underground operations, some open pits. So that really, when it comes down to things, when you've got the open pit, the grade really doesn't matter all that much. And even the size of things, if it's economic, it's economic. Even globally, you look at some of the American mines, the underground mines, their grades are less than 0.3, and they're still going underground to mine them. You look at Ranger in Australia, which was the biggest uranium mine in Australia. Grades there were about 0.2, 0.3% open pit, and then they went underground as well. So these are grades that have been proven to be economic, not just in Canada, but globally as well. So we're not discouraged by lower than typical Athabasca grades at all.
What would be considered the bare minimum then for this project to be commercial in terms of tonnage and grade? Like if you tell me, how many million pounds at what average grade?
Honestly, couldn't answer that right now. That's something that we're trying to work towards to really figure out. Theoretically, we've got a few numbers in our mind, but until we've got some more solidified numbers at our back, we can't really define any of that. Again, it all comes down to what's your capex, what's your opex. There's even the geology of the mine. Do you have a lot of waste rock? Are they these high grade chutes that you're following, or is it more disseminated mineralization throughout the entire ore body? Can you limit the amount of waste? We've already looked at ore sorting technologies, so there's that advantage to be able to mine at lower cutoff grades and be able to use ore sorted technology that would upgrade your resource. But then it all comes down to the mill as well. So one of our strategies, as I said, was we were looking at areas around, or projects around, pre-existing mills. Doesn't mean we can use them. We would have to be able to come to some sort of agreement with the mill operators, hopefully toll milling agreements. But even then, is our mineralogy and metallurgy, is it going to be compatible with what they are milling and mining? A lot of factors at play, but those are just some of the hoops and hurdles that we are investigating and trying to overcome with each step of the way.
Many unanswered questions. Yeah. How many holes do you think you have to put in Accio to get more answers on some of those questions?
We've had a very good look at it, and even just to get to an indicated resource, we're fairly comfortable that we would need probably about half or less than half of what we drilled last year. So we put in about 80 drill holes into Accio, I guess, from discovery and last year as well, for about 20,000 meters. So we figured less than half of that should be able to get us to an indicated resource.
So, okay, so what's your timeline on that? When do you want to have that out?
Love to have a resource estimate out by Q4 of this year, or even Q1 of next year. But if everything aligns nicely and we complete our objective this summer, which is when we do plan to go back to Accio, then we should have everything ready to go by Q4. So Q4, Q1 next year is a pretty good estimate.
Okay. That's the Hook property specifically. Do all of your property fit that geological thesis? Do they just fall into one whole? I mean, are they all pieces of the same puzzle, basically, geologically?
Yes. Yep.
Okay.
Yep.
Well,
they were designed that way.
What's that?
They were designed that way. They were all designed to be very similar with the same strategies involved. That if with Accio, with what we can learn from Accio, if we make it another discovery on Hook, or if we make a discovery on Shadow, Catharsis, Bear, wherever, we're already ahead of what we didn't know 3 years ago. So then any discovery that we make on any of these other projects, we will be able to quickly advance and operate based on our learning from Accio.
So that's Catharsis and Hook. I guess the rest of the work that you've been doing this year is going to be on Hook, right? Or are you doing something on Shadow and Bear too?
Bear, we're still going to hold on to. Shadow, we could do some work on Bear, depending on what we can get done at Shadow. Shadow's still in consultation process. Yep. It's been basically 2.5 years now, ongoing, with no steps forward. But I've been back engaged with the chief and the council directly, so that's a good first step. We're trying to get an airborne survey done and have some ground follow-up on Shadow as well, to hopefully be able to be drill ready by next year. We probably will go back to Catharsis, maybe not with a drill program this year, but at least have some ground prospecting, because there are some other, now that we know where some of these prime target areas are, we'd want to see the rocks around those areas, just see if we can pick up some very subtle details. But yeah, the rest of the year is really going to be focused on Hook. Drilling, we've got definition drilling to be done. We've got targets within the immediate Accio area that we'd like to follow up. And then we've also got exploration targets that are much removed from Accio, but the geophysical anomalisms are quite encouraging. So there's quite a bit that we want to get done.
When does that start?
Anywhere from May to June. I was hopeful for April to May, but after listening to the field crew, and April, May, the snow really starts to melt, and if you've got a lot of snow cover, things become very, very slushy up there, and it was not conducive for exploration. It was probably the hardest time that they had. So even with the minus 40 days during dead cold of winter, they're saying that the thaw period was the most difficult for them to work with, just because of the amount of water that was being produced on ground with the snow melt. So we're going to wait for that, and that should hopefully be all dried up or pretty close to dry within around May, and hopefully have the drills turning by end of May, early June.
Mm-hmm. Have you been talking to your neighbors over there, though, the 92 Energy, and how they're going to dealing with this? And also maybe you can talk to me about what sort of the plan is to go forward, because if there's a deposit, if I understand it correctly, then it's one deposit. You guys, you have it. You think you have the better part, obviously. But like, is this going to be a race of who comes out with a resource first? Are you going to work together? Are you talking, stuff like that?
Yeah, we have been talking, but is it a race? Not really. We're doing what's best for us. We follow and monitor what they do. But yes, it is one deposit. There's no doubt about that. The two are going to be linked. We do have the shallower mineralization where they've got the deeper ends of things. So we see that, again, with the Athabasca 2.0 strategy, it's the whole idea of that was looking for shallow mineralization, things that are open pittable. So as we define that as it is now at Accio, we're going to stick to our guns and focus on that side of things. Whatever happens down the road is to be seen.
Okay. So the weather is one thing that you should be paying attention to. I guess that's also one of the challenges of exploring that for up north. But in my brief experience as a natural resource speculator, I've learned that there's always more challenges, that stuff that I'm not thinking about. So let me maybe ask you that. What are some of the hidden challenges that I might be overseeing here, or some of the viewers here might be overseeing, that do keep you up at night?
Weather is always one of them. You can never predict the weather, and it's cold plays havoc, extreme heat plays havoc, dry. When we've been seeing drier years up in northern Saskatchewan. So I've even seen lower water levels in certain areas, but oddly enough, in other areas, I've seen higher water levels. So just things like that kind of play. Rising costs, really affects your budget. So even just with mobilizing a drill, now with higher gas prices, you can't use a mobilization estimate that was done 2 years ago, because gas prices are just shot through the roof, diesel even more so. So all of these food prices are going up. So every time that you try to put a budget together, it's not too hard to really undercut everything. And the next thing you know, you're spending more than what you thought. Helicopter costs for their fuel, just everything, all the costs have just gone up so quickly in the past year to 2 years. So I'd say for us, that's probably the biggest thing. There are some new environmental standards that are being looked at within the Athabasca area, Saskatchewan as a whole, to be honest. And those are just things that we have to abide by anyway. So not really hindrances, but they do sometimes slow down the process. Fortunately, we're always quick enough to get our permits into exploration, and we look for 2 to 3 year exploration permits anyway, just so we don't have to sit there and keep going back and reapply for exploration permits.
Mm. But in terms of permits and community and all that for Hook, you're set for this year, right?
Yeah.
Okay. What about capital? Because you're talking about raising costs. When are you looking to raise money?
Before we go back drilling, we'd like to get the share price a little bit higher and be able to go back. We are fully funded. We've still got about 7 million in the bank in cash, at least 7 million in the bank in cash. And a lot of that though is hard dollar. It's all is good working capital asset that we have right now, which is what we don't want to spend, considering that this market still doesn't look very favorable. There was a good run, positive sentiment in the uranium space, but now everything's kind of gone back, and everything's being dragged down across the markets globally. And it's really hard not only to raise money in those circumstances, but it kind of puts you in this perspective, like, should we, how full blown should we go? Should we put our foot right down to the pedal and go 100 miles an hour? Should we ease off a bit and maybe do half of what we want to do? So just a lot of considerations. Last year, we raised 3 million in flow through. We've put about a third of that towards Catharsis, knowing that we do want to get back to Accio. So we could have done a much larger program at Catharsis. But again, not having the funds secure as it was, and not wanting to use what we've already got in the bank, that we wanted to be cognizant of that. We've even kicked around the idea of just going up there with 1 drill this year instead of 2 drills. So it's all kind of cash dependent. If we can raise more money between now and May, let's say, then we'd be looking at a larger drill program. We'd be able to hit we'd be able to check off all the boxes that we've got planned for this year.
Well, so what are you doing to make sure you're going to raise more money, or you're going to be able to raise more money?
We've got a pipeline of, let's call them educational pieces to come out. So once the Catharsis news is out, hopefully people will appreciate what we've done there and what we've seen there. And then we basically segue right back into Accio and just keep pushing that envelope. Again, just really trying to educate the market on what Accio is looking like and how it really compares to a lot of these other open pit mines. And for us, that's really the big win, is that it's not just a deposit. This is a deposit with a legitimate prospect to be mined very quickly. That was our strategy from day one, and we're hitting it. So we're going to keep pushing that, because being able to have that in today's market goes a long way. It does something unique for the Athabasca, in that the Athabasca is not reliant on McArthur River or Cigar Lake, and that's it, which are the world's largest high-grade uranium deposits, the most valuable commodity of any commodity across the globe by far. There's nothing that compares to them. But once they're done, what's next? Really, what's next in the Athabasca? So hopefully Accio is the next, or even the now.
Those are big plans. I was going to call them big dreams, but in your case, those are not only dreams; they're currently plans. So that's something that as a shareholder myself, I would be looking forward to. And I assume you're not. You're kind of like me. I'm underwater on the investment, obviously, and I'm not as happy with the market cap, and you probably aren't either. So let me ask you this: if I were to take a plane tonight and come to Saskatchewan tomorrow with a briefcase full with $50 million Canadian, which is about where your market cap is right now, would you? I mean, let's assume it was a private company and you owned the whole company. Would you sell it to me?
Tough. That's a very tough question. I was taught very early on, take the money when it's there. But if you're going to give over controlling rights to an outside company, it's a very tough question. That's something that would obviously have to go through the board and through the investors that exist.
I was just trying to sort of figure out what you think of it. So to figure out if you would buy these 3 projects, if money was not an issue for you, would you buy these 3 projects at the state that they are and the team behind them for this amount of money? That's sort of a personal question, because obviously, yeah, if we had to make it realistic, it would have to go through the board and all that, and it'd probably not be as easy. But like you personally, would you do it?
I'd buy Accio for sure, without a heartbeat. Yeah, it's hard for me to say that because I love all these projects. Oh, they really came out of my head, so I'm very biased on them and say, yeah, I'd buy them all. But Accio, from what I can see, and what I'm hoping that other larger companies, or just anybody who's put mines into development before, can hopefully also see what we see, that it should be low capex, should be low opex, and have a net turn on the asset that's there within a very short time frame. So if you've got a deposit that's going to make you money, why not? Isn't that business? Nobody goes into business to lose money. Everyone goes into business to make money and benefit their shareholders, or benefit the company in the long run. So yes, I would completely buy Accio in heartbeat. I'd buy Accio, GMZ, combine it all as one.
Yeah, that's what most people are talking about out there online. That's what everybody's really speculating on. So it'd be interesting to watch. I don't think I have any other questions, James. Here, what am I missing about the story? Something else you want to add?
No, you're not missing anything. I think we've hit all the main parts. Catharsis is awesome. Well, Shadow and Bear are also awesome, which is why we staked them. And Accio is going to be what I believe is going to be a huge success. We've got a much better handle on the structure, which was kind of elusive there throughout the season. But now that we do have an idea of what's going on, we've got some immediate targets that we want to follow up. So kind of segue into some of these educational pieces that I alluded to earlier is we mentioned it from day one that we thought there was a good sandstone target at Accio. But now with all of the drilling done and the geochemical assays that we have, and even some of the quartz irradiation studies that we have, we've got a vector that's pointing us towards the southeast of Accio and the sandstone, saying, hey, look, this is your most prospective area for unconformity mineralization. So we've got a lot of things like that are just in the works, just some really good looking targets that if we find more uranium at Accio, and a zone that we have to the west is completely wide open. We've got a couple drill holes into this western little blip of mineralization, and it's completely wide open. So the more that we start drilling off and discovering in this area, especially shallow and open pitable, this creates the big win for us, for our investors, for the Athabasca as a whole. Because if Athabasca 2.0 takes off and we start seeing more of these open pit discoveries, then I think Athabasca climbs back up on top and takes lead on global uranium production.
So it's a bigger picture here. You're talking about these discoveries to the west. How much do you think you're going to be stepping out to the west to figure out what's there?
We don't need to step out too far, 50 meters to the west. So we don't need to go to the project boundary. We know that the mineralization that we're seeing there is going to be constrained within our project side. So between 50 to 100 meters.
Okay, 50 to 100 meters. Yeah, because I know that you know, if this was gold we were talking about, or copper we were talking about, these step outs would be almost as if there's some gimmick play or something that you're doing, but it's different in uranium, if I get it correctly.
Yep.
Okay, so 50 to, okay, that's a good step out. So yeah, you're right about Shadow and Bear, by the way. They look like interesting projects. I just wish that the First Nations would also see the potential and work with you. Let's hope something happens there this year. Are you meeting again this year?
Yes. Yep. Hopefully we'll be meeting within the next month or two.
Okay, good stuff. So potentially something to come out of there. Okay. All right. Well, thanks, James. Thanks for this overview. Thanks to the Ore Group for putting this together. And yeah, thank you for being here. Thanks
a lot, Antonio. Always a pleasure.
All right, so that's Baselode, again, the Ore Group's Uranium Explorer. But why even uranium and why now? I mean, you know, you hear all these things about enrichment and conversion and shortages and sales assays and overfeeding and replacement rate contracting and spot buying on the spot market and confusing. Frankly, it's a lot, okay, especially if you're me. So, you know, I'll shut up for now and let an actual expert do the talking in the face of a uranium insider, Justin Huhn. To talk to me about uranium, where we are headed, and how long it takes us to get there, holding his crystal ball, I have with me Justin Huhn, also known as the Uranium Insider, with me here today. Justin, thank you so much for investing your time with me.
Happy to be here. Good to see you again, Antonio.
Yeah, the pleasure is all mine. We've been talking about uranium for a while, but let's just say that I had no idea why uranium and why now. And let's say that you and I meet in an elevator. You have some 1 minute or so to convince me to consider uranium as part of my high risk investment portfolio. Why uranium and why now?
There's currently somewhat of a nuclear renaissance going on with the energy crises that we've seen over the past 18 months or so. Nuclear is being re-embraced by the environmental left, let's say, as a potential solution for a low carbon, energy dense future, the electrification of basically everything. The commodity itself is trading well below a price that the industry needs to incentivize new production. There's a massive shortfall in supply currently and expanding as we go forward into the later part of this decade. And the equities are trading still, 30+% below their high print of just a year and a half ago or so. So we think it's a ripe opportunity. We think that we're going to see a strong general commodities market in the next number of years and potentially for a good part of the rest of this decade. I think uranium is going to be one of the leading commodities to bring gains towards patient investors.
How has your experience been in telling that story to people between now and when you first started? Because I felt like when I was looking into this for the first time, must have been 2018, and I was talking to like my dad and my other relatives about it, they were looking at me as if I had two heads, and that's changed. They're even asking questions about nuclear now. So how's your experience been?
It's very much changed. Yeah, I had the same experience. For me, I discovered this opportunity, let's say in 2016, started to really talk about it maybe later part of 2017 into 2018. And, you had and still have your niche community on Twitter and the investing community in uranium on Twitter, where you had a handful of people that kind of understood the thesis and knew more than the average person about the growth of the sector and the supply shortfall, et cetera, et cetera. But to talk about it with anybody else got the same kind of looks for me. It was very difficult to explain exactly what I was doing and exactly why I was interested in this thing. So from really the depths of the bear market to only about maybe 2.5, 3 years ago, it was a bet on a hated industry, an industry that was completely forgotten, a commodity that was trading at 20% of the cost it needed to be. And it was a bet on this going from absolutely terrible to just bad. And that's really where it was at. It was a recognition that, oh, maybe there was a 1% growth in the sector, and we need higher prices. That was the core thesis at the beginning. Prices have to go up because we have a supply shortfall, and there's an unknown amount of above ground mobile inventory that in the short, potentially to midterm, can buffer the supply shortfall, which it did. But eventually, at some point, utilities are going to have to come back into the market and secure long-term contracts. And finally, we're really seeing the beginning of that, and it's really picking up steam right now. So the thesis is that the core thesis remains. I mean, the core thesis is utilities, generally speaking, globally, have a lot of uncovered supply that they need to cover. They need to secure long-term contracts out to 2030 and beyond for the reactors that are going to be operating for that time frame, and the price still remains below the average cost of production, and it remains well below the costs that are needed to bring on supply. So assuming that nuclear will remain a thing, and assuming that the vast majority of the reactors under operation now will be operating 5 years from now, we need new supply. And we need new supply simply to balance out the market and for the health of the sector. And that only comes with higher prices and long-term contracts with those, not only brownfield care and maintenance mines coming back online, but new greenfield production.
So even if we don't account for the growth that we have in the nuclear renaissance, that's still the case. Is that true? Because I've heard the argument that, the growth in nuclear reactors, first of all, they're very slow to build. And if you average out that growth and relate it to U3O8 demand, that really leaves you with low single digits growth. So it's not much of a growth industry, but we don't even need that to make a thesis. Am I getting it correctly?
Correct. Yeah. A big part of it is the existing fleet now and how much it, generally speaking, has been de-risked by what has happened in the world over the last 5 years. So one example would be the United States with the largest fleet with 92 reactors. We've seen a number of life extensions. Of course, we've seen some early retirements as well over that same time period. But we now have something called the Inflation Reduction Act, which has nuclear, clean energy tax credits that are supporting nuclear reactors. And so what we have is the largest fleet in the world, significantly de-risked by this government support in recognition of the importance of that fleet. And that's just the United States. We've seen Japan finally legislating that they're going to not only accelerate restarts, but they're actually going to look into building new nuclear, especially when it comes to smaller advanced reactors. We should see 3 more reactors restarted this year in Japan. South Korea has fully pivoted. They're full on back into nuclear. We've seen the UK is looking at new builds. France is looking at new builds. China is going, balls to the wall here. They're building, I think, 22, 23 reactors currently under construction. Their goals are to hit 200 gigawatts by 2035. Are they on pace to hit that? No, they're not, but they're still building more than anybody else in the world. So we do have this nuclear renaissance really is sort of twofold. It's one, a general recognition of the importance of saving the existing fleet for as long as we can. And of course, there's exceptions to that, but for the most part, that is moving in that direction. And 2, a lot of excitement about building new nuclear, both large traditional nuclear. Westinghouse signed a deal to build, I think it's 5 AP1000s in the country of Poland. That's just one example, but a lot of excitement about SMRs, small modular reactors, and new designs, new advanced reactors.
I just want to go back to a point that you made previously about utilities finally having to come back into the market, because what first got me interested in uranium was the supply gap at the time, which was supposedly going to just start getting worse because of what was, again, at the time supposed to be that thing that would dry up the spot market completely. And that was the thing that was going to get utilities freaking out and signing more long-term contracts. Even more, some speculated at the time that utilities would sign even more contracts than they did back when Cigar Lake flooded during the last cycle. For me, that thing was Section 233, 232. That was supposed to be, that big driver at the time. That was roughly 5 years ago. And sure, the price of uranium has gone up significantly. It's actually gone up nearly 3 times since then. But the spot market still seems to be able to keep coming up with pounds. And yes, some contracts have been signed. We're seeing growth in contracts. I know that. But nobody's yet panicking, I guess, besides retail investors at times on Twitter. But what's I mean, we see all these positive developments that you're walking me through here, but utilities are still not panicking, it seems like. So what do you think, what's happening there?
Well, I think that panic for the utilities was really never, at least for me, not part of the thesis, not expecting them to panic into long-term contracts. You have to recognize that a lot of the guys that were around, the fuel buyers during the previous bull market, overpaid significantly for uranium, signed contracts at $100 a pound and never lived it down. Those same people are not going to make that mistake again and probably already have covered. The other point I would make is that, relative to what you just said, is that utilities don't look to the spot market to cover their needs. The spot market is simply, it's a market for surplus disposal. It's when an entity has pounds to sell, they go to the spot market to sell it. And typically that's not producers. Now, there are some producers that sell into the spot market. You have UG, which is the trading arm of Orano. They sell in the spot market a little bit. Uranium One did and probably does still sell in the spot market. The Chinese sell a little bit, but the big players are like BHP, their Olympic Dam mine in Australia. That's primarily a gold and copper mine, but they have 7, 8, 9 million pounds a year of uranium. That's literally a byproduct. And they sell that either right into the spot market or short-term spot referenced contracts. So the spot market, while it's the most visible market, is not the market that's important to utilities. It's not the market where the utilities go to buy uranium to fulfill their needs for their reactors. That's, generally speaking, the long-term contracting market. Now, there's been somewhat of an exception to that over the past 5, 6, 7 years, which has been carry trades. Now, carry trades were, and I say were because they're not really existing now. So to give you an example, 2021, the carry trade still made up something like 20-something% of the term contracts, whereas 2022, they were 3% of the term contracts. So it's basically died. And that has a lot to do with not only minimal above ground mobile inventories now, because we've worked through a lot of that, but also interest rates. And so, but carry traders, what they did in the later part of the last decade, especially, was they would sign 2, 3, 4 year kind of short to midterm contracts with utilities. They would make the process very easy for them. They would source the uranium in the spot market. They would hold it on their books. They would add their profit margin and whatever the cost of carry. They'd hold the pounds just on their own books, and then they deliver out into the future to these utilities. And they allowed for the consumption of a good part of that mobile inventory that had just been lingering, sitting in a can at the conversion facilities due to the oversupply that followed the Fukushima Daiichi accident, which took 10% of the global's demand offline like that. Well, the producers kept ramping, especially Kazakhstan. So long story short, that above ground mobile inventory is largely gone, especially at these prices. Will some inventory shake out at higher prices? Probably, but a lot of times what happens is the price starts to rise. People tend to hang on to the inventory because the rising price is indicative of a shortage of a material. And that's what we've seen in the past 5 years, right? We've seen the price go from $18 to $50. That doesn't happen in an oversupplied market. That's a really, really, really important point to understand. And it's the most basic point of all commodities markets. Shortfalls equal rising price, period. Period, the end. Oversupplied markets equal falling price. So we're on the uptrend of this cycle. And what we're seeing now in terms of the long-term contracting market is we saw officially 114 million pounds signed in long-term contracts last year. And that is set against the backdrop of about 180 million pounds of demand by the global reactor fleet. Now, the reported numbers for long-term contracting grabs about 85% of the total contract. So likely we saw about 15% more than 114 million pounds signed. We probably saw 130, 135 million pounds signed last year, right? What we're hearing now, in the month of January, the number of pounds under consideration for contracts to be signed this year is already greater than what was signed in 2021. We're seeing more than 70 million pounds. Officially, more than 40 million pounds have already been signed in long-term contracting this year to date. We're 6 weeks into the year. So I fully expect we'll see replacement rate at least levels of long-term contracting. And these long-term contracting cycles typically last multiple years. We're talking 3 to 5 years at least. And they're going to last that long. And it's not theoretical. It's an understanding of how much material is out there. It's just available above ground. Understand who's producing, who's going to be producing, and how much material is going to be available. And then looking at the uncovered needs for the global utilities, you know that we're going to see multiple years of replacement rate contracting and then some. Plus, we're also at historically relatively low inventory levels. And that doesn't mean utilities are sitting on nothing and they're about to panic. That's not what we're talking about here. That's not what we want. That's not what anybody wants. That's not what the industry wants. Utilities typically hold 2 to 3 years of inventory, and we're on the lower side of that. So usually, historically speaking, what happens during these long-term contracting cycles is utilities restock. So you'll see not only the burn rate, 180, 185, 190 million pounds, be contracted in a year, but they'll actually bolster their inventories. And they could do that before in the spot market and with carry trades, and now they can't. So it's really all about the term contracts here, and that's going to what's be primarily driving the price without getting into secondary demand from financial players.
Well, I was thinking, as all other commodities that we're discussing on ore date, this is a cyclical sector, as you mentioned. And I know Americans like talking about baseball, but let's retire that analogy. I know you personally don't like it. Let's maybe talk about it more specifically, because you said long-term contracting cycles, they can last for a couple of years. How many years do you expect this uranium bull cycle to go on for, and how many years have we already been into the cycle for?
That's a really good question. Well, obviously, from the bottom of the commodity, that was 2016. So if we're talking about, I mean, coming off of the bottom, in my opinion, doesn't really mean bull market. It's more kind of a trend that you see based on moving averages is what I would call a bull market. Not the absolute, the first move up off the bottom doesn't really mean bull market. It kind of just means the bleeding has stopped, right? So, but that was 2016. So what is that? 7 years, almost 7. No, it's a little over 6 years, because it was December of 2016. And we're speaking in February of 2023. So I would say that we're still, without the baseball analogies, we're not at the very, very beginning, but we're closer to the beginning than we are at the end. And the reason I believe that is because we still have a ways to go for the commodity to get to that baseline level of price that justifies incentives for mines to come online. And it's not like we get to $75, $85 a pound and all of a sudden there's uranium in the market. That's just not how it works. It's going to take a long time for mines to come online. And most models have, let's just say, for example, NextGen's Arrow coming online 2027, maybe 2028. That, in my opinion, is probably a pipe dream. Honestly, I think it's an unbelievable deposit. It's the biggest, basically highest grade deposit of pretty much any metal on the planet. It's going to cost, by the time they start actually building it, whoever ends up building it, it's going to cost multiple billions of dollars and take many, many, many years. They have to build a mill. That doesn't happen in 2 years. I mean, it takes a year to remodel your bathroom, right? It takes a very long time to build these projects. And and we're going to see that continuously. We've already seen multiple delays in some of the brownfield projects coming back online, even some of the greenfield projects. That's just going to be the way it is. So the big question, so let me just give a simple answer to your question. I think we could see a very long-term bull market that could go out towards the end of the decade and potentially beyond. Just zooming out generally, now there's going to be big ups and downs between that, right? So for example, the bull market that happened 2004 to 2007 for the commodity went from less than $10 to $134 in less than 4 years. That was a big price spike, and a lot of that had to do with financial speculation. Hedge funds buying uranium, basically. When the hedge funds started selling the uranium, that coincided with the recession, that brought that spike back down into, I think it was the 40s. So we had a baseline price of $8, $9, $10 that was kind of chopping sideways for a number of years. Then we vastly overshot and came back down to a higher low. And then we started to recover again because the demand was still there. The actual demand was still there. That's what we're seeing and what we're projecting here as well. The demand is going to be there. It's going to increase, and it's going to take high prices and a lot of development to feed what we see is going to be a multi-decade growth in nuclear energy, if things go the way we believe that they will and they should, in my opinion. due to the energy density and the clean nature of that electricity production that comes from nuclear. So if we look at something like the IEA's projection that nuclear should more than double by 2040, okay, that's 17 years away, and they're talking about doubling the nuclear fleet. That's a big ask. Do I think it should happen? Yes, I do. But that's a really big ask, right? Because you need a doubling of the labor force. You need an unbelievably huge push to develop pounds in the ground into producing resources. So if we continue to move in that direction, there's going to be a continuous and growing demand for the commodity, which should support higher prices, generally speaking. Now, of course, we can get to a level of price where it just doesn't work for the existing utilities, right? And that's that remains to be seen what that price is. Like I said, utilities paid north of $100 a pound 15 years ago. So adjust that for inflation. They'll pay what they need to pay if they absolutely need the uranium. The big question in my mind has to do with whether or not we'll see a price spike due to financial speculation again. And this market, yeah, go ahead.
What do you think the cure for the high prices is, though? Because it is time bound. I'm getting from you here, but because if it's $75, we're at 50 now. If you say $75 and you're talking about this bull run going into the end of this decade, if it takes us 7 years to get to that $75, that's just 5% growth per year, more give or take CAGR. So what is the cure for high prices in this case?
Well, the prices are going to need to go north of that. So that's just kind of, I just threw that number out there. We're looking at probably, the projects on the margin. Some of these projects, let's say the lower grade projects in Namibia, for example, they had incentivized prices basically in the low 70s, with their feasibility studies 2, 3, 4 years ago. Inflation continues to push up on costs of everything. And so we're looking at probably the cost on the margin for the marginal projects is probably something like $85 to $90 a pound here. But like I said, what happens is you get to that price, and it's not like all of a sudden you see some of these low grade projects come online. Just immediately, a lot of these projects need to raise hundreds of millions, if not billions of dollars in capital, and they need to secure contracts to make sure that they don't spend that capital and then all of a sudden have a market for whatever reason they can't sell into. So the rising price is one aspect of it, but you actually have to have capital cycles and de-risking based on contracting to get these projects to actually happen. And that's just kind of the baseline. So the baseline is, I think we're looking at, $90 plus uranium, simply based on supply and demand dynamics. And that should happen sooner rather than later, in my opinion. I believe that's not going to take till 2030. I believe that's going to be in the next 2 to 3 years. But the other thing really, again, is the financial speculators. And that is what drove the price to prices far higher than what was needed in the previous market. And now we happen to have much more efficient vehicles in place. I mean, we had Uranium Participation Corporation in the previous market, and when they were trading at a premium to their net asset value for a period of time, they would go into the market and they would raise cash and they would buy uranium. And now what we have is the Sprott vehicle that can actually issue trust units into the open market via an ATM vehicle whenever they're trading at a greater than 1% premium to the net asset value of the previous day. So, for example, they've been trading right around their NAV and a slight premium to it for the last 2 weeks, almost exclusively. That kind of came out of nowhere. And they've raised almost, I think they've raised $150 million year to date so far. And they've purchased almost 2 million pounds of uranium. That's year to date so far. And this vehicle is just there waiting for capital flow into it. And if we have the, let's say, bloodthirsty financial players get a hold of this thing, there's no price that would surprise me. And do I think that's going to happen? I do, but I can't model that. I can't predict when and if those capital flows are going to happen, but gun to my head, do I think they will? I do.
You're talking about some of these producers needing higher prices to go into production. What about the producers on the other end? Maybe some of the ones that are not talked about a lot out there. I know people would mention Kazatomprom and them potentially ramping up production. I think that's being covered well enough that they don't really have the ability to do that as quickly as we might expect them to because of supply chain shortages. But Uzbekistan is an obscure player in the uranium market, despite it being an important supplier, and despite it allegedly having the right geology to ramp up production quickly if the price goes up a lot. At least that's what I've been told. So do you follow it, and how important is Uzbekistan in this thesis?
It's important. We do follow it. I agree with you with Kazatomprom. They do, in my opinion, have the geology to support higher production levels, at least temporarily. But just like any commodity that's in the ground, you go for the high grade, you go for the nose first, and you get those high grade pounds first. And Kazatomprom, the ISR mining that they do, they have to have continual well field development to maintain the level of production. It's ongoing all the time. The slowest months are December, January, February because of the winter, very harsh winters in Kazakhstan. But for the most part, they're constantly drilling. So if they have, which they are actually currently going through this, any sort of interruptions to their supply chains, whether it be piping to line the wells, casing, whether it be sulfuric acid, they're building their own sulfuric acid plant, which should help alleviate some of that. But any sort of interruptions, and they see a slowdown production, which they just mentioned last month in their Q4 wrap up, that basically they're not going to hit their 2023 production, and 2024 is in question. And this is only 6 months after saying they're going to increase production in 2024. So they're not a tap that can just turn on. They need everything to go right. They need the capital markets, the demand from utilities, and they need no interruptions in their supply chains that go from 60 million pounds to 65 million pounds. It's a big ask for them, especially since the best parts of the best deposits have already been mined there, right? So it's going to take an increasing effort to maintain, let alone grow production. Uzbekistan is kind of like Kazakhstan light, but they don't have the geology. No, they don't have it as well as Kazakhstan. So I believe they guided last year to be able to double production by 2030. That's another 8 or 9 million pounds of uranium production by 2030. And if you're saying what we're saying, that production is needed. Even with every single proposed project coming online in the next 5 to 6 years, we still have a shortfall of supply in the multiple hundreds of millions of pounds.
So unlike last time around, where I guess the spike in the price went to almost 140, I've been told that was caused by a perceived shortage because of Cigar Lake flooding. There wasn't a real shortage, and now this time we have a real shortage. But as I'm saying this, I can almost hear myself saying, "Oh, is this time different?" But people always tell me those are the four, how many ever most dangerous words in finance. You should never say that, because it's never different. But you expect it to be more of a gradual increase and stay higher. Am I getting it correctly this time around?
It has everything to do with the financial interests. Honestly, it really does. And whether or not we see a spiking price. And I honestly think we probably will. So I would expect we probably see a spike in the price. I'm not even going to guess where it's going to go within the next probably 2 years. I think probably what will happen after that is it'll settle back down to a higher low. And assuming we have continued demand from the world's reactor fleet, and that continues to grow at the pace that it is now, that should see high prices for many, many years going forward. So it could be an exciting tradable situation in the next couple of years, or it could be a long-term just kind of buy and hold for a very long period of time. It's very difficult to tell what the capital markets are going to do. So that's why we don't really model out secondary demand, just because it's impossible. But we know it's going to be something, and how big of a something it's going to be, we don't know. What is really interesting is that what's happening with the past year with the war in Ukraine is that some Western utilities have signed contracts with Western producers, the Camecos of the world, Urenco and Orano for enrichment conversion, Cameco for conversion, and then Cameco and some other entities for uranium. But a lot of utilities have sort of relied on their inventories to see if the situation would calm down, to see if the war would dissipate, if peace would be realized, which obviously everybody wants, prior to engaging in long-term contracts with a Western producer, because Russia's been an unbelievably reliable, low-cost producer forever. I mean, basically since the 80s, they've been producing and providing, since the 70s for Europe, since the 80s for the United States. And from what I hear, we just had Dustin Garrow, managing director of Nuclear Fuel Associates, as our webinar guest for Uranium Insider. We actually spoke with him just yesterday. He said that the Russians did not miss one delivery, not one delivery in almost 20 years. And, you can make one phone call and they'd cover every element of the fuel cycle, and that's it. And so a lot of utilities, and very, very competitive pricing. That's important. So now that that's not necessarily off the table, we just saw that the EU turned down actually sanctioning Rosatom. My belief is that there's a lot of Russian designed reactors in the EU, and it's only the Russians that can certify these reactors to continue operation and give them life extension. So they can't sanction the entity that's going to actually offer those licenses. So that's kind of a fly in the ointment there. But utilities still are generally in the West avoiding new contracts with Russia. That, I believe, is going to stick and probably be lasting for quite a while, at least the next number of years. Which means, long story short, I know we discussed this in the past, I'm not going to get into the weeds, but which means we're going to see incremental increases in overfeeding with Western enrichers actually buying uranium on the open market to feed into their centrifuges. And we're going to probably see continually high tails assays, transactional tails assays with the Western enrichers. So utilities signing enrichment contracts for late 2020s, early 2030s, and in the 0.3 and higher tails, which means a really, really big jump in uranium demand, 20 to 25% jump in demand for uranium just to feed through the conversion and enrichment process. And that's 70+% of the global fleet that's in the West. And that's increasing because all these reactors that are in Eastern Europe that historically have gone to Russia for their supply, which is Cameco announced that contract with Energoatom. That's a big one. So interesting bifurcated situation in the uranium market. And that's, I think we'll see, and we're actually seeing the very conservative price reporting nuclear analysts, nuclear consultants firms that won't be named right now, going into much higher numbers for the next few years in demand. So they're modeling out, much higher than 180 million pounds. We're looking at north of 200 million pounds that could start, as soon as kind of next year, which has to do with these high transactional tails assays. And potentially, they actually do model out some secondary demand from financial players, but we're going to see north of 200 million pounds of demand. Not necessarily this year because the overfeeding is limited by the conversion bottleneck. And we're only starting to see some enrichment contracts in the 0.3s. If that continues, I think we're looking 2024 or 2025, 200, 210 million plus pounds of actual purchasing and demand for those years.
But from the government side of things, you don't expect the US to sanction Russian uranium either? Am I getting it correctly?
Well, I mean, the EU just shot it down for those reasons. I mean, they didn't explicitly say those reasons, I don't believe, but that's why I believe that they did that. We could see it in the United States, but they're probably going to give waivers of some kind so that legacy contracts could continue to be honored. But they might actually cut off new business with Russia for the US utilities. That remains to be seen. There's a couple of players in the United States, Senator John Barrasso from Wyoming, Senator Manchin from West Virginia. There's one other that just proposed a new legislation again. That's something like the Domestic Nuclear Supply Act or something like that. That's not exactly the name, but something along those lines. Essentially proposing we stop taking uranium from Russia and we continue to increase support for domestic mining. And so that continues to move in that direction, but there's pressure from the utilities to maintain those deliveries because they're so low priced, right? If you cut off actually receiving these deliveries, and in the short term, there's some utilities that actually need those deliveries because we can't necessarily get spot EUP, Western spot EUP and fabrication in time for those fuel reloads, right? So some utilities still need those deliveries, but to take a delivery that you signed 4 years ago with Uranium One or Rosatom or whoever it might be, by the time that arrives, you're paying the partial reference to the market, which is what it is, but the fixed price of that contract is probably in the 20s, And so they want to hang on to those as much as possible. There's a lot of pressure from the utilities to push against this legislation, as crazy as it might sound. And that's not all utilities, right? There's some of the big utilities, I think, like the Dukes and the Constellations have covered a lot of their needs and are not doing business with Russia and are in support of banning Russian material. But there's a lot of utilities in the US, and some of the smaller ones are seeking to continue to buy from Russia.
I've been thinking about government involvement into the sector as of recently, and how that might potentially turn into a risk or not. And I'm hoping you can give me more insights there, because I don't think I'm getting the full picture. Is because placing, for example, price caps or something like that, as you said, I don't know if you said it, but it is true, uranium is responsible for some 10% of global electricity demand, 20% in the US specifically. So what if we're talking about big supply gaps here? What if there's no uranium out there? Like, what if the government, mandates SPUT to release the by then possibly 100 million pounds or whatever they have by then, or they put a price cap, or like, can there be some type of involvement from the government that breaks the thesis for us?
I think that's kind of a stretch. It's not illegal to own uranium, so what they're doing is perfectly legitimate. If they did that, that would crush the companies that also exist in Canada that are selling uranium. So that would not be an ideal situation for them as well. And when I say crush, I mean, it would significantly impact, at least for the short term, right? It would obviously lower prices, but of course they can force them to sell it, but can they set their own price? I mean, I think that's a stretch. I don't see that happening, but who knows? Anything's possible, but it's not something we believe is going to happen. Sprott's done their work. They've done their homework on this, and they have plenty of other trusts that they have that hold physical metals, and there's never been any sort of issue around that. Even though some of the precious metals trusts have redemption clauses, but it would take a shareholder vote to actually be able to sell uranium. So the shareholders would actually have to approve a change to the prospectus for them to sell uranium. That would have to happen. So everybody that's like, oh well, maybe Sprott just one day decides to cash in, well, the shareholders have to approve that. Maybe we're at such prices that gets approved, and the shareholders believe that will be something good for them. But generally speaking, I think the shareholders understand that the buying and holding of this commodity is what has an accretive price on the sector and on the commodity. And a lot of it's pouring rain. I apologize if you're getting some loud noise in the background. A lot of players believe basically that own SPUT, own other equities in the space as well. And those are obviously affected by the rising prices, of which would be negatively affected by SPUT selling uranium. So not something that's on our bingo card. As far as other government actions, sure. I mean, that I honestly think is maybe one of the longer term potential risks to the thesis, is basically governments just not doing the right thing, which has plenty of historical precedent, right? I mean, just look at Germany right now. They've got 3 perfectly operating nuclear reactors remaining. A lot of pressure now for them to keep them online. Maybe they will, but they've shut down the rest of their fleet, and it doesn't make any sense whatsoever when it comes from a clean energy perspective, when it comes from an energy security perspective, when it comes from a national security perspective. Yet they've done it. And so there's continues to be a vast expanding into renewables, even in places and in situations where it makes absolutely no sense whatsoever. So it's entirely possible. Oh man, it's hailing against the window. Sorry for that noise. It's entirely possible that countries just shoot themselves in the foot. It's happening now. It could happen more. That's possible, but we have to look at in investments. It's important to look at what is happening, not what you want to happen. And so looking at what is happening right now is Japan restarting reactors faster, and South Korea pivoting, and the United States de-risking their fleet, China building a massive amount of plants, and that's what's happening. So that's what we're going with, and what we're projecting, at least for the short to the midterm. So I think we'll see a pretty rip-roaring market here for in the next couple of years, and maybe we spike and come back down to a higher low and then grind higher. I don't know. Maybe the capital markets, against all odds, just don't take advantage of this opportunity. We just have a longer, slower bull market. That would be fine too.
In the meanwhile, we are seeing big players in the capital markets starting to pay attention to this as well. Just recently reported Stanley Druckenmiller has taken a position in uranium as well. Is that something you expect to see more moving forward?
I think assuming this sector continues to grow, yes. I think the story has improved so much. There's been a massive amount of de-risking of the story, just in recognition of everything that's gone on in support of nuclear over the last couple of years. And somebody like Stanley Druckenmiller that might recognize that and recognize that opportunity. One of the all-time greats, in my opinion. But of course, size begets size. So we've heard this. I know you've heard this as well, talking to people like Sprott CEO John Ciampaglia, that there's plenty of funds that he's talked to that have multiple billions in AUM, if not hundreds of billions, that get it. They get the thesis. They understand. They're bullish. They just can't touch the sector at $42 billion in market cap. They can't touch it. They can't take a sizable position that actually moves the needle for the fund. There's just nothing that's liquid enough. There's nothing that's big enough for them to have a position that even makes sense. So as the sector grows, and it's a difficult thing to understand, because retail tends to look only at buying the lows and selling the highs, right? Just trying to get in at the bottom and get out at the top. And nobody ever does that, but there are some good traders out there, right? But when you're managing an AUM of $50 billion, liquidity is number one. The ability to get in and out of something is 100% the most important aspect of it. So as the sector grows, yes, I do expect we should see some larger entities. We just saw the last couple of days that BlackRock was looking at the uranium and nuclear sectors and looking at potentially creating a nuclear ETF. I don't know what exactly it would hold. I don't know if they're going to do it. That's the largest money manager on the planet. I have a feeling they're going to look at the sector and love it and see that it's too small and not going to go for it. But I could be wrong. I would love to be wrong. But that's pretty significant. That should equal a lot of money flows and attention towards the sector.
I've heard the argument, though, that besides liquidity, valuations matter too. And if you run whatever type of financial valuation for Cameco, I guess, a PE ratio, for example, that type of high level stuff, you might discard it right away because you see a earnings per share of a couple of pennies, and then you see price per share $30. And then you look at some of the developers and you do a EV to NPV ratio, for example, and you come out at 1, even though they did the study at like 50% higher than spot. So would you say that the valuations of some of these companies have gotten out of hand, and could that also be keeping institutions away from the market?
Probably not, honestly. I mean, maybe some smaller funds might look at it and not be interested for that reason, but no, I think it has to do with the bigger story and liquidity in the sector more than anything. Because we see when funds flow into the sector and they go for the liquid vehicles, they're not necessarily looking at valuation. So if they're going for a SPUT or the ETFs, they're looking at liquidity, not valuation. And so, and the ETFs hold everything in the sector, right? So it just moves everything. And capital flows are going to dictate price more than anything. So yes, you can look at certain things that look overvalued. Cameco's earnings per share should continue to increase because we're literally just at the start of this contracting cycle. They're talking about extending Cigar Lake and trying to improve as far as the total number of pounds that they have to contract out in the future. So those terms of those contracts should keep improving for them and increase the bottom line. But as far as total valuations, there's some companies that are still very cheap. There's some that look expensive here. But as a total market capitalization of the sector and liquidity of the sector, as that increases, the price of the stocks are just going to keep going up regardless of what that valuation is at. In my opinion, flows will dictate everything.
I'm almost about to let you go here, Justin. I just want to ask you one more question, and that's regarding to where you place uranium in this whole commodity or alleged commodity super cycle. Because I assume you place it in terms of potential, at least almost at the top or at the very top. What about in terms of risk? Where do you place in terms of risk so that I can get somewhat of a risk reward picture here?
It's a very risky sector. And that primarily has to do with volatility that's very persistent. It's a difficult sector to hold through, especially if you don't know a whole lot about the sector and understand the nuclear fuel cycle and the long-term contracting cycle. It's very, very difficult because what often happens is, like I just mentioned, that the capital flows dictate the movements in the sector more than anything. you'll have incredibly negative sentiment based on short-term expectations due to positive news flow. So, and this has happened over and over and over since I've watched this sector. It's not like, oh, people came in the last year or two and all of a sudden it's like, oh, the sector just doesn't move and everything's great. No, this is classic. It's classic for all of these elements to stack up that are positive and the stocks just move sideways or down. And then all of a sudden, capital decides to flow and the stocks will double or triple in 6 months. That has happened so many times in the 7 years that I've been following the sector. I can't even tell you. So it's very easy to get shaken out. It's incredibly important to understand the fundamentals to hang on. Most of the analysts that cover some of the companies in the sector, so the Haywoods and the Cantors and the Red Clouds, you know, they show the risk of these positions as very high. And that primarily has to do simply with the volatility and the small size of the sector. So it's important. What I've done over the years that continues to work for me is when people hate me and they hate the sector and they're crying and they're posting really negative stuff on Twitter and really negative stuff on YouTube, that's when I'm accumulating stocks. And maybe when people are doing cartwheels. I haven't really taken a lot of profits in the market so far because I still think we're in the early stages and I don't want to leave anything on the table at this point. But usually when people are euphoric, that's at least a short-term top. But there hasn't been a whole lot of euphoria, a couple moments of that in the past number of years. So it's important to understand that there's always a small risk of a nuclear accident of some kind that at the very least depends on how bad the accident would be and how persistent it would be. But mostly it would depend on the reaction to such an event if it were to happen, right? So because Fukushima itself, you know, resulted in 0 deaths, there was, but the fallout from Fukushima in terms of Japan shutting down their reactors, that was a big change to demand. That's what led to the bear market. It wasn't the accident, really. It was the closing of those reactors and then Germany shutting down the bulk of their fleet, you know, not too long after that. So that's always a risk. And definitely that would hurt the sector in the short term, at least. So that's always on the table. The positive news is that events like Fukushima Daiichi really are wake-up calls for the entire global fleet, especially for the Japanese. And so a lot of the reactor operators and most reactor operators around the world have improved their safety mechanisms and their safety protocols. And we haven't had any real significant accidents since then, more than 10 years. So knock on wood, we're clear for a long time, hopefully forever, honestly, as far as meltdowns go. But that's always a risk. So we always suggest to our subscribers, basically, we suggest to make a rational allocation to the sector. That is obviously an individual choice. What that means for you is different than what it means for me. Make a rational allocation. Don't use leverage. Don't trade on margin. Don't size into positions all at once. We always recommend staging in tranches, because more often than not, the market will give you an opportunity to add at lower cost in the short to midterm. If you're just arriving to this sector and you're thinking, hey, I want a piece of this, do your homework on the sector, do your homework on the companies. Of course, that's obviously something that we do and that we offer, but entering in tranches is always a good idea. So, and whether that's 3 or 4 or 5 or 6 spread out over weeks, if not months, can definitely, because if the market maybe gives you an opportunity where there's some kind of mini crash or a sell-off that was unexpected, you can take advantage of that instead of just being subject to that.
Right.
But yeah, it's very volatile. It shakes people out constantly. And one of the primary things that we do is try to educate people as much as possible on what's going on in the nuclear fuel cycle, and give people the confidence and the conviction to hang on for the long term, because really it's going to be, the big money is going to be made in the sitting, right? Hanging on there through a long-term commodities bull market is really, you can make a killing, and that's what we're here for.
Okay. And you do that at the uraniuminsider.com without the D. We're not going to complicate things. So uraniuminsider.com. Justin, this was a great overview. Thank you so much for investing your time in Ore Day, and the Ore Group thanks you.
It's my pleasure, Antonio.
You probably don't want to hear this any more than you have over the last 2 or so years, but 2023 is actually finally an important year for this thesis. That's because the uranium market is mostly dependent on long-term contracting, right? That's where the majority of the uranium demand comes from. And so in the last few years, nuclear power plant operators have been contracting at a rather slow pace, which is also known as contracting below replacement rate, that is. Matter of fact, they've been contracting at between 30 and 35% off replacement rate, which is very low. And so why I say this year might be an important one for uranium is because long-term contracting has already severely ramped up during the first 2 months of 2023. And so if we keep this pace of long-term contracting as we have, on top of the financial players like, the Sprott Physical Uranium Trust, Yellow Cake out of London, out of England, the Kazakh spot buying arm, ANU, them constantly buying physical uranium and pushing the spot price higher and higher, which is, by the way, spot price is often used as a reference for pricing the long-term contracts. And then if that were to continue, we would be seeing, a lot more contracting, but also at much higher prices, which is or has historically been the thing that really moves the uranium market and therefore also the uranium equities. So as far as I understand it, that is why Justin and others are saying 2023 might be the year that our thesis finally gets tested. And I'm not saying 2023 is the year where uranium explodes, no pun intended, unfortunately, but I'm saying, let's watch this. And if utilities are back contracting at or even above replacement rate by the end of the year, yet nothing has happened, and the price of uranium hasn't moved up significantly to the upside, and they're signing contracts at around the $60 level still, then there might be something wrong with the uranium thesis. And that's when we'll have to review it again and, reevaluate, I guess. Until then, though, the fundamentals stay very promising and, in my opinion, are worth following in my uneducated and inexperienced audience, of course. But I guess that's already too much of me talking, me and your screen. So let's get this face off your screen and get another face on your screen, a better looking one that will be telling you all about QC, copper, and gold. And this is, by the way, the Ore Group's most advanced company in that they have plans to come up with a preliminary economic assessment, PEA, by the end of the year for a metal that is also very crucial to the energy transition. And it's also one that has much more complicated and larger supply chain problems, with that being, copper, of course. Right after Charles's interrogation here, I will also show you my conversation with Lobo Tiggre, who talked to me about where copper is headed and what an economic slowdown might mean for the metal that I guess shares a color with my hair. But first, QC, copper, and gold. All right, Charles, I'm looking forward to talking about QC because it's a very interesting company and you're very excited about it. Why don't you tell me the story about how it all came to be? What got you excited? How did you get Stephen excited about it and stuff like that?
Yeah, certainly, Antonio. I was first exposed to this project back in around 2007 through the vendor who's a guy that he's a geophysicist actually in Quebec City, very well known in Quebec, very famous. He's old now, but he was still pretty strong in 2007, and he's the one who invited me to look at this data. He had acquired this property immediately after Falconbridge basically abandoned the mining rights on the old mines. And in around 2003, 2004, he managed to get his hands on a whole bunch of old mine maps and sections and plans and all kinds of stuff that had been stored at one of the mines in Chibougamau. And he wasn't even aware of that. But when he found out, he just basically he rented a U-Haul and went up to Chibougamau and picked all that stuff up, brought it back down to Quebec City. So I was invited to have a look at this, and so I started looking at these plans and sections and stuff like that. And what was pretty immediately apparent to me was that they although they mined 24 million tons of ore in 4 different mines in the immediate area around Chapet, their cutoff grade was quite high. It was about 1.5% copper, and you could see very clearly on the mine plans that there was quite a bit of material that was left behind outside, on the edge of the stopes. And so my thinking at that time already was that, we could if we compiled this information, maybe we could come up with an interpretation of the mineralization that would be as an open pit, and therefore with a cutoff grade that's maybe 1/10 of the cutoff grade that they have. they had at the time, and so this was the origin of the project, and at that time I'd done some work because I'd made the recommendation to Edwin Gaucher at the time. I'd made the recommendation that we should start thinking about digitizing all of the stopes and stuff, and digitizing the drill holes, which is what he did, and I started the stope digitization at the time. So we built up some 3D wireframes of the stopes, and that was the origin of the source of the material that was used by RPA when they did their studies in 2013, 2014, which did not result in a mineral resource, but they did produce an exploration targets for both Springer and Perry. And I tried to option the property at that time. I wasn't able to for a lot of complicated reasons. I came back to them at least twice between 2007 and 2018, and was not able to do anything. But it's only when really I joined forces with Stephen that we attacked this seriously in terms of negotiation. And we had the corporate structure. We had the QC Copper that was like out of the just right out of the blocks, and so we had a good, had a tight capital structure, and the vendor was quite impressed by that, and that's really what facilitated the deal. The deal was actually negotiated with Edwin Gaucher's son, Pierre Gaucher, and so that was the origin, and so we closed that deal at the end of 2018, and since then we've been working on the project.
So since then you've been exploring. You're now looking to do an MRE on it, mineral resource estimate soon, I believe. When do you think that's going to be?
Okay, so just to summarize the evolution since we acquired the option, the first phase that we was basically desktop work that we did. We went back and took all the 3D data, all the drill hole data that had been done, and what we did is we completed the digitization of all the stopes at Springer and Perry, and the drifts and all that material, and then we basically wireframed around the stopes. We wireframed veins, or what we called veins at the time, and this was before we even started drilling. And then in the spring of 2019. We went out and we drilled 23 holes for a total of 3,500 meters, which was our validation exercise to demonstrate that we could identify surrounding the existing stopes that we could define a mineralization that would be above our nominal cutoff grade, and that was we were successful at doing that. One of the results of that, however, was that we realized that there was quite a bit of mineralization that we had that existed outside our vein envelopes because we didn't have the drill data. But when we started drilling, we realized that the mineralization was more extensive than we thought, and so that's why we added what we call for the 2021 resource, we added what we call the halos, which was a stopgap measure that was meant to be eventually replaced by a more formal interpretation, which is what we did afterwards. So since that resource, which was published in the fall of 2021, which came out at about 103 million tons at about 0.85 equivalent copper, we realized that of that material, there was about 80 million tons that was measured and indicated. It was mainly coming from the historical mine data, and there was about 18 million tons of inferred, which came from the halos, and the halo mineralization was very conservatively interpolated, very tight search radius, about 20 meters. So basically, what we got were tons that were just around the immediate drill holes we drilled, and so we knew that if we could increase the density of drilling, that we would end up with a better distribution of grade outside of the just on the edges of the stopes, and so this is what we're doing now, is that we remove the halos, remove the veins, keep the stopes, and then just reinterpret the mineralization as we have it with 278 drill holes that we've drilled to date, and that includes, since the first MRE, which was 100, we had 101 drill holes. We've added another 177 holes to the project, and now we're at the stage where we're just recompiling all of the historical data, and we're sitting down, like in the next week or so, we're going to sit down and then redefine our mineralized envelopes using both grade and also the geology itself, and a structural model that we just interpreted last summer that allows us to basically better interpret what's going on.
How long is it going to take?
It's a very technical thing, right? It's very technical, but it's a very important point, because first of all of the mine data now is compiled, validated, and we won't have to revisit that at all. That's going to be done. And then for the rest, we're going to be doing our geological interpretation of the mineralized envelopes is going to be done with implicit modeling using Leapfrog. And what that means is that it's going to be very easy for us to update the model. That's the big advantage of using implicit modeling. Otherwise, you have to digitize everything by hand. Very fastidious, but not only that, but it's hardwired, and you can't modify it very easily.
Right.
With implicit modeling, it's just you add a few more holes, just press the button, and it just redefines all the envelopes. Once that's done, then you can convert that to a true wireframe, okay, and bring it into Micromine. And then run your variography and your interpolation algorithms and your domaining and your interpolation algorithm, and that's where we're almost there now. We're just pretty close to that point where we're going to do that.
Okay.
Yeah,
It's going to be in the first half of 2023. You still think you're going to be on time with that?
I certainly hope so. There's a couple of critical, as when you're doing Gantt charts, there's always a critical path, right? And sometimes you have two and sometimes three, but we have two critical paths. And one of the critical paths is the digitization, validation of the deep stopes on Springer, and validation of the stopes on Perry. And that's ongoing. That's part of the critical path. And the other one is finish the compilation of the historical mine data, like the drill holes. So that means collars, deviations, assays, and geology is a big part. And it's very, very long. It's a very long process. I just said 16,000 drill holes. It's huge, right? It's a huge data set.
Are you going to
pardon?
I was thinking if you're going to include silver into that MRE this time, and if whether that's going to make a difference for the workload.
No, not really. No, not really. We have analyzed silver systematically, so we're good. The mine, that's a good question. The mine, they analyze systematically copper and gold, okay, almost always. But then other elements wasn't always, they weren't always analyzing other elements. But they did produce a fair amount of silver that was included in the concentrate. And we're hoping that we're going to be able to get a bit of silver. It's not very high, but because the volumes are going to be so big that there's a good chance that we're going to get a silver credit.
Yeah, I don't expect it to be high either, I guess. I mean, what do I know? But it's probably too early to speculate, right? But if you had to give a guess, I mean, what is your gut telling you? In
terms of the grades that we're seeing, okay, the silver grades that we're seeing, we regularly see grades that are over several tens of grams, okay. And as you know, 30 grams is about an ounce per ton, right? So but generally speaking, the grades that we're seeing in the mineralized, in areas where we have ore grades, to use the term, it's not properly used in this context but yeah, in the economic mineralization that we have, the silver grades are they're typically between 5 and 10 grams per ton.
Right.
Okay,
I was also wondering
means when we get into the concentrate, obviously the silver grade is going to be much higher.
Right. Yeah.
Right? So
I was wondering if we look at the final product, though, if we look at the final in situ rock value, how much of it do you think would be made up of silver? Like, is it 5%? Is it less?
I would say between 5 and 10% of the NSR is going to come from silver. Depends on silver price, right? But yeah, I would say we're going to get probably about 20 to 30% of the NSR is going to come from gold. Okay, and so between gold and silver, we're probably going to get somewhere like maybe a third of the NSR.
Okay. Good point. I was also thinking if you look at these metals, some of those might be starting to turn around in terms of price. You know, we look at the copper price. If there are fears for more rate hikes, and let's say the copper price doesn't work with you, I mean, if the copper price is lower than what it is right now, would you still go out with that MRE, or would you wait for better prices? Have you discussed that internally?
No, we haven't really discussed it, and I'll tell you why. Because our average grade is so high. Our average grade, like in copper equivalent, is over 4 times the cutoff grade. And when you're used to looking at projects and reviewing projects and stuff, the robustness of your project is really ultimately related to the ratio of the average grade versus over the cutoff grade. And in order to be robust, you need to talk about at least 2.5 to 3 times higher. Okay, and so ours is over 4. So basically, what we're looking at here is a deposit that we can bulk out more and lower the average grade, but still maintain a very profitable project with greater tons, less waste, and more metal. Right. So that's kind of what we're aiming for inside our pit. In this new resource, we're aiming for a resource that's going to be bigger, possibly a slightly lower grade, but with overall more metal, more copper and gold than the initial or maiden MRE.
Right, because that's mainly what you've been working on too, right?
Yes.
Improving the strip ratio. Is something that you've been trying to do, improving the dilution as well. Talk to me about that. What is your gut telling you on strip and dilution?
So like I mentioned, the average grade is quite high, and so as a result, when you're putting an optimized pit on the block model, the algorithm will dig basically. It will dig on a yearly basis. Okay, it will add tons on a yearly basis until your NPV stops growing on your deposit. Okay, the net present value stops growing, and when it kind of inverts and starts to go down again because your strip ratio is too high, that's where it stops. And so that in this case, the calculation stopped fairly high, was at about, I think it was about 7.5 to 1, the strip ratio. But that's a function, like I said, of the average grade, which is about 8.85 copper equivalent. It's quite high for this for an open pit. It's with a cutoff grade of about 0.2, perhaps even lower. It could be about as low as 0.15 equivalent copper.
What about dilution? If you have to deal with, say, 20% dilution, that's still feasible?
Well, it's the dilution we're gonna have to see basically, because the envelopes we're putting around the stopes or around the veins, the envelopes, there's no dilution per se in there. Okay. Whereas it's not like an underground mine where you go in, you catch the vein, and there's always going to be a bit of dilution on the edge, and you can have dilution internally because if you have dikes and stuff like that, so you get both external and internal dilution. In our case, the dilution that we're going to get is going to be caused by later dikes and stuff like that. And at this stage, we're not even modeling them because they're not very important in terms volumetrically at the scale of the deposit. Once we move forward towards pre-feasibility and feasibility, we will have to take those into account. But at this point, it's just going to be the envelope and whatever you can interpolate in the envelope minus the stopes, right? Because you have to remove all the samples and remove the volumes of the existing stopes. We have to remove all that from the calculation. We will use the grades in the stopes. Okay, we will use them to interpolate the crown pillar and the internal pillars on the deposit, but we're not going to use but for the everything that's outside the veins is going to be, we're going to remove those values in order to avoid contaminating our interpolation algorithm with this very high grade material in the veins. The veins are there. We cross through them when we drill them. We go through them, and the pillars are quite thick around the old mill. They left very thick pillars around the old mill. So we have all that, and it's going to be part of the starter pit. Part of the starter pit. Starter pit's going to be an important component of the project, because it's significantly higher grade than the average grade.
How long are you going to be running that starter pit for?
Well, the numbers that we got from the 2021 was about 11 million tons at 1.3 equivalent copper. With this new interpretation, we expect that it's going to get a bit bigger at similar grade. So yeah, it's going to be interesting, and that's where we're going to basically, that should be enough to pay back our capital.
Okay. I want to talk about that in a second. Just before we get onto that, though, you're making me think, when you move forward, wouldn't the strip ratio get worse over time as you progress the mine, or how does that work?
Okay, at the beginning, the strip ratio is going to be very low, because there's no overburden, basically, especially over the starter pit. There's no overburden, and so it's all basically on bedrock, and we can see the veins on surface. They're easy to strip. We see in the crown pillars, we see the veins. So that's going to be easy, and the strip ratio is going to be very low in the first years. As time goes on, and the deposit the pit gets deeper and deeper, then the strip ratio increases. Right. You end up towards the end having to basically mine a bunch of waste in order to get the few tons of ore that you can still mine. But obviously, we need to keep in mind that all of this is done on the basis of a project. Okay, once you have a mine and you've paid back your capital, okay, then you have to recalculate the whole thing, because your operating costs are going down. Okay, there's no interest charges and stuff like that. So I like to say jokingly that the deposit you mine is never the deposit you make your production decision on. Okay, yeah. And the reason for that is part economics, part geology, but ultimately it's related to the fact that the deposit is a thing in space. And the mine is how you extract it. It's really the economics of extraction. So that will change with time, change with grade, change with price of metal, and change with all these for different factors. But mostly with the once your capital is paid back, then it changes the economic profile of your mine.
But there seems to be mineralization below the bottom of the pit too, right?
Oh, absolutely. Absolutely, that's a big issue. We stopped the conceptual pit bottomed out because of all the waste that you had to get to mine in order to get that last ton of ore. But that's that will change over with time. It will change. So in other words, the deposit's still there, and there's actually. We're starting to toy with the notion, particularly at Perry. We're starting to toy with the notion that under certain conditions we could go underground on Perry and bulk mine the mineralization with a cutoff grade of say 0.8 equivalent copper, with an average grade that would be somewhere close to 1.5%. And that's consistent with the deep exploration target defined by RPA in 2014, where they had identified a deep target on Perry that was between 3 and 11 million tons at between 1.5 and 2.5% copper equivalent. That's kind of interesting. But right now it's notional right now, because we haven't really studied that very much. But we figured out where that deep target was. It was above the 10th level, and the Perry mine goes down to level 22. So we're talking about 3 to 11 million tons between, say, the bottom of the pit, which would be there about 200 meters depth, and the eighth level, which is about 450 meters depth. So that gives us 11 million tons. So extend that down to level 20. It could be a pretty big, it could be a substantial underground resource that could be mined by bulk mining methods. That's the kind of the dream right now. It's more of a notion than reality. But it's something that we need to attack that as soon as we finish the MRE, as we're going into the because what we'll need to decide essentially immediately after the MRE is that, do we go to a PEA right now, okay, and on the basis of what we have, or do we sense that we should be working on Perry depth in order to get more information on this idea of an underground, possibly an underground operation that could be tagged onto the pit.
I wanted to ask you that. I was a little bit concerned that maybe, because this is all a little bit up in the air, right? We don't know what's going to happen, as you mentioned, and it's maybe too far up in the future as well. But I wanted to ask you about the possibility of going underground and what you're seeing, what gets you excited, what are your worries? Like, what can go wrong if you had to go underground, stuff like that.
Well, I think the main thing is that okay, we're not going back underground to remine the old mine. Okay, that's not in the cards. Really, what we're talking about here underground is more of a situation, let's say, like what's the Goldex in Val d'Or? You know that project? Okay, yep. That's an underground project. It's a gold project. It's in an intrusion, and they've been mining it as a sub-level caving, or like a large volume type of operation. So we would be imagining something like that, whether we can get these big stopes that are like 100 meters across, and that we could go down with a big ramp down from the bottom of the Perry pit. So that's kind of what we're imagining that we could look at. But in order to establish that, what we need to do is we need to analyze the data from the historical mine data from the old mine, particularly the drill hole data from the old mine, to see this material that RPA was talking about at depth on Perry. Is it real? Does it hold together? What kind of can we get? Like I said, the requirement would be a cutoff grade. Can we create in other words, a mining context or geometry that would allow us to get a cutoff grade below 1%, equivalent copper, a cutoff grade, and then an average grade somewhere in close to 1.5%. If we could do that, then that could add significant tonnage and a lot of metal to the project. But we're not there yet.
No, you're not there yet.
Our focus is on the pit. It's on the pit.
Right. It's on the pit.
Okay? That's the focus. So it's the main pit. Plus, we did a bunch of holes this winter on the to the east, on the eastern veins, and we're trying to see with that if we could define some little satellite pits. Well, there's two sets of veins. There's the northern veins and southern veins, and the northern veins, we realized after the drilling that we have to work it more. It's not clear that we can, but on the southern veins, we think that we'll be able to define a little satellite resource on the southern veins, and which would be much lower grade, but it would be kind of a freebie. It's an add-on to the project.
Well, I like free stuff. Tell you what's not free though. A central processing facility is not free. But do you want to have it there? Do you think it makes sense?
Well, I would right now, like the kind of the production profile that we'd probably be looking at would be something like 20,000 tons a day. Mm-hmm. We would very much like to get that up to, say, 30,000 tons a day, but that we can only do that if we have the resource. In other words, we'd have to be able to mine at that sustained rate for at least 10, 12 years to warrant having a larger mill. But having the larger mill gives us the advantage is that it lowers our cutoff grade and makes the deposit bigger. So that's the advantage that we would have by having a larger mill, but it has to be justified by the resource itself.
Okay. So you're
Which
not,
should be clear. Yeah.
but it should be clear by the time you have a PEA.
Yeah, exactly.
Okay.
Yeah.
Okay. So what's next from this point on after the, let's hope that, first half of the year, you have the MRE out. What are your next steps after that?
Well, we still have to do a fair amount of work along the Cook-Robitaille trend. Okay. We're pretty convinced that we can probably do some satellite pits on Cook and Robitaille, and possibly a third area along that trend. So that's it's not huge compared to the Springer Perry. I mean, obviously it's not that big, but it is there. It's nearby. Same geology, same environment. So we're pretty sure we could do something like that. And we need to look at the Perry at depth to see, can we define an underground mineable resource on Perry at depth? If so, then we need to think about what that means, because you don't want to do a PEA if you haven't identified the natural size of your project. Otherwise, you have to redo it, right? See, that's the problem with so the preliminary economic analysis is going to be very useful, because it's really what defines. It's the first time that you define the economics of the project. I mean, you and I, we can both build a spreadsheet, a financial model for any project that we have. But in terms of 43-101, we can't publish that unless we have the within the context of a formal preliminary economic analysis. That's the key.
Right. In the meanwhile, I also assume you're staying in touch with the community, because if you eventually end up, what you're hoping for, to end up making this a mine, you would possibly have to move to town. Or how are you looking at that?
I can speak to that issue very clearly. We've never hidden the fact that our 103 million ton pit encroaches on the town of Chapet. We've never hid that. We've not gone out of our way to show it on a map for obvious reasons, but it's something that is going to be much more apparent when we come out with our new MRE. That we're going to have everything on the table, and but we've shown people in Chapet. I've at least twice a year since we started that I've been making presentations to the community in French, so that everybody could be on the same page, and we've been working also with the Cree First Nations, particularly of Ujie, but also of Waswanipi. We've been working to basically ensure that we have endorsement, or not endorsement, but consent from the First Nations in the area for what we're going to do, because particularly the waste pile is going to be considerable, as you can imagine, right? With a strip ratio of 7-to-1, we're talking about 600 or 700 million tons of waste that's going to be piled up north of town, and it's going to be visible from Ujie-Bougainville. I mean, they're going to see it literally. So there's definitely there's work to be done there, but we've been very transparent about what we're doing, and we've kept the communities apprised of our progress. And until now, I can tell you that at Chapet in particular, it's been very positive. People are looking forward to the project, and they're always curious to and we have an office downtown, right, of Chapet, right on Main Street, and people walk into our office and they talk to us and ask us questions about how things are going and stuff like that. So no, it's very, very positive. Positive. And for the rest, the infrastructure is fantastic. We have railroad coming right up to the door. We have highways 2 directions. We have 750,000 kilovolt line that goes right down through the property. And we have a big substation that feeds the Chapet and Chibougamau region right there. And it's a great and the rail line right now between Chapet and Quevillon was abandoned a few years back, but as part of the Plan Nord, the development project, the Quebec government is seriously considering reopening that line, and which is going to make us is going to make it very easy to move the concentrate from Chapet to Noranda, which is obviously where the concentrate's going to go.
But still, though, when to someone from outside of mining or someone as inexperienced as I am, when you start talking about moving towns, it starts getting sort of interesting. But it also sounds like a very big undertaking, right? And an expensive one. Like, what would that cost? 100 million?
Well,
I don't know. I'm just guessing.
Well, it turns out that the part of the town that we're talking about is the northwestern corner, and it's an area where there's a fair amount of open space because there's two old schools, and the local parish that's included. So there's probably something like 50 houses maybe at the most that are in addition to that. And so we have to move the there's always going to be an implication there for the town later on at least, and but we're going to have to move the highway. We're going to have to, so there's a number of things that are going to have to be done, but really, and I've been stressing this with the population, don't freak out about that. Really think about the implications of having a pit right next door. The noise, the vibration, and the dust. Okay, and we tell them, if you want to know what it's going to look like, go to Malartic. That's the model. Where at Malartic they had to move a neighborhood, that was south of the main street or the highway, and they were able to do it, and I think everybody for the most part were happy. What's important for us is to keep everybody on side, because if there is if we lose the trust of the population of Chapet, it's going to make things much more complicated, and not only that, but it's going to attract attention of opportunists on the outside that would like to make a business model out of preventing us from moving forward.
That keep you up at night, or is this something else that keeps you up at night?
No, not really. No, it's not. Like I said, we're very transparent with the people of Chapet. There's a number of it. There's not just that as an issue. There's the issue of when you look at the footprint that we're likely to have on the mine. It's the town of Chapet, the municipality, is a rectangle that covers just part of the mining complex, not all of it. Okay, and towns live by real estate tax. Right. So a pit doesn't generate an open pit doesn't generate any real estate tax.
True.
You know what I mean? Yeah. So there's a bunch. It's not just about the strip ratio. It's about a lot of other complex things that will need to be negotiated with the town. So and they're quite aware of these issues. They've even spoke to me about it. So yeah, so they're aware of these issues.
So that's a process that you already have started, though.
Yes, informally, obviously. It's until we have a clear handle on the economics of the project. How can you sit down and negotiate benefit agreements since you don't know how much it's worth, right? So in the end, it's the mine that pays for everything.
Yep. True. I mean, if it makes business sense in the end, you probably get it through, right? If you can convince the government and everybody around.
Yeah, exactly. You got it. So, but for that, you need to know what kind of project it's going to be, what's the capex going to be, what's going to be the NPV, how much cash flow you're going to generate annually and stuff like that. So you need all those estimates in order to sit down and negotiate benefit agreements.
So that's basically the Opimiska property that we're talking about here, but you still have the Roger deposit. If I'm not mistaken.
the Roger
Roger, okay.
Yeah, we use a French expression, the French pronunciation. Roger it's primarily a gold deposit. It's about 20. I think the resource has got about 20 million tons, but maybe we could increase that by 5 or 10 million tons, possibly. Okay, it's at about 0.8 grams per ton gold. But it has a copper credit, and particularly in the northern part, and so we're looking at Roger as a potential add-on to the Opimiska project, and not as a standalone. If you look at Roger as a standalone, it's not economic. It's an orphan. It's just like a bunch of other deposits. It's just not big enough to justify a mill. But if there is a mill nearby, it's very possible. So as part of our efforts, we're doing some metallurgical testing on Springer, or on the Opimiska. But we're also doing some metallurgical testing using the same parameters, but on the material from Roger. And if that's favorable, then we can imagine that we could include Roger in the PEA. And so, but we'll have to see. We're going to find out in a couple of weeks. But right now, the preliminary numbers coming out of the lab indicates that the recoveries for copper and gold are excellent. Okay. I'm not going to talk about any specific numbers, but it's certainly it's well in line with what the historical recoveries were for copper and gold for Opimiska. For Roger, I don't know.
You sound very positive, but let me ask you this: what makes you think twice? What is something that you see as a risk out there? Like, not keep you up at night, I guess, but what are you paying attention to as a risk?
Both. Okay, for us, the number one risk issue that we need to manage and properly address is the social acceptance. That's number one. Okay, that's very important. Then afterwards, the other risks are more technical risks. Okay, there's the risk of the resource, which is we're hoping to address now with what we're doing. Okay, and then there's some engineering risks associated with the ore, which appears to be fairly hard. Okay, there's going to be something there that's going to be a risk associated with that. Mind you, with modern processing technologies, we can deal with that. A bit higher capex, but we could deal with that. And the other things are the pit walls. We have stopes that are going to be sticking out of the pit walls. That's a risk that we need to evaluate. And then there's the slope of the pit walls that we need to better understand. And there's the Gwillem fault, a major fault that passes just to the south of the deposit, and maybe eventually will be exposed in the pit walls. That's going to be something we're going to need to study and better understand. So there are some risks. Is it keeping me up at night? No, not really. No, for me, what keeps me up at night right now is the schedule to get the mineral resource estimate. That's we've been pushing like really hard to get that delivered for the mid-year.
Is there something holding you back, or some challenges?
No, it's just the amount of work, just huge amount of work. And it's the best analogy that I could use for this is the mythical man month. Okay, is that when you're dealing with things that are highly technical, okay, and require a high level of skill to do, adding bodies to the problem doesn't solve it. You need to take the time with qualified, a smaller group with qualified people that are experienced and understand what they're doing, and it's the time that it takes to do it. And so by adding, if we double the personnel on this, it's not going to take half the time. You know what I mean?
Okay.
That's what I'm trying to get at. It's a mythical man month, right? It's you have to do it, and so that's where we are.
Well, I'm going to be looking forward to that, Charles. Thank you for this overview. I think I'm all out of questions. Is there something that I'm forgetting to ask you, though?
No, I think on the technical side, we've covered a lot of the bases, and I think the viewers will be able to understand, what this thing is, it's in our view, this thing's economic. The question is not whether it's going to be a mine or not. The question is how big it's going to be, right? That's really what we're focused on, and we need to get a good, solid, robust geological interpretation of this deposit, which was a bit lacking on the original maiden resource. It's not unusual, but we now that we know this thing is going to make you go the whole 9 yards. We need to bite the bullet and get the quality data that we need in order to move the project forward. That's key.
Well, I'm going to get out of your face and let you go and bite the bullet. Thank you so much for this overview.
Thank you very much.
So the story here is not that complicated, I think, but that's not to say that it's without risk. And none of these companies really are without risk. Okay. As others have pointed out so far in this conversation, failure is the expectation in this sector. And if you blindly go into an investment just because you saw it on a video somewhere, the odds would be heavily stacked against you. So yes, it's an interesting story to follow QC. Fair disclaimer, honest confession, by the way, you might not have said this. I own this one. But the Orc Group provides a lot of information on all of their companies' websites, by the way, and provided that doing more research is really crucial, you cannot afford to skip those websites. So I'd recommend you checking those out. Besides the risk on the company, this is also a commodity, right? Copper is a commodity. And like most other commodities, copper is a cyclical commodity. So where are we in this cycle? And what happens to copper prices during an economic slowdown? Do supply chain issues keep the price elevated, or do we see prices fall? Well, I guess you're probably getting it, but we need a bigger brain than this baby face to solve those questions, to answer those questions for us. So let's finally listen to Lobo Tiggre. To talk to me about copper, I have with me Lobo Tiggre, aka the independent speculator, aka the due diligence guy, aka Louis James, aka what else, Lobo? What else should I call you?
Oh, well, how many?
What does your
hours
wife
do you
call
have?
you?
She calls me Lobo or Lobushka.
Okay. But that's presentable. You're here today to talk to me about copper, though. We can also chat about your wife in another podcast if you want to. But what's the broad picture on copper, the 30,000 foot view, whatever, supply demand wise? What can you tell me?
All right. So the main message, and this isn't just the due diligence guy or me, whatever, but you look at all the big reputable firms like Wood Mackenzie, the major engineering firms that deal with the commodity space and so on. And it's pretty much unanimous. The expert consensus is that there will be a long-term structurally driven supply constraints in the copper market for decades to come. And this was already shaping up before the electric car adoption started ramping up and pulling a hockey stick on the charts. And that's really key but let me come back to that. So the big picture, everybody who knows anything about this industry has for years been warning that the discoveries aren't coming fast enough. The mine permitting is taking longer for various and sundry reasons. Supply is increasingly constrained. That doesn't mean that it isn't increasing, but you have global population increasing. And remember, Dr. Copper is called that because it's such an essential industrial metal. It's used in so many different things. It's not just an electric car story. That as the globe grows, the economy grows, the population grows, copper use grows. So it's not enough to be able to even replace what you're mining. You have to more than replace it. And that's not happening. Or not happening fast enough just to keep up with the basics. So this is a fundamental, right? This is an extremely bullish trend. And yes, prices fluctuate, they go up and down. They call it also Dr. Copper because since it's such an essential industrial metal, it's very sensitive to economic conditions. If there's a recession or a downturn, copper prices, at least on the spot market, tend to go down. Not tend to, they do, they go down. And it leads. So it's Dr. Copper because it's the metal with a PhD in economics. It tells you a lot about where the economy is growing. And that's a real thing. And that happens. There's fluctuations. But if you step back and look at the big picture, the issue is one of significant to severe supply constraints for many years, if not decades going forward. And as an investor, as a speculator, that's a fantastic thing to have something that's so well established, something that gives you time to breathe and think and invest and work around, recessions and other shorter term variations is fantastic. Think about that for a minute. If you have a multi-decade trend that you have high confidence in, but there's volatility along the way, well, each time there is a recession or some scare that puts copper prices down again, then that's a buying opportunity. It's one thing to say, oh, I'm going to buy the dip. Well, why? Well, because it's a dip. You don't really know why. It's just like, oh, that's what they say on TV. Oh, buy the dip. Or that's what my brother's doing. Or that's what the Bitcoin hodlers are doing, whatever. In this case, you have a strongly evidenced thesis for a very long-term outlook, which justifies taking action when you get these near-term dips. So, and then that's the fundamental. And then on top of that, we have this whole electric car thing. And that just, that's when you take your significant to severe shortages. And the good news there from the metals perspective, whether the world should be adopting electric cars the way it is or not, the politics are a completely different issue. I'm not taking sides on that. Personally, as a free marketeer, I wish the governments would get out of it. There would be no incentives whatsoever on this and let the better car win. That's not the world we live in. It is happening, and the incentives are major, and they are creating additional demand on top of this fundamental situation that I'm talking about. So before I go on too long, so what about this is that this additional demand is very sensitive to economic fluctuations. Cars in general, when there's a recession, car sales drop. Oddly enough, in 2008, the last big fluctuation, not the flash crash of 2020, luxury cars actually held up better than regular cars. Because I guess the people who have lots of money, if they need a car, they're going to buy a car and they don't care if it's a recession. Whereas people with not so much money, they're not going to buy the car because they don't have it. But the sales were still whacked for luxury, regular cars. Doesn't matter. In a recession, you're going to see an impact on sales. And that affects this extra, tailwind for copper story based on the electric cars. And I'm of the opinion that we're looking at a global economic recession. I think it's primarily actually an eventual consequence of everything from the GFC done forward. But I think it was really brought on in its current round by the COVID lockdowns, which are, the knock-on effects of that are not done yet. And then on top of that, now we have the war and the new Iron Curtain, which is an additional blow. So hear what I'm saying. The fundamentals, and it's not just me saying this, the big firms that have the biggest research departments, the companies themselves, but of course they're talking their books, but basically everybody in the industry understands and validates this big long-term bull thesis. On top of that, you have this variable tailwind of the electric cars, which will come and go with economic boom and bust cycles and perhaps subsidies as well. But it is extra. It's not the fundamental. It's on top of this other fundamental thing. So it may sound like bad news for me to say that I see global recession hurting copper prices in the near term, but that is the case. But if you have the longer term outlook, that's actually good news, especially for anybody that isn't long copper already, that they don't have any copper exposure in their portfolio. For them, nothing could be better than a fire sale. The wonderful thing about markets, Antonio, is that they're not efficient. They're famously irrational. And things get overbought and things get oversold. It's entirely possible that this summer we will see copper ridiculously oversold, perhaps down to the cost of production or less. It's happened before. And that would be a fantastic buying opportunity. So where do you want to go from there, my friend?
I want you to argue with Dr. Copper, because when I look at the chart of copper starting last summer, dipped at 320 and then it went back up to 420. And you said it's Dr. Copper, so it's predicting what the economy is going to do. It's going up. Wouldn't that mean that recession is canceled? We're not going to have turbulent times. So it's base metals as times.
Yeah, it's an excellent question. And I think the reason for that is, again, I just mentioned how markets get overbought, oversold, they're irrational. I think we had a little bit of premature irrational exuberance about China's reopening. I mean, this is a major countervailing factor to the recession, and I've written about it a fair amount. Like, I see this as a big tug of war between these two factors. I get it. I get, China is the #1 consumer of copper in the world and many other things. So this really is huge and important. What my objection or my resistance is to the people on one side or the other who say, oh, the China reopening, that's going to drive, oil, copper, all these prices are going to go through the roof. China reopening is the big variable. And there's other people saying, wait a minute, all the leading economic indicators, everything except for the US labor market is flashing recession. So, who the Chinese going to sell their stuff to? And people talk about these things like they know what's going to happen. And the reality is nobody knows what's going to happen. I don't know what's going to happen. Rick Rule doesn't know what's going to happen. Certainly not the powers that be. They don't know what's going to happen. Nobody knows what's going to happen. And we'll just have to see. We'll have to watch the data. Be data dependent, but in a good way. Not in the we can do whatever we feel like and change our minds at a drop of a hat way that the Fed means it, but in the sense of instead of being arrogant enough to think for sure what will happen. Since we have these two competing forces, let's watch them. Let's see which way the tug of war seems to be going. When it starts moving in one direction or another, there will be time to invest. So, copper did have what you would think Dr. Copper was getting it wrong. Dr. Copper was ignoring the recession. But I think Dr. Copper got a little distracted by this glitzy nurse dressed up in a Chinese reopening outfit. And we'll just have to see what proves to be more important. If the Chinese reopening actually does save the global economy from recession, and there's been some precedent for this. There's been cases where booming demand from China has rescued the global economy before. I think the globe's problems are much more serious and intractable. And I don't think China's in the place that it was before. I mean, China will be lucky to have low single digits growth, I think, this year. Whereas before you could, back then China was growing 10%. And China had a much greater capacity to drag the world forward that I just don't think is on the table today. So I'm not trying to be all doom and gloom here, but even Dr. Copper can make a mistake sometimes. Markets are not perfect.
Is his verdict, I guess, on the economy, though, influenced by the supply chain issues that we're having in South America, as well as the inventory being at how many ever years low? And also explain to me what that means, by the way, if you will, because they always say we only have 2 days of copper inventory or whatever it is. So
time out. Those are very separate issues. So let's take them one at a time and remind me if I forget the second one. I do think that the trouble in Latin America is serious. Any one of these things, you'll see, this mine's been shut down because of a road blockade, or that one's been shut down because of threats to the personnel, or this one's been shut down because of X, Y, or Z. And it only seems to last for a few days or weeks, and then it goes back into production. So any one of those you can ignore, but it's constant. Think of it this way. If you listened for a single piston in your car, in your gas burning car firing, you wouldn't hear it. You hear the purr of the motor. The pistons are firing so constantly that it's a steady noise. So if you have mine shutdowns happening so constantly that it's a steady noise, basically your production rate, whatever it should be, the nameplate capacity of these mines, whatever the output should be, it's going to be less by whatever the average of that noise is. And particularly in Peru, but not only in Peru, up and down Latin America, I think there has been a significant social shift. And I'm going to say this carefully because I'm not insensitive to the plight of poor people, and I'm not, being a fairly dark-skinned person myself, I'm certainly not trying to say it has anything to do with the race of the people, but you have these indigenous and local communities that have been given such a moral high ground that they essentially have veto power over projects, exploration and development, mine building projects. And even after the mine's been permitted and built and gone through all the hoops, they can stop them in their tracks. And at some point you have to ask, what is reasonable? How many hundreds of miles around do you need to consult with before you get a permit to build a mine? And what rights do the rest of the people in the country have to the benefits of this economic activity, as opposed to the local villagers and their very localized rights there? It's complicated. I don't pretend to have all the answers to this. What I am saying, though, is that this is, such a constant threat now, and it's all up and down throughout Latin America. There's a strong populist sense here that has given a very powerful veto force in the mining space. And I think two things. One is, from the macro picture, I think we need to expect lower output than nameplate capacity, basically forever, for practical purposes. For the investable future, that's not getting better. Once you let that kind of genie out of the bottle, it doesn't go back. Once you give people that moral high ground, you can't just turn around and say, oh, never mind, we don't care about your rights anymore. I mean, that's just not going to happen. It's an aspect of ESG, if you will. You can see this as part of the social instead of the environment, the S part. There is an S tax that is very high on Latin American mining. And it's not just copper, but, Chile and Peru are two of the world's biggest copper producers. This is very significant. And prices are determined at the margin. So even if this noise level reduces the output only, 2-3%, say, 2-3% is very significant to the balance of the global copper market. And it could be a lot more than that. And, if something flares up, as it has with the politics in Peru recently, it can be a lot. I mean, there are mines in Peru that single mine is responsible for 2% of the global copper supply. Mm-hmm. So you get a couple of those out at once. That's a big hit. Now, like I say, these things tend to get worked out. The mines tend to come back online before too long. But if it's constant, you're looking at an overall average of lower output than projected or expected. And I don't think this has been priced into any of these economic models yet. Like you look at supply and demand models, and they include not only current mines at their supposed operating capacity, they include development projects and future projects at their study, what's in the feasibility study. And many of those aren't going to come online, or if they do, they're not going to be as efficient, or they may have to leave part of the deposit in the ground because it's too close to a town or to a sacred tree or whatever it is. And again, I'm not trying to dismiss the sacred tree. I'm just saying this has consequences. Right? The more you tighten this S as well as the E screws, and the G I think of as in taxes, so all three of the letters, the more you tighten these screws, the more it impacts output. And it's not just Latin America, but I think the trend in Latin America has particular relevance. It's basically new. Like, it's already difficult to permit a mine near tribal lands in the US or something like that, but that's been that way for a long time. Whereas locals getting a much more powerful say in the process in Latin America is new, and it's changing supply. This hasn't happened yet in Africa, but you have different risks there, and it probably won't be long before it does start happening. This is a global trend, and it is bearish for supply, which is bullish for price. I forgot the second question.
It was about the inventory, which I suppose is suffering because of what's happening, or not. I don't know. You tell me.
Right. Well, so I don't want to just dismiss inventory. I mean, clearly, if you have some record low inventory and then something happens at that point, that can have a dramatic impact. And we saw this recently with nickel, when suddenly there was a nickel squeeze on, and it broke the LME. I mean, they even, not only did they have to suspend trading, they went back and they undid, right, millions and millions of dollars in trades. Mm-hmm. So, so I'm not trying to dismiss the thing, but I got to tell you that, I've been in this business almost 20 years, and I won't say every year, but periodically, there's somebody like, oh my gosh, look, the LME stocks of this, XYZ metal are at multi-year lows. That means price is going to go up. And it's basically seen zero correlation. A squeeze, a flash in the pan is a very different thing from predicting within a reasonable time frame price movements based on stocks. And the thing to remember is these stocks turn over. Like the gold is the only thing where you mine it and almost all of it just sits there. As Warren Buffett famously says, he spent all his money digging it out of one hole in the ground, processing it just to stick it back in another hole in the ground. That's a little facile. It's much more useful in the refined form than it is in the ore that almost nobody can do anything with. But the point is that it's still there. So the amount of gold theoretically that's sitting there matters because that's what it does. It sits there. And if suddenly it's not there, then that would mean something. Whereas copper's used. It goes in one warehouse, it goes out the other side as wires and plates and pipes and all kinds of things. It gets used. So, a mine disruption can impact the balance of that, and the stocks can go down, and then they go right back up again. We don't need to beat that to death. My warning or my takeaway from this would be is just don't get too excited about the stocks. If they get critically low, then that's maybe a risk traders you could take a punt on. Like I'm a speculator, but I'm a value speculator, and I don't trade in and out of positions. I buy something because I think it's going to do X, Y, or Z, and I hold it until it does X, Y, or Z, or it fails, and then I'm out. But if I was a trader looking in and out, and I saw like record low copper inventory or whatever the metal was, and I had reason to think that might get squozen, then that could be fun, short-term trade or something. That's not my business. It's really tricky and very, very high risk. So it's not something I recommend to anybody. Experts only, and even then, they understand that they're gambling.
What about shadow pounds? That's something that you see written every time. I don't even know what that is.
Right, and that's relevant because you look at stocks in the LME or Shanghai, and these are two sources. There's a lot that doesn't ever even go through those sources. There's a lot of off-market pounds out there. I haven't looked at the numbers specifically for copper recently, but I did look at for nickel, and it's huge. Like if you look at what gets mined, that's not LME. It's not even the right nickel form, the more pure nickel that goes into the LME. You got the nickel pig iron that they mine up in Indonesia or the Philippines or whatever. That never even goes near the LME. And it's huge. It's a large part of what goes into China and never gets tracked anywhere. There's no measure of that. You can go and you can aggregate company reports or something, but the stock at any given moment, that's not a statistic that I'm aware of available to the markets anywhere. So yet another reason to not get too bent out of shape about what's on the LME or even LME plus Shanghai. That's not the entire market. And that certainly applies to copper. I cannot tell you how much bigger the shadow copper is than the regular, but given where so much of it comes from and where it goes directly to consumer, I would expect it to be substantial. And by the way, that's the other thing about this is, high prices cure high prices, low prices cure low prices. If there's a run and the LME warehouses were to get emptied of their stocks, that would impact price. But it's not like you'd have to say, oh, well, there's no copper anywhere. Well, no, that price would bring other copper into the market. So
shadow pounds copper that people just want to make a higher profit on. Is that it?
Assuming it's not plywood spray painted with copper paint, yes.
Okay. What is, by the way, high price for copper that would cure in terms of bring on additional copper supply? Like what is the production cost? I guess?
Yes. No, I understand. It used to be that $3 was a great price for copper. I don't think so anymore. After all the inflation we've seen, and by the way, dear audience, you look at the official CPI figures from various countries. We're plus or minus 5 to 10 in various countries. And then you could even apply shadow stats and say it's twice as high, right? Whatever the US CPI is, the real number is twice as high. Even that is nothing compared to the inflation that mining companies are seeing. When from the iron needed for structural framing for plant buildings and the iron that goes into ball mills to copper and the vehicles and so on. The numbers I'm seeing, and I'm not just talking overall project capex blowouts, but like input costs, I'm looking at 25, 35 or more year-on-year price increases for raw inputs to mine construction and mining operations. Major inflation there, much larger than the inflation figures we're seeing around. So the point was, you can't just say, okay, it used to be $3 and now we're going to adjust for 6.5% inflation in the United States and say it's $3.20, right? That doesn't work. The input costs for the mining and the mine construction are so much higher that I would say that $4.50 is the new $3. And going forwards, that's going to continue. I think if we want to really see significant, like copper prices around 4 plus or minus 4 plus, that'll keep things going as they are. But if we want to see new projects, big projects, especially if we want to see some of these large, low-grade deposits that are known, they're out there, the land banks, those can help cure supply, but not at these prices. It will take a higher copper price to make those economic. And I think you're looking at, a today equivalent of $6. If you can see, 5 would help. But I think if you could have $6 and then adjust that for inflation going forward, something equivalent to $6 today going forward would help solve the copper supply problem. But can we stay at that level? We'll see. Remember, you have to adjust it for inflation going forward. $6 in 2030. We'll see what the profit that governments do to the money supply. But $6 in 2030 could be 10, 12. I don't know. We'll see.
Exactly, because just how you wrote in one of your recent pieces, which was when will inflation matter to gold? When will inflation matter to copper? Well, I guess right now, it already is mattering to copper because you see that in the margins of the producers as well, right?
Yes, and there's an important clarification here in that when I wrote that, when will inflation matter to gold? Gold is a monetary metal. And it does trade, it's driven by dollar real rates. It responds as a financial asset. And if it's an inflation hedge, people are scratching their heads. We've had all this high inflation the last year or two, and gold's kind of gone sideways. What's wrong with it? It looks broken. We won't talk about gold, but copper is different. It's an industrial metal. And as commodities go up as part of the inflation picture, then that does matter to copper. So there's two questions. One is sort of on the input side. Does inflation of mining costs and of mine construction costs, does that matter? Yes, it does. But remember, it takes two to tango. So if the miners say, well, look, copper price is not high enough for me to spend the money building this mine. So I can't build the mine at this price. That does not instantly make the price of copper go up. The company has to not build the mine. Other miners have to not build their mines or put mines on care and maintenance because they can't make money. And then the supply has to really get squeezing. And then that will push the prices up. So there's a pretty significant lag between high input costs trickling through the process to produce higher metals prices. On the other hand, on sort of the financial side, if you've got governments printing money, easing financial conditions, increasing liquidity in the system, money goes into the system, there's more, that drives up prices of everything, including commodities, including copper. So you could have copper prices go higher, even if supply is increasing, if inflation itself is increasing faster than the supply is increasing. If you see what I'm saying, if the liquidity is increasing faster than even a rising amount of supply is increasing, you could still see copper prices go up because there's just that much more money chasing after that copper and coffee and everything else. So what I'm saying is part of the argument is just inflation in general inflates prices, including commodities, and copper is a commodity. And the other part of it is, beware of assuming that just because it's more expensive to mine, that's going to drive copper prices up. I mean, famously back in the late 90s, when the copper price was down to around 70 cents and the average cost of mining was closer to 90 cents or $1, that lasted for years, Antonio. People would think, how can it happen? Not only did it happen, it lasted far longer than anybody imagined it could. So, how can that happen? Well, there are above ground stocks, and also it's expensive for a company to shut down its mine and put it on care and maintenance. You might take a loss for a while just to keep the mine going rather than take that hit, or you might actually increase your production because you can get economies of scale. If you're just barely making money, you say, oh, well, if I double my output, I can reduce my costs and maybe I can still make money. So ironically, marginally lower copper prices could conceivably increase copper supply. So I'm just saying that whole thing is quite complicated. The answer to the question, when will inflation matter to copper prices, is actually, I wouldn't really look at inflation. I would look more at the economy, Dr. Copper. I would look at the recession. And in terms of our investment decisions right now, if I'm looking at like, okay, I've got my short list of copper stocks I like, when am I going to buy these stocks? For me, the answer is not today, not this month probably. I want to see if I'm right about the deepening global recession. I want to see what that does to copper prices this year. So this isn't a someday, kind of thing. I'm just saying, like, right now, there is good reason to be cautious. And I'm sorry about your sponsors here, Antonio, but there's good reason to be cautious about buying any industrial metals plays right now at all. Let's see how this recession does. And then either I'm right and we get a fantastic buying opportunity ahead of this big mega trend in copper that I've talked about, or I'm wrong, soft landing, no landing, everything's fine. The Fed kisses the boo-boo and it all goes away. And copper starts going up again. It's not going to double overnight. You won't miss the boat or the train or the plane if you don't rush out and buy copper right now. I think the prudent thing to do is to wait to see how Dr. Copper responds to this recession and then speculate accordingly.
I appreciate your honest opinion on the matter. I'm thinking one step forward as well, though, come time to buy copper stocks. It sounds to me like the producers might end up being in a tough situation, especially with the protests, global supply chain issues, and inflation, thinning their margins. But then explorers and developers, they have the thing that we're actually going to need. So they're going to be in higher demand. Does that make any sense? What are you focusing more on?
Yeah. Well, the way I think of it, there's a sort of conventional wisdom in the sector that when the market heats up, copper market heats up, people want copper, that the money will go to the big producers first, and then will trickle down to mid-tiers and then trickle down to juniors and so on. And that does happen. At least the go-to part, I think, is real. If especially for somebody who's not a seasoned resource speculator or has never invested in copper before, but they hear people are trying to melt down pennies, which aren't really made of copper anymore, but they're mostly zinc. The people hear about that, people get all excited. Where are they going to go? They're going to look copper, and what are they going to do? They're going to find the big boys, and that does happen. That's a real thing. But this trickle down thing, I don't think it happens. I don't think it necessarily happens at all. If it does happen, it tends to happen through M&A, and that takes time. But the thing about the juniors, I think there's a sort of leapfrog effect here for the juniors. The smaller companies, maybe it'll be 10 years before they can even bring their mine on production, assuming they even have a discovery already that looks economic. The permitting takes so long. You could say, well, what's the point of buying this junior? 10 years from now, who knows what will happen to copper? Maybe other supplies will come along. Why would I buy this junior that is, years and years and years away from making any money from this deposit? Well, in the first place, if you look at your Freeport-McMorans and your Rio Tintos or bigger producers, these are such large companies that they have very little hockey stick potential. They may go up in response to metals prices, but you're not going to get a 10-bagger out of one of these big companies. Whereas a little, a tiny exploration company that's less than 100 million market cap, it's not so difficult for one of these that has a real copper discovery or any other metal of significance that has a chance of becoming a mine. It's actually, I don't want to say it happens all the time, But every year you hear about stocks like that do become 10-baggers. Like the mythical 10-bagger is not a myth in the mining space. This is a reason for going down the food chain to the junior stocks, is they have this incredible hockey stick potential. Plus, if you're exploring still, you are actually increasing the value. If you've got 500 million pounds of copper in the ground and it's still wide open, you're still drilling, you make it bigger, and now you have 1 billion pounds of copper in the ground after another year of drilling. That's huge. You've added a lot of value. And not only that, it might take 10 years to permit and build a mine, but if you're a junior, you're probably not going to be building the mine anyway. It's possible to build a pretty rich gold mine because they tend to be smaller, but a significant copper mine is usually a multi-billion-dollar project, and the juniors almost never build those. They get taken over, and that can happen anytime. If you have a junior that makes a compelling discovery long before it's even permitted or even, shovels hit dirt, any of that, they often get taken over. The majors can see, they know what a good copper deposit is like. They know what they're looking for. And they're even willing to accept political risk. I've seen big takeovers in Africa, in Latin America, in Peru, we were just talking about. You get somebody who makes a big discovery, a good grade, good geometry, the metallurgy starts looking good. I mean, those basically never get built by the junior. The only thing even close would be Ivanhoe in the DRC, but that's a Friedland story and it's unique. And most juniors just can't raise that kind of money or build a mine like that. So you're looking at a takeover, and the takeover may not be your 10-bagger when the mine gets built at the end, but the beauty of a takeover is it gives you an overnight win. If you get in before the takeover, the premium to get shareholders to go along with the takeover bid is usually at least 30%, 30, 40%. It's often 50%. And for a really high quality project, it can be as much as 100%. You can literally see a stock double in a week or so when a bid comes in. And then if there's a bidding war, if it's a great project. So why would I step down from the big famous names, the more stable mining companies? Well, it would be for greater capital gains. The juniors, as crappy as most of them are, they can have incredible capital gains for shareholders who get into one that has, the real stuff, the right stuff in the ground.
Yeah, it makes a lot of sense. Thank you so much for investing your time in me and Orde and the Ore Group. Thanks you as well.
Okay. Well, thank you and good luck.
Now, QC Copper and Gold might be the most advanced copper company that the Ore Group has to offer, but it's definitely not the only one. American Eagle Gold Corp, despite having gold in its name, is actually a very early stage exploration company primarily focused on finding copper at their NAC property, which is in British Columbia. They recently drilled their first 7 deep holes, and their stock even went up 600% in a single day when they announced the assays from their first hole, after which it's given back some of those gains, obviously, despite them continually announcing more drill assays. So that begs a few questions, and we're going to hear from their CEO and figure out what his plans are to add more value to the story. All right, Anthony, let's kick it off with the usual question, which is basically 5 questions in disguise, but who, what, where, when, and why American Eagle?
Okay, let's go. Who? We're our company's called American Eagle Gold. We're trading on the TSX venture. That's the who. The what? We're a junior exploration company. The where? We are exploring in BC, interior BC. I believe there's 3 jurisdictions to really safely explore in the world. Australia, United States, and Canada. Canada is the best, and we are in copper country. The why? Look, the whole point of business is, to make some money, create shareholder value. I believe we have a great property, and our goal is to create a liquidity event whereby we position our company to discover a big deposit and then sell it off to a bigger company to create shareholder value so people can leave the investment. So That's really the why, creating shareholder value. We want to be different than all the other majors out there. We're not looking for lithium. We're really kind of building long-term sustainable value. And that's why we have great people in a great jurisdiction and putting most of the money that we have raised into the ground.
There's also the when question. And what I mean by that is, when did you get started? Because that was recently, right? It's not too long ago.
Yeah, sorry, it's hard to answer questions. You got 5 in your head you're trying to drum off. But when we went public in May 2021, We switched gears to BC away from Nevada 7 months after that in December of 2021. And we started drilling, within 6 months and got our permits, which is pretty impressive. So we started drilling in August 2022. We ended drilling towards the end of December of last year. And we're just waiting for our final permits. They should be ready any day.
Right. And
then
you sort of...
if you want to talk, sorry for interrupting. If you want to talk about the future, we're going to be drilling very shortly, starting probably in late spring, early summer, and we'll be drilling throughout the summer. So that's a little future-wise, a little bonus.
That's nice, because we're definitely going to be talking about that. So it's good that you're setting it up. This summer, though, you sort of shocked the market. I know it was not the summer anymore, but it was late last year. But you were releasing some drill results of your first hole, actually, and your stock went up 600% on a day. After which you kept releasing holes. I believe you're waiting for hole 5 right now.
5, 6, and 7.
Yeah, right. But the excitement is no longer as strong as it was on that first day. What do you think the markets wants to see here to get that excitement back?
Well, the market's unrealistic. They're greedy. And obviously, they're looking for 6 times gains for investments they make. That's why you see, crappy gold companies with, assets that aren't going to yield anything going into lithium, because, that's kind of what's hot right now. But like I said in the beginning, we're looking for sustainable value, and it's kind of a blessing and a curse. We didn't really even have a heartbeat. We were in Nevada, we failed, and no one gave us any value, any credit to even get our permits, and thought we were going to fail in BC. And we essentially got a shot of adrenaline from being in a coma. So our stock was extremely undervalued. I believe we're about 2 million market cap. So yeah, we went up 600% overnight. We had a great drill hole, Antonio. I think it was 126 meters of 1.05% copper equivalent. If you looked at gold, that was over a gram per ton from surface. And it was absolutely amazing. And all of a sudden people were like, well, this is for real. And, we shot up because people wanted to give us more value because we were worth a lot more. But unfortunately, we start off with a really good drill hole. Everyone thinks you're going to surpass it afterwards. But what was funny, our second drill hole, looking at it from a mine perspective, we thought it was as good as our first. Mines aren't made on 100-meter holes. They're made on at least 300 meters. And that first hole is 300 meters of 0.57% copper equivalent if you spread it out. Our second hole, the reason why we didn't, go public, we didn't raise money after our first hole, is because we really did think, we still believe that second hole was almost better. So if you look at the second hole, it didn't have that eye-popping 1% grade, although from the surface it had 37 meters of over 1%. Over 300 meters, it had 0.61% copper equivalent. So from top to bottom over that 300 meters, it was very consistent, 0.6 all the way through. And that's what mines are made of. And it showed that we weren't a one-hole wonder. But again, I think people were greedy and they were looking for another, plus 1% hole, which we didn't have. So obviously, it's tough, this business, Antonio. You can make a mistake not on the geology part, but sometimes on the news release. So what we liked was we actually shared our news release, and it showed over 900 meters of 0.37% copper equivalent, which is great. That's what the big base metal companies are looking for. They're not necessarily just looking for grade. They're looking for scale. But investors, when they look at your news release, there's 10,000 different companies out there. They look at the first 2 inches, look at your title and maybe the first line of your news release. And what they saw there is 0.37. They don't bother to jump into it. And 80% of the money made right now in the TSX Venture is on the short side. So you combine that with investors that got into the investment without even knowing, they got in with the momentum. And then they see the 0.37. They're a little bit confused. And all of a sudden the short sellers come in there and start selling. It creates contagion. That's why the stock went down. So just kind of explaining the second hole. The fourth hole we have, Antonio, complete game changer. We kind of had an idea where we're drilling with the first drill hole. It's a South Copper zone. We didn't twin it. Some people say we did, but we drilled 100 meters away from the historical best hole in this whole area with hole 1. So that's quite a bit of a step out. But we did have an idea that there'd be some gold and copper mineralization there. With hole 4, we didn't really know we'd have any mineralization. So we drilled through about 150 meters of 0.5% copper equivalent, which is still great. And then we actually hit 0.75% of almost 200 meters, starting at 363 meters. And why that's game changing is historically on this property, the last time they drilled this, in a big campaign. It was 1996, 97. You couldn't access this land, by road. You had to fly there. They didn't have the equipment to really drill deep, and obviously copper 6 cents a pound. So looking for something high grade at surface. And what we drilled through was something they called historically shutdown rock. So after about 150 meters, there's marginal grade. Let's call it 0.2. So historically on the property, the drillers, the companies, they just shut down. But we had a plan. We stuck by it, to our credit, to our geo's credit, and we drilled to 700 meters. And we actually hit really high grade copper and gold that has never been hit at this shallow of a depth, 363 meters. So 0.75% of 180 meters. And it shows that there's a lot more to this property than just the South Copper Zone. And what we're trying to do right now in terms of our program, it's kind of a hit them high, hit them low program. So we're going to scope out the stuff we have at surface in the South Copper Gold Zone, but also suss out that mid-level copper that we just hit with hole 4. And between that surface stuff in the South Copper Zone and that mid-level stuff where hole 4 is, we're hoping that we can actually connect the dots and lead us to that really high-grade stuff that we think is at depth between 700 and 900 meters. Because trust me, Antonio, the copper and gold doesn't come from the sky. It doesn't come from the rain. It comes from down beneath. And that's tricky trying to find it, but use geometry and geology to try and track where it's coming. And there's a big source of copper coming from somewhere, and we're trying to find it. And when we find that, that's a giant jewel box. I'm just telling investors right now, when we find it, watch out.
That fourth hole, though, when I looked at it on the map, it seemed much shorter than the other ones. And then I read that it was terminated to what you call technical difficulties. What does that mean? Is there going to be a risk based on some of the rocks? Was it something to do with the drill? What happened exactly there?
We hit a clay alteration that we hadn't hit with the 3 previous holes, and the drillers there, they just didn't have the proper equipment to get through it. So we had to stop. There's a certain drilling cost, but the drilling cost really, you backwards in what it costs per day. It's about $20,000 per day. So if you stay idle, it costs you a little bit more than that. So to get that proper equipment there would have taken about 5 days, which would have cost us $100,000. So what we decided was, after a day, let's move on. Let's drill according to our plan, not waste 5 days. And if we have time, we'll go back to that area and drill. And that's what we did with hole 7. So we got actually the proper equipment. We brought to site, which didn't take that long. So hole 7, we actually drilled through the same clay alteration, and we got right through it. And what we did on the 7th hole, we drilled from the 4th hole drill collar, but we drilled on an 81-degree inclination, so we can actually have a good idea of what hole 4 would look like a little deeper than where we got, but also start to kind of discover how the mineralization is at depth towards underneath hole 3 and 2, which we didn't quite get to, but that was the whole plan.
And then hole 3 was sort of I assume you don't like talking too much about it because it was not your favorite hole, but aren't hole 6 and 7 expected to be more like hole 3 in terms of composition, I guess? I don't even know how to ask this question, but what can you tell me about that?
Well, hole 3 I did not like. It's just with the market, it's tough because what they see there is a 0.21% copper equivalent. But hole 3 was drilled right between, there's something called the North Copper Zone and the South Copper Gold Zone. So that was drilled right in the fault, right between there. So it wasn't really expected to have that much mineralization anyway. But if you're looking at a mine, you're really looking at scale. And if your worst hole is 0.21% copper equivalent, that's still pretty darn good. It certainly wasn't a duster. And if this becomes a mine someday, which I hope it does, these companies are looking for scale, and that's certainly mineable. If you look at Highland Valley Gold, I think they're mining 0.15% copper equivalent. So it actually was a pretty darn good hole for a quote unquote non-successful hole. Hole 6 was a step out to the east, about 180 meters. So what we want to do is actually drill, so give us a third point to understand, what the orientation is, of the system. So we actually drilled underneath hole 3 and 4 to try and give us an idea of what it looks like underneath. And what we wanted to do was connect the bottom of hole 2 and the bottom of hole 4 to see if there's continuation of the higher grade underneath. And then hole 7 is the same thing. We kind of want to understand what it looked like, on an angle between holes 4 and 2. So it's just giving us kind of a good idea of what the mineralization looks like. It's challenging because what we did here, we got our permits very fast. We got, I got the property, I think mid-December 2022. The first thing I did was I tried to contact the local community, the Lake Babine Nation. So I contacted them. I told them, if you don't want us to be here, we don't want to be here. And they said, we want you to be here. So we got our permits really fast. We started off on the right foot. So we got our permits within 6 months. But in order to get our permits, we were very limited in terms of where we could drill. So we can only drill within, current cut blocks that were there for previous drilling. We had to drill along a line. So we drilled all vertically, all along the line with very little step outs. And as you know, these ore bodies don't really exist along the line. Mother Nature just doesn't see. We're going to just create a straight north to south ore body. Sometimes they're like a crescent. Sometimes they go in different directions. And what I'm trying to say is, we could have been drilling just on the peripheries here and not really been drilling into the belly of the beast. So to be able to hit some of the grades that we hit is absolutely amazing. So that's why we're so excited what's going to happen with our future drill program.
The future drill program is something I definitely want to talk about, but It's also been a month since that hole 4 was reported. When do you think hole 5 is coming in?
Hole 5 should happen any day now. So, the rule of thumb is it's about a month per assay. If you look at Eskay Creek, I think was done their drilling 35,000 meter program. I may be wrong on the math, in July. And we came out with our first drill result in November before they had come out with theirs. So, it's in the real time, it seems like it's taking a long time because we're releasing hole by hole by hole. But I'll give credit to the labs they're working with, ALS. They actually are getting the results out very quickly. And we've been pushing the labs, and it takes about a month per hole. So it takes about 3 weeks to drill a hole and about 3 to 4 weeks to get those assays back. We've pushed the labs to get all the holes out together ASAP. So trust me, I hear from investors all the time about these holes, and I'm not sitting on them. I want to get them out as soon as possible. So usually once we get the assays out, and they should be out any day, it takes about 3 days to put together a release, film a video about it, and get them out to the public. So I am hoping that they're going to be out before PDAC. So that gives us before March 4th to get those holes out.
Okay, that's a good indication. I like the specifics in there. But yeah, talk to me about that next drill program. What's next after these 7 holes, and how much of it is there?
Yeah, look, our drill program is really, we don't want to blow up our cap structure. Obviously, our stock's been trading down a little bit. So our drill program is kind of a combination of, what we see in the assays. It's hard to really build a drill program with just geophysics. We did it last year because it was kind of an exploratory drill program. This one's going to be a little bit more robust based on assays, putting everything into the leapfrog model and figuring out where exactly you're going to drill. Mind you, if you thought we had good drill holes just based on geophysics, wait till we actually have things in a model and we can actually poke things into where we actually believe that there's high grade ore. But again, you have to base it on what the price of your stock is, how much money you can raise, and then backwards into a plan. So I think the rule of thumb is at minimum, we want to do at minimum, we want to do about $2.5 million plan, which is about 5,000 to 6,000 meters, which is the same as we had last year. At a maximum, maybe double that to 12,000 meters. One thing you have to realize too, we drilled in the heart of winter. Throughout the fall where it's extremely wet. So for about $2.5 million, we got 6,000 meters of drilling. Right now, we're going to be drilling at the end of spring throughout the summer when it's dry. So for our budget, we'll be able to get more meters in the ground.
So a capital raise is to be assumed, I guess, because you just raised $2 million. But I assume that's not going to be enough because you told me $2.5 million.
Yeah. So look, if we only have $1.5 million to drill, we'll do that. But again, it's a factor of what our price for a stock is. Obviously, I think we're going to do some charity flow through. We get a premium on it. We'll do it, later on in the year. So we can start the drilling right now. Show the investor exactly what we have, and possibly do a charity flow through later on. It just all depends on the market and what the size of the drill program is right now.
Talk to me, by the way, about that $2 million, because it was interesting to see a private placement right before you announced the drill hole, like some 2 weeks later or something. Why did you have to have the money right then?
We had a lead order. Who liked everything that we're talking about, and the money was there. And sometimes you just got to take the money when it comes. So that's what happened. We were sitting on our hands. So I hear from people all the time, and one of my challenges, some of the mistakes I've made is maybe overpromise investors. We were told by the labs we would have our hole 4 due by December 23rd, And then we were waiting a month. We still hadn't received the holes. And I was getting a little bit worried. And then we got not worried about the results, just worried about how long we have to wait. And then we got a lead order from a bank. And we decided to take the money when it came. And it was for $2 million. And we closed that. And right about when we closed, we actually got our holes back. So that's why the timing kind of worked out there. If you're looking at where our stock went, this market is fickle. What I think actually happened is, there's probably some investors in there that, came in at the 3-cent round and they're willing to sell at 20 cents, 15 cents, still make a 5x profit. You can't get away from it, but there's always overhang. You either have overhang in 4 months or you have overhang currently. Right now that the TSX venture allows you to do that life exemption with, 0% wait period. Investors now only want to invest in something that doesn't have a wait period. And what you end up having, even though we have a lot of great investors in there that have promised they're going to hold on to it long term, you can't avoid the coupon clipping. So what happens is people sell the stock even at a small loss just to hold on to the warrants, the options for the long-term gain at no cost to them. So that's what ends up happening. I think we had about 7-8 investors in the 2 million round, and about 83% of the money was with 4 investors who were in there. So I think it's the smaller investors that kind of clip. And if you look at our stock going down, it's based on small volume. It's not big investors getting out. So as fast as it can go down, it can also go up. And I believe in our results coming up, and I believe in our team.
Actually, when you explain it that way as to why you had to do the raise, it makes a lot of sense. Especially because I met you late last year. And I think for people who haven't met you, you're just an excited person. Like you want to move forward. You want to do this and you want to do that. And you just want to keep it going. That's just sort of the nature of who you are. Correct me if I'm wrong, of course. But that's sort of the vibe that I got off you when we met last year.
Our number one goal, obviously it's to find a deposit and create a liquidity event down the road. But what a lot of people forget, you got to keep the lights on and you got to look after your business. You got to look after your balance sheet. And kind of the blessing, the curse with our program is we liked it so much that we just put the pedal to the metal. And I think investors should be happy that the most of our money that we have, it doesn't go to G&A, it doesn't go to my travel, etc. It goes into the ground. That's the only way you're actually going to get value as an investor. And you look at the end of our program, some people would say as a business probably should have shut down at the beginning of December, but we want to do that 7th drill hole, which was very important to us. And we use a lot of capital up. So we had to protect our balance sheet and give ourselves a bit of a margin of safety. And, there's a lot of armchair investors out there. And mind you, the investors you hear from the most are probably people that don't even invest in the company or people that own very little. I have an investor that owns, 3-4 million shares. You never hear from them. It's always the guys that just own $1,000 or $2,000. But there are armchair CEOs out there. And they say, listen, why don't you do a raise at 31 cents? Well, here's my answer to you. First of all, our stock never traded at 31, never closed at 31 cents. It closed at 29.5. If we're going to raise money at 29.5 cents, guess what price you'd raise that at about 25, 24 cents. The difference between raising money at 24 or 25 cents versus 20 cents is a difference of 2.5 million shares, which is less than a 4% difference in dilution. So you got to take the money when it comes. So, we raised money at 20 cents, which was the same price that we raised it in our initial raise in May 2021, which, by the way, we have drill results and we have a lot better asset and we have a lot more leg room to grow. So that's what I tell investors when they ask the why of when we raised money when we did. But here's another thing too, Antonio. It's funny. The investors aren't really so mad that you raise the money, but they always want that extra information to get ahead of it. So they're actually kind of a little bit upset that they didn't do the sell before we did to raise the money. But again, we're there for the long-term gain. I participated in that private placement. But what I'm catering for isn't the day traders, the guys looking for that 10, 20, 30% gain. I'm catering for the long-term investors. They're going to sell the stock in 2 or 3 years when we sell it to another company, hopefully. I always tell investors, I get messages from people every day. Someone sent me a plunger the other day. I get a guy that says, what's new every day. And I don't disclose public information. But what I always tell investors is, I wish I could pull a Han Solo with you and actually just put you in a coma for 2 years. Because if you go in a coma in 2 years and wake up 2 years from now, I think you'd be very happy with this investment. But junior investing is not for the faint of heart if you're a CEO. It's not for the faint of heart if you're an investor, but you're in here because it's cracking, you get big returns. But you just got to hold on. You got to trust management. You got to trust geology. You got to trust the location, and you will be paid returns because the people that make the most money in this business are the ones that pick the right stocks and get that 1,000, 2,000% gain when they hold it for 2 years, not the guys who are trying to make a 10, 20% clip every day. Because guess what? When you make those 20% gains, you also make the 20% losses. So you're almost better off picking that right stock, which I think is American Eagle, and holding on for the long term.
That's a good point. It's also a good joke. So it made me laugh because I wish I was in a cryo sleep over the last 2 years. Not really. I had some good moments. But let's go back and talking about what you have there under the ground. What you're really looking for, I guess, from what I've understood so far, is that so you have something there. Okay, there's something. The historical drilling already proved there's something at first surface. You're looking for something deeper. What you're really looking for is size, higher grades at depth, and continuity of the mineralization. That's what you're going after in 2023. Is that right?
Exactly.
Okay.
We have size, we have scale. We had 7 drill holes, all over 0.2% copper equivalent, all continuous mineralization, all 1,000-meter holes, over 700 meters strike, which is absolutely amazing. It's open in every direction. And again, if you look at our South Copper Zone, like that's amazing. That's a very economic resource. Our first drill hole was 126 meters at 1.05%. If you look at the hole that was drilled in 95, I believe that was about 175 meters at 0.81%, and that was 120 meters away. So just that South Copper Zone, that's robust enough. And all of a sudden you're hitting that hole 4 zone, and we're looking for that deep area where the source is. And I believe that we can find it. We have extremely smart people that are running this exploration plan. Charlie Gregg, Neil Prouse, who are involved in GT Gold and SK, that have experience in BC. They're just not pumped just because they want to be paid their hourly wage or their contract. They want to be part of this discovery, and they really do believe that something is there. When we drilled that first drill hole, I couldn't even get a meeting the day before, and I was contacted by 4 major companies, and some of them have actually seen our core. And these guys are looking at things for scale, and they're extremely impressed with what they see. And what they see there is a lot of bornite, which is very rare. When you're as an investor, what I look at is look at 3 things. Who's your team? Do you have a team with track record, guys that don't rip people off, people that don't do pump and dumps? We have no history of doing that. Charlie Gregg and the Geos have a history of making discoveries. So let's check 1. Where's the location? Well, we're in copper country. We're in BC. A lot of people get scared of BC because some of the community issues. That might take maybe a couple more years to get something done, but mines do get built. But once they're built, they don't get taken away. And that's why we avoid places like South America, Argentina, anywhere else except for Canada, USA, and Australia. So, it's the who, it's the where. And then I guess the last thing that you want to look at is you want to make sure there's a good potential for liquidity event. Is there something of scale, which I believe that we have. So that's what really makes me excited. And, finding a really good investment in this business is like finding a needle in the haystack. My job as CEO is make that haystack as small as possible, and for people to buy, my needle.
Seems like you know what the text behind you says, right? It's people, projects, and capital. So that makes sense. I think I'm mostly out of questions here. I wanted to ask you though, what keeps you up at night? That's sort of one of my favorite questions. What do you think the risk is there? Like not proving up continuity? Is it something else? Is it drill channel? I don't know. What keeps you up at night?
Also, what keeps me up at night, just try and keep everyone happy, try and keep investors happy. So I said my goal is to keep long-term investors happy, but it's also to keep those short-term investors involved in our stock, to keep that stock up, because the price of our stock is really important to us, because that's our capital, allows us to raise money to actually do drilling down the road. So that's what really does keep me up at night. I believe we have something there, so I'm not as worried about our drill results. I'm extremely excited about them, extremely excited about our next assays coming out, extremely excited about our drill program. But really, it's just a stock. I look at it every day.
Okay.
And just to add one more thing I just thought of, Antonio.
Please do.
Another blessing and curse of doing these raises is that you do the raises, and we sold 10 million shares for 20 cents, raised $2 million. And you're always looking for people to buy the stock. But unfortunately, when you do those raises, you actually take people out of the buying in the general market that keep the stock afloat that you did the private placement with. So that's why there's maybe a little bit less on the buy side, because we kind of took those buy people out with the private placement. But again, those people that get on the buy side at 20 cents, they'd never be able to buy 20 cents stock of $400,000 worth. So again, this business is it's a very gray area. It's more of an art than a science. But in the end, it's about finding that deposit, and that's the only way you can get any sustainable value.
You said you want to have those holes out before PDAC, by the way, and I forgot to ask you, are you going to be at PDAC?
That's my backyard. Of course, I'll be at PDAC. It's the greatest mining conference in the world.
Okay.
I forget our booth numbers, but we have 3 booths there. We're going to be right there. Look for the Orefinders booth, and American Eagle will be there. We're going to bring all of our core from American Eagle, or at least a lot of it, and we're going to show it. And you can see the bornite. It's amazing.
Okay. Well, good stuff. Thanks a lot for stopping by. Thanks a lot for our day. I've been having fun, so I enjoyed talking to you.
Yeah, thanks a lot, Antonio. Nice seeing you again.
Copper, of course, is not the only metal needed for the energy transition. It is the main metal for the electrification of everything, as Lobo explained. The supply chain issues might also be very positive for the price over the long run and stuff like that. That's right. But over the last year or so, though, there has been another electrification metal, so to call it, that's been making moves and stealing headlines. And that's been lithium, of course. If you look at the price chart, you'd not be surprised. But lithium has since given back all of those gains, all the gains that it made in 2022. It's given back and then some. But many companies have also changed their names and focuses to suddenly include lithium. We've seen congratulating news releases and other types of shenanigans, many of which point towards this being the sentiment top for lithium. But the thing is that the supply and demand imbalances in the metal are not to be ignored either. So that's reality, right? So again, in the need of a bigger brain to do the explaining here, because I don't quite get it, here's Koby Kushner giving his opinion on the lithium market. I have with me Koby Kushner, who is a mining engineer who spent years in the field, like actual boots on the ground at different mines in Canada, during which he's basically seen it all. He's seen mining projects succeed, fail, mostly fail, I guess, move from exploration to construction, and then even to production, some of them. Koby currently works as a mining analyst for Red Cloud Securities, and he is also a CFA chart holder. So, Koby, you've set your own bar high enough here. So, no pressure at all. But I'm looking forward to this conversation. Thank you for being here.
Look, thanks, Antonio, for having me, and thank you to the Ore Group for putting on an awesome show.
Yeah, absolutely. I wanted to take it from somewhere. I was thinking, what do you like writing the most about? Like, is it what do you cover the most about? Is it specific commodity, specific type of company, specific type of country?
I think, like you kind of touched on it a bit. I started off in the field. I started off working for majors, and throughout my career, I worked for smaller and smaller companies. Went from producers to non-producers. And then when I moved into finance, I started looking at a lot of non-producers, including companies that were in the pre-discovery phase. So I've learned that exploration is what excites me the most. The idea of turning land into something potentially worth billions of dollars is what's exciting for me. And I like writing about exploration companies. Particularly these days, the lithium space has been very hot. It's been very heated. Precious metals are fun to cover, but lithium is very exciting right now, and it's something that not a lot of other people cover. So it's interesting that I've been able to take a deep dive into several of the companies that are advancing their lithium projects and all the newcomers to the space.
We're gonna touch upon all that, I'm hoping at least, but you are indeed here to talk about lithium today. If you had to rank it, though, if you had to rank lithium among the metals that the Ore Group is exposed to, among which gold, copper, uranium, and other energy metals, where would you rank it? Would you rank it all the way to the top?
Trick question, because I don't believe the Ore Group currently has a lithium company, at least to my knowledge. That being said, they've got exposure to a wide set of commodities. Like I'm still a gold bull at heart. I love gold, and I love copper. I think the fundamentals for copper and uranium and nickel are all fantastic. Generally, there's major trends happening across the space, and that's the decarbonization efforts, as well as the electrification of everything. So we need a lot more of those metals. Gold, of course, isn't really a battery metal, but it still has its industrial applications, but B, it's something that I personally would always want to hold it in my portfolio.
Well, let's make the case for or maybe against lithium. Who knows? And you're right, the Orr Group does not have one. And when I say we, I really mean let me shut up and let you make the case for lithium. But let's maybe take it from the top, because there seems to be hydroxide, there's carbonate, there are equivalent prices, and I'm even more confused than I normally am. So you take it away and tell me more about it.
Yeah, I mean, lithium isn't a single product. It's not a commodity. It's not like gold where, there's a spot price for it and that's the accepted price for it across the world. Lithium is a chemicals business. The end product is usually either lithium carbonate or lithium hydroxide, some kind of lithium salt. And depending on where it is that you're selling it, you'll get different prices. For example, like spot prices, if you even want to call it a spot price, in China, they tend to trade higher than the rest of the world. And then hydroxide usually carries a premium over carbonate, but it fluctuates. Like we recently had a carbonate premium that just dissipated. But yeah, and then the other thing is purity. So it's not just where it's sold, it's what's in it and how that will affect the end use of it. So, for example, if you're talking about a product that chemical manufacturers are selling, it might be 99% purity, 99% lithium carbonate. But what's in that other 1% or what's in that other 0.5%? That might dictate your selling price. And it might dictate its end use. It might dictate whether or not this lithium would be able to, would be applicable to the glass and ceramics industry. It might dictate whether it could be put into a battery. So there's even within lithium carbonate, right? Like there's different prices for it. Depending where it's traded, there's different prices depending on whether it's what they call technical grade or battery grade, etc.
I guess pretty much the only thing I can think about is because this sounds quite complicated. And I don't know many things, but I do know a chart that's gone up 15 times in 2 years when I see one. So I guess my inner contrarian is screaming at me to stay away from that chart. Is that inner voice wrong?
I think if you have been following the metals and mining space for a while, you know that what comes up must come down. We've all been familiar with the, Rick Rule's famous phrase, the cure to high prices is high prices, the cure to low prices is low prices. So I don't think you're naive for that being your reaction at all. Prices will eventually come back down. But I think the difference with lithium right now is that it's not a widely traded commodity. It's not like there's idle supply waiting to come on. Instead, there's basically no supply. There's basically no idle supply, and because of that, the current prices it's really a lack of supply that's driving this price appreciation. And when you want to think, hey, what's the catalyst that's going to cause prices to come back down to the cost curve? And it's going to be the introduction of new supply. And right now, there's not really much line of sight to having that introduction of new supply. And touching on the cost curve, just to put things into context for the gold listeners on the line. If you're lucky, you're selling your gold for about double the cost to get out of the ground, if you're good. But in the lithium space, right now you're selling it for anywhere between 10 to 15 times. We are very disconnected from the cost curve. What's going to make it come back down? introduction of new supply, right now, I don't see line of sight for significant new supplies to disrupt the lithium market to the point where prices will sharply correct. So in this case, the cure to high prices is indeed high prices, but that's not happening anytime soon, in my view.
When you say not happening anytime soon, how long is that? Like how hard is it to put a lithium production into a lithium, or property into production? And also, do we have enough of those? Like when you look at copper, for example, we don't even have enough projects to put into production. How's the thing with lithium? Do we have a couple waiting, or how does it work?
No, I'll say. I think maybe within anywhere between the next 2 and 5 years, there might be 15 new operations to come online. And then meanwhile, like if we want to meet 2035 demand, benchmark mineral intelligence is suggesting we need about 74 new lithium mines to come online, average size. So yeah, I think it's not like we have projects that have advanced feasibility studies on them just waiting for funding. Those things are, in the next couple of years, and even now, those things are getting funded right now. And that's why we're seeing a shift towards further upstream. The fundamental issue here is that the timeline to bringing on new battery capacity, which is what's driving lithium demand right now, is much shorter than the timeline to bringing on a new mine. So because of that, the supply-demand gap is going to continue to increase unless there's some major disruption in the lithium supply chain. You're asking me about how long does it take to put a new operation into production. It takes years, anywhere between 5 to 10 years, give or take. Which again, that's a lot longer than the timeline to bringing on new battery capacity. Touching further on that, generally the hard rocks have been able to come online quicker than brine projects. I'm not sure if you'd like, we can touch on the different types of lithium operations as well, but we can get there when we get there.
Yeah, I definitely want to talk more about the supply side of the story later on. But you just mentioned something about the batteries and the increasing demand in those. Is lithium really dependent on the demand for EV? Like, do those go hand in hand, or is it batteries for other stuff as well?
So the breakdown right now, it's batteries for other stuff as well. But within that, EV batteries comprise the biggest source of demand compared to the other sources, whether that's batteries in our phones, batteries in stationary energy storage. Right now, it's mostly EV demand that's driving it. That being said, the demand for other types of batteries are increasing as well. And then there's, of course, demand for the classic industrial sources like glass and ceramics and medication. To go on a bit of a tangent here, it was the early 90s when the first commercial lithium ion battery was available. And that was a product by Sony. If I'm not mistaken, it was used in, don't quote me here, I think it was used in one of their cameras. Since then, demand has continued to grow, but it was recently in 2018, that's when demand for batteries overtook demand for industrial applications. So 2018 was kind of an inflection point for lithium. At the time, there was actually a surplus of lithium, so prices didn't really react. But now that we've entered a deficit, prices have really, really jumped.
How dependent is all this then? I mean, if we go from that answer, how dependent is it is the demand side of your equation on interest rates and the economy. I mean, if the economy is not doing well and people are not consuming as much, does that mean that the demand for lithium is going to die off? Like, could it?
That's a really good question. The answer is I don't think so, in my view. I don't think we're replacing lithium. If you know, going back to high school chemistry now, you know, first of all, let's talk about battery demand. Are we replacing ICUs with electric vehicles? I think the answer is yes. I think the demand is very real. And then continuing to work towards the chemical composition of these batteries, I don't think we're going to be replacing lithium. I think the thing is that lithium is very much the lightest metal on the periodic table, going back to high school chemistry, right? Hydrogen, helium, lithium. It's the third element. It's the lightest one. It's got this 3 electrons. It's got its first shell full with the first 2, and then it has this third electron that just wants to jump away. It's very it's these qualities that make it you know, the ideal battery metal. So if you want energy density, you need the lightest conductive metal to do that, right? And that's lithium. So there's other chemistries out there that don't have lithium, but if you're trying to put them in a battery that's supposed to move around like an EV, you really need that energy density. You know, vanadium redox flow batteries, very promising technology, but they're the size of the room you're in. It's not something you put on an EV. So I don't think we're shifting away from lithium anytime soon. I think it's here to stay.
It's interesting that you should bring that up, because I wanted to make it as a comment to the cure for high prices remark earlier, because I spoke to Rick Roll and he told me that phrase does not only mean that once prices are high enough, there's going to be new supply, and that supply is gonna cover the supply gap. Sometimes it could also mean that the metal in this case would get substituted. And, you know, it happens all the time with platinum and palladium, for example. On the periodic table, no better metals than lithium for that purpose, as you mentioned. But what about stuff like graphene and other 2D materials that are being tested for batteries? Like, is that too far off in the future, or am I going into science fiction here?
Well, you know, lithium is... I think it's that these products tend to work with lithium. Like, if you look at the innovations in battery technology, I think the most promising one, you know, in my view, is solid state batteries. But those batteries still use lithium for a reason, right? So, and you know, graphite. I don't know. I'm not a battery expert by any means, but assuming you're talking about graphene replacing graphite on the anode side of the battery, so the other side of the battery, that where the lithium ions start at the cathode and they move over to the anode, and that's where graphite comes into play. It's able to store the lithium ions. Whether graphene could replace graphite, maybe, but lithium is still going to be there.
You said if that was what I was talking about. I wish I knew what I was talking about. It's just that I've seen graphene batteries all over the place, and it's sort of getting me interested because of the stuff that they're promising. Let's talk about the supply side and the different projects that produce lithium. How does that work with lithium? Like, what's the underground to open pit equivalent in the lithium world?
Generally, right now, about 60% of production, give or take, comes from hard rock sources. Hard rock could be open pit or it could be underground. Right now, it seems that most hard rock lithium producers are open pit. And then the other 40% comes from the brines. Generally, the brines are very concentrated in what they call the lithium triangle in South America. And there's a reason for that. That's because it offers the right desert environment to allow it. So hard rock, for our listeners on here, they're probably generally familiar with hard rock operations. I'll start there. So open pit or underground, the end product usually at the mine site isn't the final lithium chemical. It isn't usually hydroxide or carbonate. It's what they call a concentrate. So they'll take, grades are usually about plus 1% Li2O is how they measure it. So they'll concentrate that 1 to 2% Li2O into something closer to 6%, and then they will ship it off to a hydroxide converter. So that'll be usually in China is where the chemical processing is actually done. Mm-hmm. And now moving over to the brines. Again, mostly in South America for now. I think that's going to change, but I'll get to that. They have, at least in South America, they comes from these salars, these salt lakes, and these salt lakes have lithium concentration in it. It's liquid resources. Drill a hole, you pump it out, and you let it sit in these what they call evaporation ponds, shallow ponds, and you let the sun do its work, remove the water, and then you're left with a high enough grade lithium concentrate, and that which you can then further get into your chemicals. Usually, it ends up being a lithium chloride, which then can be turned into your lithium chemicals. It relies on the sun to do its work, right? So you need to have a desert environment, hot, arid, low precipitation, and because basically, the sun needs to evaporate the water out. There's other developments happening. There's what I'll call unconventional sources of lithium, which might be the wrong term for it, but that might be geothermal brines. It might be petrobrines. So that would be something in the oil fields. The thing with that is generally you need a new technology in order to unlock it. And they call this technology direct lithium extraction. Calling it new technology is also a misnomer. I mean, a lot of them use processes that have been around for decades, like ion exchange and solvent exchange and absorption. But to commercially do it for lithium hasn't really been done yet, at least on a pure play DLE only type of operation. DLE being direct lithium extraction. So it has been done before. Livent's been doing it since the 90s in Argentina at Hombre Muerto, but they've been doing it in conjunction with evaporation. Same with some brines in China as well. So I think personally, I'm bullish on the technology. I think it's inevitable. To quote a friend of mine, innovation happens at a necessity. So that necessity hasn't really been there until now. There's a lot of new developments happening in lithium, both in the brine space as well as hard rock. The other unconventional source of lithium I'll briefly talk about is the clays or sedimentary type deposits. Often this is what you'll see in the Southwest US, places like Nevada. You'll have clays that are enriched in lithium. That has yet to be done on a commercial scale, but there's lots of developments happening. We saw the announcement with Thacker Pass and GM investing millions of dollars into that to try and develop it. So there's a lot of I'll say warming up to these unconventional sources now, so more than ever.
There's another unconventional source, I guess, and I don't know how big it is, you tell me, but recycling, can that I mean, how big of a supply source is it right now, and how big of a supply source can it become in the future?
Yeah, I mean, it can be a contributor, but it's unlikely to disrupt the market in terms of supply. Even at today's very high prices, it doesn't always make economic sense to recycle. Different battery chemistries can cost a lot more to recycle. For example, LFP chemistries, those arguably don't really make sense to recycle even at today's high lithium prices. For what it's worth, LFP market share has been rapidly increasing as well.
Right. Which of those suppliers, which of those sources offers the best risk reward in your opinion? Is it the hard rock, the brines, the clays, something else?
I think it varies by project. Like if you look at the economics between different sources, like it could vary. Generally, hard rock sources tend to be lower cash cost, but they also might be lower margin because you're selling a concentrate rather than a chemical. So it's hard to say if there's an opportunity more so in one than the other. It really needs to be project specific. Unconventional sources like DLE, let's face it, it's a binary outcome. Like if we can't get DLE to work, the project, evaporation is not an option in places like Western Canada, right? So it might be a binary outcome, but if it works, like it's very disruptive to the global supply chain. And I say that because, when putting on my engineering hat now, if you're trying to determine your productivity of a mine, how many tons you can get through the mill, if you're looking at a hard rock operation, generally, your production rate is dictated by the geometry of your ore body. Moving over to the brines, the traditional brines, the bottleneck ends up being your evaporation rates, and consequently how much real estate you actually have to put these massive evaporation ponds. Now with DLE, those bottlenecks don't exist. You're now limited by your deliverability, the flow rates that you can get out of each well. That means that if you want to scale it up, if you want to scale up a DLE brine operation, it might just simply be a function of drilling more wells. And of course, adding more DLE processing capacity as well. So I think I can't tell you which one has the best risk reward in summary. It's got to be project specific. But yeah, the unconventional sources, higher risk, maybe higher reward too.
What about companies who, and I don't know if there's too many of those, I think I know of one project who's hoping to do that, extract lithium themselves and then refine it. Is that increasing the value chain within the companies? That's something that interests you?
I think that's a trend that we will see. So one trend that we're seeing is, nationalization of critical minerals. We saw Zimbabwe decide that they're going to stop exporting lithium. We saw the Mexican government declare that they're nationalizing lithium. We saw Canada force Chinese divestment of 3 juniors last year. So I think we're going to see more countries trying to secure their own supply chain. And what that means is that they'll have to build out an entire supply chain. Sorry, countries trying to secure their own domestic supply of critical minerals such as lithium. And what that means is that they'll have to build out the supply chain. So individual companies, how I feel about it is mixed. So I think that's the direction that we will end up going down the line. Canada historically has a poor track record of doing that. We've tried doing that with Whabouchi. They tried going downstream, and it turns out that the science behind going downstream is very specialized. It's not like you can just be a miner and say, oh yeah, we're also going to produce a hydroxide product here on site. It's not that easy to do, to go from spodumene to hydroxide. There's a reason it's mostly done in China, and that's because they've got the expertise. They're years ahead of us. So I think it's risky. I think you need a separate a separate knowledge base or new type of experts in there to achieve that. So I think it adds to the risk at the company level, but I think what might end up happening is, rather than the same company trying to go fully downstream, or at least for startup operations anyways, I imagine most startups will want to go just producing the 6% concentrate instead. With the brines, maybe we'll see more of producing your end product at site than we will for the hard rock concentrate sources.
As we were talking about the different ways to expose yourself to this sector, though, what I'm thinking is that if we're sitting here, and I mean this is no insult to you, more as an insult to myself, but if even I know and understand this thesis, wouldn't that mean that the thesis is already well distributed throughout the marketplace? And wouldn't that mean that the investment vehicles are already under the efficient market theory, already priced high enough, or even too high? Or how do you look at it?
If you asked me that a year ago, and prices continue to keep going up, like it's hard to call a ceiling or a floor on this. I think with the flood of new explorers coming into play, there's still some companies that are doing it much better than others. So I still think it's possible to pick winners, especially relative to the rest of the market. And similarly, I think it's possible to pick losers. We're seeing something totally new in the lithium sector this time around, compared to the previous, I guess, somewhat short-lived bull market of around 2016. For one, we're seeing more investment into these unconventional sources of lithium. We're seeing increased nationalization. And we're also seeing a lot of grassroots exploration, which hasn't really been done before. I shouldn't say that. Like, there was a boom in the 50s, maybe some was done in 2016, but genuine grassroots exploration has not really been done before in the lithium space. So I think we're going to be seeing a lot more discoveries over the next couple of years. And if you're positioning yourself with these early stage explorers, you're not, prices could chop in half, and if they find a deposit, they're still gonna outperform.
We've mentioned Rick Rowe a couple of times in this conversation. Two other things that he's been telling me is that you said it's hard to call a ceiling or a floor. Two things that Rick uses to call a ceiling is, he says, when the thing you want to invest in has become front page news for general media, that you might be closer to the ceiling than the floor. We look at the investments that lithium companies have gotten from some of the bigger auto manufacturers like GM or whatever. That was front page news. And then the second thing that he looks at is that he says something like, you need to sell you're closer to the ceiling when every other Canadian listed company turns into a Canadian listed lithium company. In this case, we've seen a lot of that silly business happening, especially throughout the last weeks. So what does that tell you?
I think any high growth industry attracts a certain kind of person. So if you're, we saw it with other sectors too, the whole marijuana cannabis craze, the whole crypto craze, and then people that see the potential for those rapid high returns in a short period of time, it attracts a certain kind of person, certain kind of promoter who's out to make a quick buck. So the space, investors need to be very cautious, because the lithium space, because prices are up 700-800% since 2020, it has now attracted a lot of new explorers, many of which are doing great work. some of which are run by those same crypto cannabis promoters who are in it for the quick buck. They're not in it for the long haul. They still might have success, but that's something to keep your mind on. I wouldn't necessarily use that as a proxy to tell you whether or not you're near the top or near the bottom in the lithium space. That is, you mentioned automakers coming in. Automakers are signing MOUs with companies that just have inferred resources without a PEA, without a PFS, no real line of sight to production. That shows how desperate they are. Again, there's no reserves right now are expected to be depleted by the mid 2030s. So in my mind, the demand is still very real and the lack of supply is still very real. I'm still hesitant to call to put a cap on things just because we've seen an influx of new explorers, but investors still have to be very careful in times like this.
That's a good point, and I'm almost about to let you go here, Koby. Just last question. If you look at a commodity cycle, what inning or what part of the cycle would you say lithium is in right now? Because you said it's a different animal. Is it maybe a different game too? Like, are we not even in innings? Should we talk in terms of halves, or how do you look at it?
I think we're in the early days. So we're I think it's it's not the flavor of the week, it's the flavor of the decade plus. Yeah, we're gonna have prices come up and down. But as I said, I think the demand for lithium is very real. I don't think it's going anywhere. And evidently we need new supplies. We're going to run out of current reserves by the mid 2030s. It takes a long time for a new project to come online. We need exploration. We don't have enough of it. It's never really been done before. Most of the hard rock lithium sources being drilled right now are occurrences that have been known for decades. Often, we're seeing companies pivot that are gold companies, and they pivot towards lithium because they've had prospective rocks that have been mapped. They're sitting there for a while. It's time. It's still early days to answer your question.
Okay. I think I have a better idea of what's happening, and I'll be following along. Thank you so much for investing your time in Ore Day, and thank you for being here.
Thank you for having me.
Now, the Ore Group hasn't yet jumped on the lithium hype train. Not yet, right? I shouldn't say too big of words yet, because lithium fever is a big thing, and we seem to be at the beginning of this commodity super cycle, as Zoltan Pozsar told us. So there is time for surprises, I guess. But the Ore Group does have exposure to another battery metal, with that being nickel, which Metal Energy is currently looking for in the Thompson Belt in Canada. And that company is run by the same CEO who runs Baselode Energy, the uranium explorer that we talked about earlier. But it has a market cap that is roughly 10 times smaller than that of Baselode, despite it already having drilled 40 holes and reported significant intercepts of nickel. And as I said, James is a good guy to talk to and to listen to most of the time. So let's listen to him talking about nickel and his nickel explorer. All right, James, you're back again, kind of like Steve. I try to get rid of you guys, but you just keep appearing. You've got so many companies to talk about. This time we're talking
about. Good thing we
like
to stay active.
That's good. No, it's good. Keeps you young, right?
Absolutely.
This time we're talking about Metal Energy, though. This is your nickel explorer, which I'm interested in figuring out. Let's kick it off there, actually, because it's called Metal Energy, but you've got nickel properties. And I don't want to speculate about anything, but it seems like you might want to make it more than a nickel explorer. And do you want to add any other metals that are related to the energy transfer to it?
That was the whole point of Metal Energy from the get-go, was to be the vehicle to really capture a lot of what was going on in the EV space. So whether it was, or not just EV, but the renewable space too, things that are really taking off in the world, that are trying to transform humanity's global living standards and energy pollution. So, with my rare earth background as well, I had looked at rare earth projects to be incorporated within Metal Energy. We're looking at copper plays, lithium, vanadium. So anything that's really related to that whole metal, to the whole energy scope of things, that really falls under the metal energy umbrella, or the metal energy purview, I guess, within the Ore Group umbrella.
Okay, so within the metal energy brand, I guess. Yeah, oh, that makes sense. That makes sense. Let's do talk about the nickel part, because I guess that's what's happening right now. I know almost nothing about the nickel market or metal energy as a company. I know a little bit, but looking forward to learning more about it. But before we get into it, though, before we talk about the actual company, I want to talk about the stock, because you IPO'd in 2021, if I'm not mistaken. You IPO'd at 20 cents, and it's been a painful ride for whoever decided to take that bet at IPO, and you're now down to roughly 6 to 7 cents, 6.5, something like that, and a market cap of what, under $6 million Canadian. After you drilled so much, what's happening? Why is the market not giving you any love there?
I really wish I could answer that. Because I'm one of those IPO people as well. I got in there, I saw the benefits of the project. I really liked everything that I saw with the company, the two projects that we had. One was an exploration bet on a thesis. That's our Strange project. And the other one was, for me, it was a no-brainer. It's the home run, and that's Manabridge out in Manitoba. We've pumped out a lot of good results, upwards of the 60 meters at 0.8% nickel. That's a big hit in the nickel space, and it's all sulfide nickel. This isn't laterite pig nickel or anything like that. This is legitimate sulfide nickel, and it's relatively shallow. So with the results that we've been putting out since January of this year, we have seen more. We have seen more love come back into the story, but it is honestly still languishing. And we thought that good results would really pull this forward, really get people interested, and it hasn't moved. But I also look at a lot of other nickel stories within Canada, specifically within Canada, because there's a lot of them, and they all seem to suffer the same fate, unless they're these companies that are pumping out hundreds of meters of 0.2% nickel that aren't necessarily nickel sulfides. I think there's a weird viewpoint on what investors are looking for. But I also think that a lot of investors are like you. They don't understand nickel. They've never looked at nickel. And even though nickel is part of the whole EV spectrum and renewable battery supply spectrum, everyone's looking at lithium. And I think nickel is just being completely forgotten about and put in the backgrounds. But see, the price of nickel is continuing to rise. It is at the highest it's been in decades, barring what happened almost a year ago today with the LME thing. But the nickel demand is looking very strong for future years. So there's a lot going for it, and nickel sulfides are really where you want to be. You look at the global operations for nickel laterites in Vietnam and Indonesia. Indonesia they're upset. The government's upset with the mining there because they're environmentally disastrous. So they're starting to put bans on certain things and certain projects. And Vietnam's even now starting to look at the same thing. But you don't get that with the nickel sulfides, especially in a jurisdiction like Canada, where you've got Voisey's Bay, you've got Sudbury, you've got Thompson. These are all long-lived jurisdictions, and especially Sudbury and Thompson. They've been around for multiple decades, and they've been very safe. I guess I wouldn't say environmentally friendly, because if you've ever been to Sudbury, you know the Sudbury story, but they've cleaned it up. When environmental standards came in, they've cleaned it up amazingly. And it goes to show that when you do things right, these are the type of industries that can really add benefit to society, and without causing any undue harm.
Mm-hmm. Well, I guess the share price really only matters if you're selling the project or raising capital. And I'm just going to go ahead and assume that you're not selling the project because you just bought it and you want to drill it out. But what about raising capital? How's the treasury right now? And do you have to raise at these prices?
We've got about just over $2 million in the bank. Again, all hard dollars. So we've got no flow through. We completed the project. We completed the drill program last year with a flow through investment from one of our ore group sister companies, Mistango River Resources. So they now own 15% of the project. But we love what we saw, and we think that there's far more to be discovered in this project. Manabridge has 100% intersection success rate, which is almost unheard of. It's got high grades, it's got width to it, and it's within an area that has built infrastructure. So the roads right there, the highway, the rail lines right there. When I say right there, you turn off the highway and less than 5 minutes, you cross the rail line, you drive under the power lines, and then you're right at the drill sites. So everything is right there. You're 10 kilometers, or it's not 10 kilometers, about 10 to 15 minutes away from Woboden, which is a community that has labor force, has equipment. You're an hour south of Thompson, which has the smelter and refining capabilities. There's a lot going for the project, and it needs to be drilled more. There's one of the problems we ran into very early on, and one of the reasons we need to drill more is, yes, there's a lot of historic drill information, but we can't verify where those drill collars are. A lot of it was all underground drilling, and even we've put some drill holes into areas that, based on the historic drilling, looked like they should have been super hot, and they come back as not. So we think that there's a small shift in the data that was applied to the GIS capabilities of mapping out the old works. But that really puts us back, in that we can't rely on the historic data. We need to develop a lot of the data ourselves. So we can't simply go out there and twin a surface hole and say, yep, this is all good. Because number one, we can't even find the old surface holes. So we basically have to proceed as if this is a new project, a new discovery. But the historic data helps us in that it gives us an indication for where we can expect for better zones of mineralization. But again, that the historic data is limited, and we've already been proving that there's far more nickel in areas that they had never drilled, never even conceived of drilling. I think that if they had found some of these zones earlier on, they probably would have mined them out. The mine stopped back in the 1970s just due to the low nickel price environment. But again, some of these zones and discoveries that we're seeing were not known about back then.
Okay, so but in terms of capital, you have that money on there. What are you thinking then? Flow through later this year,
Yes.
or at least you're hoping?
Yeah,
or?
we have to drill this out. We really have to get this project moving. It's our flagship. It's an amazing asset, and we need money to do so. We are planning for about 15,000 meters of drilling this year, and that's going to take some cash. But fortunately, this is one of the lowest low cost exploration projects I've been on in a very long time.
Because you don't need a camp.
Yeah, we don't need a camp. Infrastructure is already there. Just basically get in there and drill. We're not moving the drill off every hole. We drill fans. So you drill a hole, you just change the dip on the drill another hole, and you do that for 3 or 4 holes, and everything just moves nicely. So we figure that with about $5 million, we can complete those 15,000 meters. So it's not a costly project, but we have to raise that $5 million to complete the summer drilling. So anywhere between now and May, we would need to look at raising money to really move Manabridge forward and hopefully get some more eyes on it.
How did you get your eyes on Bridge? I mean, if there's been, there's been exploration before, there, historical mine and all that, as you said, they eventually left, but the nickel price has been sort of ticking up higher. If you just erase that blip that happened last year, early last year, the nickel price has been ticking up. If I look at the chart, so how come nobody else picked it up before you? How come you're in this seat?
Well, Canalaska originally had the project. Canalaska had the foresight to see the nickel is going to take off. And they had staked a number of projects in Manitoba, in the Thompson Belt. Credit to them for that. And then after the success that I had with Baselode, the Ore Group was looking at diversifying a new company to capture the whole EV and battery spectrum of metals, as discussed, and hence the formation of Metal Energy. And so one of our directors, Charles Beaudry, who you'll probably already talked to for QC Copper, and Stephen, they were looking at the nickel space. Charles has nickel experience, and they're looking for the right project in the right jurisdiction. And they got in touch with Canalaska and really hit it off and liked the project. They brought it to my eyes. I fell in love with it because it was, to me, it was a no-brainer. I saw nothing but potential and size and scope in this thing. So we basically just decided that I'd be the guy to run it. I've got exploration experience. We needed a nickel guy, so we brought on our VP exploration, Mike Sweeney, who's got a number of years with Falconbridge and Glencore. He's worked in Sudbury for the vast majority of his career. He's been part of underground mining. He's been part of discoveries. He knows the nickel space, and we brought him on to really help us out and move Manabridge towards more of that mineability and production side of things. And he's very happy with everything that he sees in what we've done. So it's one of these projects that even the guys who know nickel really like, and we think there's so much potential to this to be a large scale operation. And it's just a matter of being able to prove that to people. But it's hard to do so at these low share prices, and it's really hard to get the eyes on people. I think one of the things, if we can prove up size and scope, hopefully that would attract more eyes.
Isn't this challenging for you though? Because if I think about it, this is your first time as a CEO. I mean, this is your first commodity cycle as a CEO. You've been a CEO of Baselode for a couple of years now, but you're already running two companies. Isn't that challenging for you? How are you dealing with that?
I take it day by day. It is challenging for sure, but you know what? That's how I learn and grow. You don't learn and grow if everything's easy and spoon fed to you. So it's, you learn by overcoming these challenges. And so with both companies, with a family and everything else that I do, I just learned to prioritize my time. I learned to focus on what needs to be done. A lot of what I do is really trying to get the story out, to really help people understand. And that's one thing we've done with Baselode is the narrative behind Baselode and bringing investors along the ride and letting them into our heads. We're trying to do the same thing with Metal Energy. So it's taken a little bit longer just because the Baselode side of things, uranium came so easily to me for working on it for 16 years and having a vast library. Nickel was a little bit slow starter, but now we're at that spot that we need to bring investors along the ride. We need them to see what we are seeing. We need them to get excited for the same reason that we are excited. And so it's just that's part of the challenge. And I relish it. I really enjoy doing all of this.
And you also, I guess it's easier because I assume you're sharing the cost for the CEO, or how does that work?
Yep, it's shared cost. Yep, shared cost, and same with the Ore Group in the background. We, our CFO is CFO of 6 different companies. Our administrative side. So there's a lot of shared costs that allow us to really reduce the amount of G&A expenditures on an annual basis. And that's really what we're what we're about. We're trying to limit our cost and put the money where the money needs to go, and that's in the ground. If you look at both the companies that I'm CEO of, I'm not the highest paid guy in these companies. Both my VPs make more than I do on a per company basis.
Gee, it feels like a dream job. You get to run a second company and not get paid as much.
Exactly. I don't know how many people would actually do that, but no, I believe in the asset. I believe in the project. I believe in the Ore Group. I believe in everything that we have. It's just a matter of really trying to make everyone else believe.
Okay. Back onto your nickel project, though, you've done 40 holes there. I guess it was you started a 10,000 meter drill program. It was sort of interrupted, if I'm not mistaken, but then you've now recently finished it. What's the latest there? How many holes are not reported, and when will they be?
We've got 5 drill holes outstanding as of this interview. I'm hoping that by the time Ore Days comes out, we will have released all of those additional 5 holes. Based on what I've heard from the geologists, the mineralization was continuing to get better as we progressed towards the old mine working. So I'm expecting better results. It's kind of hard to beat the results that we've already been putting out, but very excited to wait on those 5 drill holes. So yeah, but after that, then it's getting that story out there, really trying to get the investment community excited about it and raise the money to go back and keep drilling, keep hitting this thing hard. Because this is a project that can really benefit just the nickel industry. We had a model built off the historic drilling, and it kind of gave us an idea of where we should be looking for new zones of mineralization. Because the idea is that this whole complex that is Manabridge, it's a 3 kilometer long trend of nickel mineralization, but it's not just magmatic nickel. It's magmatic nickel that has been reworked in a metamorphic terrain, in a mountain belt terrain. So now you're magmatic nickel, but it's structurally complex. So we needed to define what was happening with those structures. What is concentrating the nickel within certain areas versus other areas? And it all comes back to structure. And that's one of the things we'll be educating down the road. But since we've got 3 kilometers of this overall structures, we needed to figure out what's the periodicity of these root zones, or these higher grade pods. Are we going to see them occurring at certain intervals? Are we going to see them occurring at certain depths? A lot of questions needed to be answered, but I'm fairly confident that we will find more of these higher root zones.
And then what? What's the plan? To make it a takeover target, or consider later on bringing it into production soon?
All up in the air at the moment. We're not excluding any ideas at the moment. All cards are on the table. Our first big hurdle, though, is just getting the eyes on it, getting investors interested in, and getting to a resource stage. We want to prove that this is a big system with open mineralization. So I'm assuming that, well, I know for a fact that we'll never come out with a fully closed off resource. Our first resource that we will come out with will be open. It'll be open at depth. It'll be open along strike. It's just the way this system is. To properly drill this system, again, it's going to take a lot of drilling.
How many holes or how many more meters do you think you have to put into it before you have an answer to that question?
Within the 1 kilometer that we are looking at, and the 1 kilometer out of the 3, we're looking at about 45,000 meters all in.
Okay.
So we a lot of those meters start to add up, because the purpose of this first drill program was to verify the lower hanging fruit, was to test a lot of the shallower mineralization that we're seeing. But now that we know that everything's open at depth, and a lot of these drill sections are all the better holes are at depth in some of these sections. So we see that there's a much better reason to start drilling at depth now, and that's just going to consume a lot of the meters that we do have planned.
How long is that going to take you? The 40
2
something
years.
thousand meters.
Oh, if we're fully funded for it, 2 years.
Okay, so it's
It's
very
quick.
early stage still.
Yes.
Okay. The grades though that you've been getting, because you said you like them and be hard to replicate them or go above them. Is it too early to speculate, or just take them as a hypothetical? Would those be mineable? Like, can this become a mine again at the current grades? And do you maybe have examples of mines that are now mines but were drilling comparable grades and widths?
Yep. So one of the things with the nickel environment, and this is what I've learned from Mike, our VP, is that underground mining is typically 2%. 2% or higher, and that's what people are looking for. Whether it's over large widths, sometimes they'll do higher grade mining over 1 meter width or a 2 meter true width of mining, and that's at low nickel price environments. When your nickel price increases, obviously you can mine lower grades of nickel, and that's what we're starting to see now. So even forget the name. There's a couple mines globally that are mining underground at 1%. The Mount Keith mine in Australia had an average grade between 0.5 and 0.6%. It was an open pit mine, but still you can mine lower grade materials, lower grade nickel as open pit operations, a third of the percent that you go in for underground operations. But with the higher nickel price environment, your grades can be lower, and you can start making lower grades economic. All of our drill holes, except for 2, so I think it's 27 out of 29 drill holes, have all intersected over 1% nickel, and that starts to show that we've got continuity of what we consider to be high grade nickel. Actually, we consider anything above 0.8% to be high grade nickel, and it's quite continuous. So over the amount of drilling that we've done, a long strike at depth, we're consistently seeing over 1% nickel of variable widths.
When you say variable widths, is that true widths?
No, that's variable drill hole widths. So sometimes they're half a meter, sometimes they're 10 meters, 30 meters. It does vary, but most of those are well over 5 meters.
Okay, well, in true width.
No, in drill hole width.
Okay, in drill hole width, because that's the most important part, right? Eventually,
yes,
the true width.
True width. Yep.
Because what we've been seeing is obviously not too bad from what you've done, and what, just sort of to give a little bit of a background, looked it up. At the current prices, 1% nickel is give or take $260, if I'm not mistaken. So if it's closer to surface, you relate that to almost 5 grams gold. So
exactly.
So that's how I see it. I guess you're not really allowed to make that comparison, but that's how I relate the value of the rock for myself, just to make sense of it.
So we do as well.
Yeah. Well,
because if they can do it with gold, why can't we do it with nickel?
I don't know. You tell me, metallurgy, something. I don't know, Nickel. Is there a reason that you couldn't do it?
No, it's nickel sulfide. Like it's nickel sulfides are the easiest to extract from.
Okay. Would you? I guess I sound like a complete amateur because I am. But would you really hope to find the really good stuff here? Because you told me you're about 350 meters away from the historic mine. Are you going closer to it or further away from it?
As of right now, we have been going closer to it. We started in the middle, almost the middle of the 1 kilometer trend that we were initially looking at, where we established a historic mineralization envelope. So we started in the middle of that to define a lot of the structural controls and see what the mineralization is doing in that area. And yes, then the idea is still to continue working back towards the old mine workings. Once we get there, we'll probably even jump to the other side of the old mine working, but also we'll be going underneath it, and then underneath all of where we have just previously drilled. So it's pretty systematic drilling, and that once once we have this structural model complete for where we have drilled, so these not the 40 holes, but the 34 holes that have been drilled since the summer program, phase 2, that the density in there to construct a structural model of what is going on will be used to really enhance our exploration strategy, so that we can kind of get away from the whole pattern drilling and hopefully be able to better target mineralization that we suspect to occur at depths. As if once you start drilling deeper, you don't want to be systematic drilling unless you've got reason to do so. Again, building a resource is a great reason to do so for sure, but with any resource, you'd rather build up the higher grade, the larger tonnage sections first, and then leave the smaller bits to the end.
Okay. Does the community want you to do all of that? Like, are they're supportive? Are you talking to them?
They want us to continue drilling. They want us to continue hitting the widths and the grades that we've been releasing recently. They want to continue seeing success coming out of Manabridge.
Yeah. Okay. I was just thinking, you probably talk to investors, I would assume. So I was thinking about the feedback that you would be getting, given that, again, share price hasn't done too well, and I was thinking about the feedback that you're getting from them, and who's left. I mean, who are you still talking to from the early stage investors? Are the bigger investors still there, or who's still there?
Yeah, some of the bigger investors are still there. We've had some newer investors come in who really like nickel space and really like the results that we've been coming out with. So it is a mix.
Good stuff. I think I'm getting a better idea of what's going on. I'm definitely missing some stuff though. What am I missing? What else should we be talking about?
I think we've covered pretty well everything. Again, the big, the big hanging issue is the share price, and I think we've talked a lot about that. But like I said, it's not just Metal Energy. You can go look at the Canadian nickel stocks who aren't Canada Nickel or Can Nickel, whoever they are, and there's a lot of nickel companies who are all suffering the same situation. They come out with good results. I think our results are vastly superior to a lot of other companies, but there seems to be no love in the nickel space. I think it's going to take a company to come out with 10 meters at 5% or something crazy like that, which again, if you consider the GT of that, GT being 50, we've had better drill holes than that. But people just want to see these big fancy numbers. And the reality of the situation is that I think nickel price is going up because your nickel mines are running out. So you need to incentivize new nickel mining, and you're not going to do that at the current prices. You need higher nickel prices to incentivize a lot of these lower grade nickel operations across the globe.
Okay. What about First Nations? I didn't ask about that. I should have, but what's happening there?
We honestly don't have any First Nations to consult with on the project.
That's easy.
Yep.
Okay. Well, good for you. Thank you for this overview. Again, I think I'm out of questions. So I do appreciate you coming and teaching me a little bit more about the nickel market. I will be paying attention going forward. And yeah, again, thanks to the Orr Group, and thanks to Metal Energy.
Thanks a lot, Antonio. Always a pleasure.
Now, if you go to look at the price chart of nickel, though, you will notice that nickel didn't move as much as lithium did last year. And it's even given back some of those gains as well. So there hasn't been the same hype in nickel as we've seen in lithium either with companies. So I guess, is this an opportunity or is it a red flag to stay away from nickel? Well, having listened so far up the video, you're probably already getting it. But I have no idea what's going on most of the time. And this time it's not different because I guess it never really is. Right. But so instead, I've invited Mathias from Torck Capital, which is a Swiss-based hedge fund who focuses on investing in battery metals, to talk to me about nickel, but also cobalt and whatever else goes in these batteries. So let's play that clip on here. So Mathias, I just had a lithium analyst on the line, and he made the case for lithium look pretty compelling, so to say, and So I don't want to spend too much time on it, keep talking to you about it, but I'm wondering whether you're still bullish on it, given that it's gone, as we mentioned, 15x in the last 2 or so years. So are you still bullish on lithium?
Yes, we are still bullish on it because we think the demand for lithium will remain strong. The supply picture in the short and midterm still looks quite stretched. So there needs to be more mines coming on stream, actually. I guess there's still quite a bit of lack in projects. What we also see is that it takes those projects much longer than they expected. This trend still persists, although now, as you might have also seen, right, there's now this big investment of GM in Lithium Americas that might come to pass in the near future if they get the green light from the court to basically go ahead with Thacker Pass.
Right. When you look at the whole lithium space, though, and specifically the smaller companies, is it not giving you a little bit of cannabis 2017 type of vibes where everybody's changing their name? Like, is that not getting you a little worried as a money manager?
I mean, we see obviously this kind of staking rush and taking properties up in Canada. Mostly actually, interestingly, by Australian companies. There were a lot of Australian companies coming over and staking in Canada. Also, quite a bit of the investor base in these lithium companies is from Australia in terms of percentage. But I mean, this is kind of like what we see, this frenzy, right? But at the end, it will be probably the mid and large companies that are supposed to deliver this lithium to the market, and they will also most probably be the major recipients of all this government spending and industry spending that we expect to enter the industry in series over the next 2 or 3 years.
I know your fund specifically focuses on exploration and development companies. Is that also true for lithium, or are you focusing on some of the cash flow producers?
Well, actually, there we are still focused mostly on explorers or near-term developers. We have one larger company in Brazil that is going to production within the next 3 months, but that's basically the exception.
Okay. Well, that's lithium. Again, I don't want to spend too much time on it. I know that you guys, last time we spoke, you told me that you were bullish on nickel, and nickel has not ran as much as lithium. I mean, it did, like for a brief period for those 2 days early last year, right? Did that blip. Would you think that the risk reward is looking better for nickel than it does for lithium, given the relative performance between the two?
Well, I think it's kind of like if you invest in nickel, it will be one of the commodities that will run through the decade. So it's kind of the safer bet, but it's the larger market, so it's less explosive in that sense to the upside. But we think it's like if you look at copper, right? Copper, with what we see, there will be a much higher demand for both of them, right? And we also could presume that if lithium stays hot, obviously people will try to replace more and more lithium with other metals or minerals, and therefore we could expect also nickel to be used more.
That's interesting, because I spoke to Koby just a few moments ago, and he told me that lithium would not be as easily supplemented. But and we might. Well, I want to get to the substitution in a second here, but I think I might have jumped the gun. Can you maybe just give me your general sort of 40,000 foot view on nickel, where the market stands, where it might be headed in terms of supply and demand, and some of those hard numbers?
If we look at supply of demand, we see that probably the gap is getting worse towards the end of the decade, or in the middle, actually. We see not that many large projects coming on stream. We see also an issue that if the tensions worldwide rise more, there could be potentially, but not in the near term, maybe eventually sanctions on nickel from Russia, as an example. I mean, we already have a lot of other markets where sanctions are already in place, or people talk a bit about it, like uranium, right? Also, Indonesia is kind of keeping more and more of their own nickel within the country, as previously. They could also fall more on the Chinese influence. So you have a lot of things. If you have in nickel, you have 2 or 3 large kind of players, right? If you look at countries. So we would expect that it's getting tight outside of Russia and outside of Indonesia over the next years.
So just to make sure, the majority of the nickel supply comes from Indonesia and Russia, right? Indonesia supplies something like 40%, if I'm not mistaken.
Yeah.
Okay. Is there also like bifurcation in the nickel market, like it is, brewing for uranium? Like, do nickel buyers in the West, do they care where their nickel comes from, or would they just buy it no matter what?
Well, I guess eventually they will have to care, right? I would say so. I mean, obviously for high-end nickel, Russia is very dominant, right? As a market player. There are not that many substitutes, but we see there the trend as well that people are thinking more and more. I mean, you see it in Sudbury, right? There are now a couple of companies that try to ramp up nickel production. Of course, not on size, but at least to restart it in Sudbury.
There's the chemical quality of these metals that we talk about, and then you also have the political correctiveness of the metals that also seems to matter, right?
Yeah, I guess the political, especially in Europe, the political correctness of the origin will become more and more important, I would say.
Do you expect Europe to be doing more efforts for domestic production over here, and would that be an interesting place to invest in?
I mean, we see some initiatives, right, in the Nordics where there was historical production. Companies that working on projects in Sweden or exploration in Sweden and Finland, where there is potential, right?
Yeah.
And historically there was quite a substantial mining. So yes, I see that, and you see that as well in the behavior of Sweden actually currently, also towards let's say uranium, that they see to get less reliant on Russia, that they might lift the ban on mining in uranium. So yes, this will be a trend that we expect to be much stronger over the next 1 or 2 years.
But you do expect, say, Canadian nickel and European nickel to be seen as the better option for the buyer, like they would be ready to pay a premium for that nickel.
I would expect that, yeah. Or, I mean, either expect it or that they will be forced to do it, right? At a certain point.
Oh yeah, like you mean like government mandates or whatever?
Yeah, or put taxes on it or whatever to make it more difficult, right?
Yeah, that's been the playbook for many other things, actually.
Yeah, exactly. Yeah, so if you look at it from the 40,000-foot view, yes, then you would say the playbook that is currently applied to other commodities, in our opinion, will also eventually come to nickel. I guess it's just not yet happening because it's too much yet of the market and you have not enough substitutes yet.
How much does it cost to produce nickel? And maybe you can also talk to me what the price difference is between the East and the West in terms of production cost.
That's actually something we never studied in detail.
Because I guess that might also be a thing, because you want the before you jump into the investment, I guess you want the metal not to be trading far above the marginal cost of production. But if the marginal cost of production in the West is much higher, which I would assume it is, and you expect the demand in the West to be higher, then the price might have to stay higher, if I'm making any sense here.
Yeah, you make complete sense, right? We didn't usually, when we do this type of analysis, we don't look at too much at the minor numbers, but rather at the larger picture, right? And yes, obviously, I mean, there's a reason why most of the let's say the easier nickel is coming from Indonesia and why most of the more quality one is coming from Russia. And yes, it has to do with cost, right? I mean, that was the big picture over the last 20 years. Usually you sourced worldwide the cheapest supplier on any given level of quality of input. And this is actually something that people, I guess, not yet really understand in full, that this is the one we expect this trend to reverse because of the global tensions. No longer any supplier will be accessible to everybody on the world.
That would make sense.
Yeah.
Indonesia, though, because you mentioned Indonesia, I'm reminded of it. They, you know, what they did last year is that they ramped up their production in anticipation of more demand coming. They've also been, they've just been very active on the battery metals front. Like they've been pushing left and right to maybe create a battery metals cartel, as they call it. They also want to get more of the supply chain within their country, right? They want to have the refiners and the battery producers within their country as well. How much of a threat do you think that is to the nickel market? Like if they ramped up production a lot more, like could that happen? Would that influence the market a lot? How do you look at it?
Well, obviously it would influence the market, right? If a larger player starts to ramp up the production. But on the other hand, I mean, there's one thing to say that they will. And then the second point is, can they actually do it, right? And what we have seen over the last 2 years is a lot of people that were supposed to, or companies that were supposed to ramp up the production had a lot of difficulties to actually do it. They either couldn't get the supplies or they couldn't get the manpower to actually do it, right? So, or not on the size they wanted, actually. So our view on it is actually, we in general think that the industry is overstating or too optimistic on what they can deliver, right? But that goes across industries, right? It's not a specific nickel specific scene.
Yeah, especially when it comes down to labor shortages, right? You see that all over the place. And also when it's now it's getting harder and harder to discover economical ore deposits. And so you need even better skills, but we are lacking skills. So our skills are going backwards, but the difficulty of the job is going up. So the gap becomes even harder. That's a good point that you make.
Yes. And also if you look at it, right, if all these projections about demand are coming through, then there's just a huge hole in front of us, right? That cannot easily be filled, right? And people really underestimate what happened the last 10 years. There wasn't really a lot of investment in mining. And you see it right now as well, right? A lot of these larger projects that actually can make a real contribution to resolve the issue. A lot of these companies are still waiting for either the big strategic investor that sends a lot of money or takes a huge offtake, or they wait for government money, right? Because the capex is increasing as well in this inflationary environment that we are in right now. And on the other side, you have a lot of traditional financiers that are getting more and more reluctant to invest in mining.
I'm glad that you brought up demand there for a second, because as I said earlier, I spoke to the lithium analyst Koby, and he told me that while batteries can change if the prices go too high, you know, cure for high prices, what he says. He said that lithium remains a crucial part of all of them because of its chemical properties of being one of the lightest elements and the lightest metal, I guess. Now that's not necessarily the case for nickel, though. So what are the chances for nickel demand to be disrupted by innovation in the space? Like, could that happen?
I guess you cannot rule it out, right? And with a lot of those substitutions questions, in most of the cases, I would expect that just the percentage amount within the battery goes down, right? Instead of that it gets out completely of the battery. Because as the colleague said, it's each of these metals or minerals has specific qualities, and a certain amount of it might still be needed, right?
Right. Is nickel like lithium in the sense that lithium is not only an electric vehicles metal, it's a battery metal, meaning other types of batteries as well. Is that true for nickel as well?
Yes, you can also use it for other let's say, use cases. And we expect anyway that the general use case I guess the use case at the moment is way too much focused on the electric vehicles, right? I mean, it will be a large driver, but I guess the other topic that we see in a broader picture is the storage of electricity and the distribution of electricity will also become much more important over the next couple of years.
You mean like grid storage, stuff like that?
Yes, absolutely. I mean, this is already a huge problem in Germany, right? If they have a large production in the north with the wind power, they cannot bring it in the south. So they can have a huge surplus in the north and a deficit in the south and cannot bridge it, right? And this traditional means within the grids of storage, there are not that many, right? Usually it's a lake and a hydroelectric storage, as it's called, right? That does the storage, but if we put more and more stuff on the grids with the vehicles that need to be loaded, usually at the same time, probably overnight, then there needs to be really a huge investment in on one side in storage, and then on the other side in the grid and the distribution within the grid.
Do you also look at China and then now reopening as a potential demand driver as well? Because I guess nickel is used in stainless steel and so building and whatnot, right?
Yes. With regards to China, we think it's overestimated the impact in the short term, but will be a contributor, let's say, starting second half of this year.
But the other side of that coin is that if there's economic trouble, then the demand for stainless steel will then drop, and that would negatively impact the nickel market. Is that true as well?
Yes. Yeah.
I'm just trying to identify what sort of the risks are to nickel, because it's a lot more obscure to me, even though it is a larger market than stuff like, uranium, stuff that I've been paying attention to.
Yeah.
What are some of the downsides that you're looking at? Like, you've got the substitution that we talked about. You have a potential economic downturn. What else are you looking at for potential downsides?
It's really like the economy. The economy is the largest downside thing, I would say, by far, because it's as we said, right? It's a well-established market, so it's less reliant on kind of trends that are within the investment scene.
Okay. So that's nickel. You're also exposed to lithium, as we just said. In terms of other battery metals, last time you and I spoke, you told me you guys are also invested in cobalt and graphite. That was sort of your 4 battery metals that you were looking at. Is that still the case, or are you still in all of those, or have you exited?
No, we are still in all of those. We reduced our exposure to copper because we still expect shortness, or let's say weakness in the short time frame. On graphite, actually, we are getting more and more bullish, to call it that way. I guess most of the people underestimate how much graphite is within a battery. So they think it's actually less than it is, right?
What is it, some 30%, something like that? I looked into it recently.
Yeah, it can be even more. It depends a little bit on the type of battery. And therefore, and this is also kind of an even smaller market, where we see that projects with very few exceptions actually have a hard time to find the financing. So that could be, in our opinion, I mean, I wouldn't say it does the 50x than lithium did, right? I mean, it's a different. There's enough graphite and around of the world, but we could also expect there's something around within the next 2 or 3 years, just because of on one side lack of investment, and on the other side ramping up of the use of it, right?
Right. Cobalt is also an interesting one to me, because I think that's I think that must be the battery metal that I know the least about. But the price chart, at least when I look at it, it looks interesting in that it's cobalt's basically given all the gains that it made in 2021 and 2022. It's given those back already. And so maybe you can give me that sort of the high level supply and demand picture for cobalt as well as what's happening in that market. Because, you know, if I look at lithium, it's close to its all-time high. I look at cobalt, it's not that high. So I'm getting a little bit interested there. But so maybe you can talk to me about that.
Well, on cobalt, it's actually, this is one of the metals where you see that people struggle the most to replace it, right? It has very specific properties that help the usage, but it usually has also the issue with the ESG the most, like because a lot of it is coming from the Congo, and also it's also very concentrated globally, right? So if you are a larger investor, let's say an electronic vehicle automaker, you obviously don't want to be reliant too much on one area of the world.
But if you have a cobalt project in the West, that probably increases your value because you're not dealing with, you know, allegedly child labor and stuff like that.
Yes, exactly. I guess this is the bigger picture, right? That we see talks about that either zero carbon metals or products that are, you know, produced like this or as close as possible will demand a premium in the future. And we expect that as well for supply that is, let's say, as ESG conform as possible, right?
Right. Yeah, that's like you said with nickel and all that. Why not the other battery metals though? There's other stuff in a battery too, right? There's manganese, there's what else may have you. Why did you pick those for?
Well, manganese, we actually looked at it, and it was very hard to find really pure manganese investment vehicles or companies, right, that are focused solely on that. So it made it very hard to be investable. I mean, also we already struggle a bit with graphite because a lot of the graphite producers have a market cap below 1 billion or even a couple of 100 million, right?
But still, there's other things in there, like what do you have? Well, obviously steel, iron, aluminum, some of the bigger metals, you know, quite liquid markets. There's also, I mean, there are other demand drivers for them besides electric vehicles, but there's still a lot of aluminum in an electric vehicle battery. I think some 20% or something. So have you looked into those as well?
No, because as we discussed before, right, we focus on more niche markets in our investment thesis, right? And aluminium is obviously a large one. We add the nickel and copper just because it really fits well the theme, and you can have dedicated companies to either explore or develop projects in that area.
That's a good point. Yeah.
Below a certain market size, right?
Yeah, that's true. So you stay where your circle of competence is, I guess, and what your strategy is. That makes sense. That makes sense. Well, I don't think I have any other questions about nickel or cobalt. Is there something that I'm forgetting to ask you, though?
No, I think we actually broadly touched on it. Yeah.
Okay. Well, thanks a lot for investing in time with me, and thanks for communicating it so clearly.
Thank you, Antonio, for the opportunity to share our view on it.
All right, we're almost at the end here of Ore Day, but it would be a crime to end Ore Day before having addressed the most hated pet metal out there, which of course is gold. And given that I've been told, you know, $10,000 gold is coming any day now for the last 3 years, I have a few questions about what exactly is happening with gold. So I'm going to be asking those questions to Robbert Sinn, also known as Goldfinger on CEO.ca, in which he explains to me what is currently happening with gold and where it's headed, but from like a fundamental and also a technical standpoint, like combination of both. But before we do that, we'll have to hear from the boss again. He is the one paying the bills after all. And he likes talking about Orefinders, I guess, because this is one of his favorite children, although I don't imagine his wife would be extremely happy to hear all that. But yeah, here's Stephen talking about Orefinders. All right, Steve, you're back here again to talk about Orefinders. I guess this is one of your darlings. Well, I mean, all of them are your darlings, right? All of them, like
they're all my children, and they're all my children. But Orefinders is my first child, so it is special, and I do feel like I owe it something. And I think a lot of our ore group companies do owe it something. It was the mothership. And I think that's something that we're going to, and I think 2023 followers of Orefinders in the Ore Group can expect us to formalize that a little bit more and take that to the next level. Well, at the same time, obviously, maintaining our exploration portfolio, which is extensive, certainly in the Kirkland Lake area with our Agnico deal, but then in 2022, shareholders will have seen we've expanded into Quebec with a copper gold project called the Grizzly, and we expanded into Alberta into the GSL zinc project. So it's really Orefinders has evolved into a diversified exploration and development parent company, and it's got a lot. It's well capitalized. It's got great shareholders with Agnico, Eric Sprott. Myself, I'm a big shareholder, and I have big plans for Orefinders, no question about it.
But the exploration assets that you have there, are those going to still remain the focus? Do you have any plans of, I don't know, spinning them off or something else among those lines?
No, not per se. So, just so for clarity, the core of our exploration assets and where Orefinders really started, its business was in the Kirkland Lake camp, and it has 3 assets. It's got the Morado, it's got the McGarry, and it's got the Knight project. And so that is the core group of assets, and those are the assets that Agnico Eagle, or at the time Kirkland Lake, and now of course Agnico Eagle, took interest in, and of course we did a $60 million deal that would see them earn 75% over a 10-year period. We're just about to enter into the 3rd year period of that. I think that begins in April, and in addition to that, they took a 9.9% interest in the company, in the shares. So they have a claim on our projects. They've earned it 0 to date, so they still have to spend another $7.5 million over the next 3 years to earn 50%, and then subsequent to that, they have to spend $50 million to take it up to 75%, and then we're joint venture partners. And so that's been the core. That nothing will change on that from our perspective. Anything can change at any point in time from Agnico's perspective. They may or may not choose to continue with that agreement. That's their right. So it's an earn-in. There's no long-term obligation. But any way you slice it, I'm happy. I'm very thrilled to have Agnico as a partner. They're great Canadian success story, one of the best operators in the business. But I'm also very happy to own these assets again. So who knows what happens in this industry? And as you said, as I sort of said before, we've also diversified. So as a result of those deals, when we signed those deals, Orefinders, who had a lot of cash at the time, and Orefinders right now has $5.5 million in cash and $8.5 million in working capital, and those numbers will be published on our annuals, just coming out in March, early March, so investors can see how strong we are financially. But my point was, when Agnico took interest in those projects, it made absolutely no sense for Orefinders treasury dollars to be invested in the Kirkland Lake portfolio, because that the investment there is for Agnico to make. So why would Orefinders shareholders be investing for Agnico's benefit? They've got $60 million to spend there. So the challenge became, how do we evolve this business? What do we do? And so you'll see we started to invest in Quebec. I'm a big fan of Quebec, big fan of the Chibougamau area. The thesis there is really about QC Copper, and we're convinced that it's going to be building a mill at its Opemiska project, which is going to totally transform the Chibougamau district. There's a lot of, call it, orphan assets there. So if you own a deposit that is not necessarily big enough to support a mill, it still will have value if you got the mill at Opemiska. So that's why you'll see both Orefinders and Mistango have made investments in the Chibougamau area, just like we did with Kirkland Lake. We originally tried to and continue to have interest in consolidating that district. It makes sense. There's too many juniors. The properties are too fragmented to bring it all under one roof, to evaluate things from a 30,000-foot context, and then allocate capital to the best targets possible, and then test a few different targets, and then something sticks. Also, I think when you consolidate, all else equal, bigger is better in mining. It allows you to raise capital more effectively, under one umbrella, as opposed to multiple fragmented companies or projects. And last, we like to consolidate our interests either in Chibougamau or Quebec because we have intellectual property of the geology. So we become experts there. We have physical facilities which we can leverage. A lot of companies have projects and they have to set up a camp, or they don't have local contacts, etc. So we really like to double down on particular areas that we know and have operations, and we have people there. So that's been part of the strategy. And of course, Orefinders, as a result of its being the first baby of the Ore Group, was often the mothership, and it spun off QC Copper and Gold and maintains a 5 million share position there. It spun off American Eagle Gold and maintains a 5 million share position in it, and it subsequently made another investment, a very creative investment at the tail end of 2022, which saw it earn a 20% interest in the project of NAC. And so effectively, I mean, it was a fancy structured deal, but effectively it was a loan to American Eagle, who was having at the time a terrible share price. And Orefinders had some flow through it. It wanted to reallocate, so we had a creative structure. And Orefinders is going to get back 50% on its investment from American Eagle, and American Eagle didn't have to dilute it 2 cents. It's gonna get to do it at 15, 20, 50, maybe. We'll see. So that's the flexibility that Orefinders has given some of the Ore Group companies, and I think that, as I was saying before, I alluded to before, Orefinders, I think in the not too distant future, our shareholders are going to learn more about our plans to evolve and more formalize Orefinders as sort of to formalize it almost as the Ore Group in itself and become the mothership, because it already does own these 3 positions in Mistango. It owns 25 million shares of Mistango, and as I already said, 5 million each of American Eagle and QC Copper. And so I think that over the years we've learned how to be creative, and I think it would be very sensible for us to formalize that structure and also incubate more deals. That's something that I think Orefinders shareholders should expect. And I should also note that part of when Orefinders did create those spinoffs, it not only did it retain, those shares for its balance sheet, but it dividended the other 5 million out directly to shareholders. So, I mean, we are one of the few juniors who have actually had 2 dividends. And I'll note that, everybody gets concerned about tax costs. We structured it so there's a 0 tax cost based on your dividend. So, I mean, I think that's, again, just speaks to the creative nature of our group of trying to create value in different ways. Orefinders right now is totally, in my opinion, overlooked and undervalued, which is probably a common theme amongst CEOs these days. But when you look at its balance sheet, it's trading basically at cash. Meanwhile, it's got a whole wealth of things going on, notwithstanding the Agnico situation. And of course, in this industry, one drill hole can change everything real quick. And I think that the Ore Group has shown it's not afraid to drill. We've spent, I haven't even counted the meters and the dollars we've spent in the last 2 years, but we've been aggressive, if nothing else, in terms of moving things forward, because I think that will be the secret of our success is ultimately to never stop drilling, but do so intelligently, always with an eye on our cost of capital and how the market receives such results. We've been in the last 6 to maybe 12 months in a situation where unless you deliver exceptionally eye-popping results, the market will, use the opportunity to sell, and which is unfortunate because ultimately on a long-term sustained basis, that's a recipe for bankruptcy, right? So sometimes you got to rein it in. I mean, if you're going to continue to drill and deliver good results and you get sold off, the math is not favorable on the long-term basis. And on the short-term basis, you can sustain, even if you're making the argument that you continue to develop the project and grow it and grow your understanding. And there will be a time. And of course, unless you're in lithium lately, but I think, that's not a model that we subscribe to. I mean, not that I'm against lithium, but we don't chase those sorts of very, very frothy and flavors du jour, which we've seen time and time again in this industry. We try and stick to, again, a very sound investment thesis on the particular commodity, stick to jurisdictions we know and we trust, and move things forward slowly but surely. This is not, while things, as I said, things can change on a dime with a drill hole. We've seen that many, many times. But that aside, and that is few and far between. That aside, this is a patient person's business where I think shareholders really need to focus in on the individuals behind. So again, the people, and people tend to pick good projects, and good people don't throw good money after bad on bad projects. We always look to fail fast if we're going to fail, and move on. And then, of course, capital. You have to have the capital to pay these good people, and to pay your drillers, and to make investments in the property, which hopefully are accretive.
A lot to talk about there. I'm just a little bit disappointed to hear that you're not going to spin off molybdenum finders or lithium finders off of this. But
never say never, Antonio. But look, I'm a believer in these metals, molybdenum and lithium. Lithium's has a place. I just think it doesn't have a place for my investment in this frothiness. I'm more of a short lithium, long gold person right now. I do think that all of the commodities that the ore group has exposure to, uranium, which I know you love, and me too, nickel, copper, gold, even now zinc, even though we haven't found zinc yet, but we're looking for zinc. I think all of those commodities will have their uranium or their lithium moment. There are frenzies, they ebb and flow. This industry is cyclical, and there are macro themes that trickle down and incent people like me and my colleagues to chase after them. And once you get these sort of discoveries, like we saw in the 90s with the diamonds and various gold rushes, we've seen it before, and I expect the same going forward. But again, the idea is to sell into those rushes, and buy copper when it's $2, buy uranium when it's $19, buy gold when it dips below 1,800, which we're probably going to see in the not too distant future, and then be patient. Patience is required. I mean, everybody's got a different strategy. You can, I'm not a trader. I'm a terrible stock picker, a terrible trader. We are investors, and we take long-term views. When you sit in the CEO and you have you're the owners of the assets, not just the owners of the shares. You're owner of the assets. You have to take long-term views. You're married to this thing, so you can't get in and out in 1 day or 30 days. So, it's a recipe for career failure if we don't really believe in what we're doing.
Let's talk more specifically about what you've got going on with Orefinders, which is, I wrote down 4 points to talk about. It's basically the cash, your Agnico deal, your other assets, and eventually, or even before that, talking about Grizzly and what's happening there. The cash, you have you just told me $5 million on the balance sheet. What's that going to be spent on in 2023? Is it all going to be spent in 2023?
No, I don't think it'll all be spent on 2023. Well, we certainly haven't allocated it necessarily, certainly not to exploration. At this point in time, obviously we're going to be developing based on results off our Grizzly. We've got, I think we got about 3,500 meters, which are in the pipeline to be released, sort of any day now. Depending on those results, we'll continue to invest there. Same thing with our zinc project, GSL Zinc, which is really a generative project that was thought of in-house by Charles Beaudry, who's had this project in his mind for a long time, and we staked it. And we're looking for, like, zinc isn't necessarily something that is sexy. It's not very marketable, and very few people understand it. And so, I've looked at zinc many times over the years, and there's dozens, scores of zinc projects we could have acquired, and I just said, no, thank you. So, the only reason I'm interested in zinc, if we're going to chase something big, you have to have something that stands out, something that's really exceptional. We're looking for a SEDEX deposit, in an area that nobody's really looking. It's in the Great Slave Lake area of northern Alberta, and Charles convinced. Charles, to me, Charles is brilliant in his interpretation of geology. He's really a geological data scientist, and has great ideas, and is oftentimes wrong, because that's just the way it is, and the only way you can test these things is by drilling. And so Charles convinced me that $500,000 to $750,000 will test this, and either we're right or we're wrong. And when we're chasing significant deposits, I don't want to say tier one or whatever it is, but deposits of significance, because that's sort of the style of deposit that SEDEX tend to be. That's a risk reward that I'm willing to take. So we like those high risk, high reward opportunities, provided they are sound, and they are sound. And if you go on our website, you'll see a very technical, detailed explanation of why. It's not just, hey, let's stake some ground and maybe we'll hit some zinc. No, there's a lot of publicly available data. It's a geochem trail we're chasing. I won't get into the details of it, but it just sort of speaks to the types of investments that Orefinders makes. And if we don't make it, well, so be it. It wouldn't be the first time we spent $500,000 on a drill program that didn't yield anything. I mean, that's just anybody who's been doing this long enough would say the same thing. And again, $500,000 in the context of things is not a significant investment. So, but that's something we've been waiting on permits there. So that's something that we were hoping to get them, in January. They still haven't come through. So permitting in Alberta is a little bit slower than you'd anticipate, given it's obviously maturity in the extractive industry, although it's obviously oil and gas. You don't see a lot of hard rock opportunities in Alberta. But I think that's changing. I actually spoke to the province, and they're looking to invest heavily in hard rock, specifically lithium, and also the brine aspects on direct lithium extraction, which is something that really interests me. And then I think in terms of Orefinders going forward, I think again we're going to shift our focus, not shift our focus, but increase our focus towards being a more investment focused in terms of maybe supporting some ore group companies, but really incubating new opportunities. And maybe even doing a little bit of, dare I say, activist investment, which we've done in the past. We did that with Mistango. We did it successfully. There's an awful lot of opportunities in this industry to create value by making small changes, but those small changes are hard to come by. And oftentimes those small changes I'm referring to involves removing management, removing the board. So if you can acquire significant block positions in companies quickly by approaching, a large shareholder who is frustrated with the lack of activity and the lack of management, get in there and then force a takeover, which is a complex and risky transaction, but no more risky than a drill program, right? So it's probably less risky than certainly than a grassroots discovery if planned, coordinated, and financed correctly. So I think there's a wealth of opportunity there to sort of look at a $5 million, $10 million company that with a small change could be a $20, $30, $40, $50 million company, and then drive value there. I mean, that's exploration and discovery in a whole new different context. So that interests me, and I think people can expect maybe some activity on Orefinders front in that perspective in 2023 and beyond.
You just mentioned Grizzly, and you said any day now. Is it too much to ask you to define any day?
No, I can't. If I knew, I'd tell you. It's as simple as that. I've been struggling ever since COVID. The labs have been, very unpredictable. When I say any day now, it could be 2 weeks, it could be a month, really. I mean, the truth is, I just don't know. But they should be expected shortly. We finished drilling towards the end of December. I think we shut down just before the Christmas holiday, and they are due.
Mm-hmm. What are you hoping to see there? I guess we all have
something. I mean, there was a little bit about Grizzly. It's northwest of Chappé, where the Chibougamau project is. Again, it was generated by our team out of Chappé, which is led by Charles and Denis and Francois. And this project had some historical drilling. There's really two aspects of it. There's vein that had shallow drilling. We've tested it underneath to sort of test the continuity, along dip and strike. And there was also a porphyry style target, which is sort of completely separate and distinct, that we drill tested to see what orientation it is, and if there's a particular orientation, it's of interest to us. But obviously, if we can hit great copper gold mineralization, it's of interest to us. But again, it's really this is pretty grassroots. So we certainly didn't bet the farm on it. The program was modest, but it was we acquired it at fairly attractive terms, deferred any real expenditures on it for the long term, so we can dip our toe into the water. That's what we like to do, is dip our toe, test these things, and as I said, fail quickly if that's the case. But it's in the right postal code. Again, it falls in line with our thesis of being in the Chibougamau area. If we can even find something that's modest, it becomes significantly more valuable once QC Copper convinces the world, and I believe it will, but once QC Copper convinces the world that there's going to be a sizable mill at the Opemiska, that whole district will open up. So we're really leveraging our, contacts, our ore group platform in that particular area. People ask me, why didn't I put that investment into QC Copper directly? Well, the answer is very simple. QC Copper has a cost of capital, and its cost of capital is not in parallel with investing in earlier stage grassroots projects. All else equal, QC Copper can drill that marginal meter and put it into a known, a better defined target that's going to go into that mill. Whereas Orefinders has higher risk type potential and potentially, with, as we discussed, higher potential rewards.
But the drill programs are going to remain focused on Grizzly, or do you have anything else sort of at the back of your mind?
We got all sorts of ideas cooking, and our level of interest in Grizzly depends solely on our level of success, or if we have something that we've learned that we believe has a follow-up. So I think it's too early to say how much more we will invest in Grizzly. We have to see those results. We're absolutely going to invest in the GSL zinc project, as discussed. It's a relatively simple program, low cost, easy to execute, and I don't want to say binary. Nothing's quite binary in this industry, but I think our thesis will be well tested. We see an awful lot of deal flow, so people could potentially see more opportunities on a project level. But again, I think Orefinders is also going to be allocating its capital towards incubation of new opportunities, so that it'll own more than just 5 million shares of QC Copper, 5 million of American Eagle, and 25 of Mistango. So I think we have the opportunity to create new companies that are backed by new people, and guide it through the going public process, and where Orefinders can co-invest and participate. So it's just a different way of participating in exploration and discovery. And so, as opposed to the drill bit, it can do so at the incubation or at the equity participation level. So it just diversified. So again, Orefinders is diversified strategy, diversified exposure to commodity, strong balance sheet, and I'm 100% behind it myself for what that's worth.
Yeah, it doesn't seem like something you hear every day. Is there any comparables or someone you're looking up to in the sector that you can talk to me about?
Well, I look up to a lot of people, but no, I think that it is sort of unique, and it wasn't necessarily the master plan when Orefinders was born almost 10 years ago, if you can believe it. And it has evolved, and it wasn't, it evolved. The Orefinders, and again, I was a part of its creation, but I wasn't driving the bus when it was born. I took it over when the previous CEO, who was a really great geologist, but were facing a tough time. We had a half-penny stock, and we had, I think, 200,000 in the bank, and basically, kind of like activism, I removed that individual and ultimately replaced him and transformed the company away from just almost drilling blindly, irrespective of the cost of capital, which we discussed before. You have to be cautious of that. And we tried a different approach, and that approach has evolved into spinning off. The first spin-off we had was QC Copper, which was, to me, a huge success, which is still evolving. And I think, QC Copper is a really fantastic opportunity, which speaks to finding an asset. And we originally tried to put it in Orefinders. So as I said, like that was, Orefinders wanted to take it over, but the vendors of the project wanted a sole dedicated vehicle. And so, we looked around and said, okay, well, I think we can do that. And that's how QC Copper was born. And the idea is, well, how can we get, Orefinders to participate and benefit? And when I say Orefinders, I mean, it's shareholders, while at the same time streamlining that process. So we did a plan of arrangement, which is just a fancy way of saying a spinoff, that allowed Orefinders to make a modest investment, which has turned out to be quite good, which resulted in 5 million shares being dividended out to its shareholders. And, those 5 million shares that Orefinders kept on its balance sheet remain there to this day. We are convinced that QC Copper is going to be a big success. It's going to be a mine. And I think those 5 million shares are going to continue to bear fruit for the company. And then we'll monetize it like everything. So like the Ore Group of companies has equity investments in its own sort of, call it peer sister companies. It also has equity investments in people who are completely arm's length. Every equity investment is ultimately meant to be monetized when the time is right, but patience is required and timing is everything.
Because you're mentioning your arm's length companies, and I'm just constantly thinking about that Agnico deal, because I guess it's the elephant in the room, right? And on your last update, I saw that they've been investing. I mean, it said they've been investing the minimum that they had to invest to keep the option going. Are they investing at the pace and at the size that you expected them to, or would you like 100%. To see more?
Do you pay any more taxes than you're required to? I mean, it's like, they are contractually obligated to pay. I think they're in years 1 and 2, they were contractually obligated to pay $2.5 million, $1 million in the first year, 1.5 in the second year. I wish they spent all $60 million in year 1, but I'm not that good of a negotiator. This year in year 3, it ramps up quite significantly. There's $7.5 million due over the next 3 years, so that's 2.5 each year. So Agnico has made their commitments and they're good partners. Unless we had, and frankly, we hadn't yet had the results that I had hoping for. That said, we really approached it in terms of a discovery. I mean, we are in the Kirkland Lake camp, and we could have put layups through, like we could have done cheap holes, as I call them. We've chosen to try and find something new in the area. We are absolutely convinced. I am convinced that in that area where Orefinders and Mistango have their core assets, the Kirkland Lake portfolio, there is another Macassa, or there is another Kerr Addison, which is yet to be found. And so that has been our approach. It hasn't been about taking the existing resources that each of those companies have and trying necessarily to expand it. Sure, maybe in some instances we put some holes there looking to sort of test down dip or extensions, but really we have been focused on something new. There's secondary and tertiary order structures. So I mean, the main show is the Cadillac break, okay, just for simplistic purposes, and that runs east to west and goes all the way to Quebec, and that has produced countless tens of millions of ounces. But really, I mean, the second and third order structures, so splays, secondary faults that come off there, are often gold bearing. The South Mine Complex, which they're mining in Macassa, that is not a primary structure. That is a secondary or maybe even a tertiary structure. So that has been our approach, which is higher risk, but again, higher reward. So, because oftentimes I feel that just sort of extending, trying to take something that's 500,000 ounces and turning it into 700,000 ounces isn't really all that sexy unless it's super frothy. 700,000 ounces, even 1 million ounces these days isn't necessarily, unless it's of a significant grade, unless you can demonstrate the margins are there. It's just sort of, getting bigger and, but you're a long way from becoming economic. And there's a time and a place for that, of course. But really, when you're in an area as fertile as Kirkland Lake and that break system, as I've said before, one drill hole can change everything. And again, there is another ore body there, but it's really hard to find. That I can tell you.
I was just wondering how the communication goes with a $20 billion company that Agnico is, something like those. It's just a humongous company, and how your conversation goes. I mean, and the type of leverage that you have over them. I mean, what are they telling you? What can you tell me about your guys' conversation?
Sure. Well, I think, first we signed the deal with Kirkland Lake, and that was as a result of a relationship I had with Tony McCooch, who was, of course, the CEO there. Tony's a great guy and had followed our projects very closely. We are around the Macassa, and so that sort of got their interest. And I just walked into Tony's office and I said, let's do a deal. And it took a little while after that, but that's ultimately how it was done. And then when Agnico took them over, obviously there was a transition and there was sort of new faces to talk to. And I got to say, and I do have relationships as well with the Agnico with Sean and Amar. I'm fortunate enough to be involved with the chairman of the Young Mining Professionals Group, which has given me entree to the likes of the top brass at not just Agnico, but companies globally. I've always said it's been the single best thing I've ever done for my career. Not that's why I did it, but it did give me entree to C-level brass at $20 billion companies, and also my peers. But nonetheless, so I do have those relationships, which doesn't necessarily get you anything, but certainly doesn't hurt. And they're not the people I necessarily communicate with on a day-to-day basis. Those guys are far too busy dealing with $60 million deals, which is small for them. So I deal with I won't name their names necessarily, but they're a senior vice president, a guy by the name of Guy, very sophisticated, knows the projects, and we communicate. And they know exactly where we are. They have a very clear vision on that camp. So not only do they have the Macassa, which is been mined for decades and will be mined for decades, but they also have the Upper Canada / Upper Beaver, which is on the eastern side of the camp, closer to where the Omega and the McGarry projects are, where the Keratison was, and that's been a project that Agnico has been fostering for quite some time. They acquired it out of Charlie Page's company. The name escapes me, but for those who follow that camp, they'll know it very well. And so there's really two areas of focus. There's the Macassa on the west side of the camp, and there's the Upper Canada and the Upper Beaver on the east side. And then, of course, you got the Keratison, which is currently has been reinterpreted into about a 6 million ounce 1 gram deposit. So there's and then of course there's a big deal that was announced just the other day with another junior in the area that's getting a $10 million injection. So I can tell you there's an awful lot going in this camp. I can tell you that Agnico Eagle has real interest in this camp and is going to be developing additional mines. Whether that is I think it's just a matter of time before the Upper Canada Upper Beaver becomes a mine. Maybe they take a run at the Keratison. And all of our projects within Orefinders and Mistango are feed. Okay, so they do have real ounces in the grounds. Many of these have been producers in the past, and we do believe they will be producers again. Currently, they are not large enough onto themselves as they're currently known to justify a mill. But when you put, just like we're doing at Okemisk and QC, when you put a mill there, everything changes, and then you don't have to bear the cost of capex, which is significant. So that's why this area, our assets, which are plentiful, well located, are very strategic, and will be very valuable as this district evolves and new mines. And I do believe that new mines will be developed there, particularly on the east side. So I think we're well positioned no matter what happens. Patience is required because these things do take time and there are lots of twists. But we own these assets. And so they're not going anywhere until value is realized.
I'm sitting here listening to you, and I'm reminded of a conversation that I had before we started shooting with my wife. She was like, how long are these interviews going to go on for? Because it's plenty of interviews we're doing here. I was like, it's going to be a long day, but it's okay. And she's like, well, you work so hard. And I was like, if you talk to Stephen Stewart, he works hard. So I just cannot understand, what about your workloads? You're doing these 6 companies under your belt. You're doing the young mining professionals. You're on conferences all around the globe, meeting investors, raising capital. You've got a kid, if I'm not. Do you ever sleep? Like, how do you do all this?
You mentioned I have a daughter. I do, and I'm married, and I'm family first. So nothing comes before my family.
And you have 2 dogs.
And I do have 2 dogs, who are sort of my little fur babies. But no, family first. I do work a lot, but I love what I do. I feel, though I have some tough days, believe me, I have some days where I feel like I'm kicked in the gut. I wake up and I get to do this. I don't really need to work. I'm not, I'm certainly not wealthy where I can, fly off to the Bahamas and live a fat life there. But I've done well. I'm comfortable. I choose to do this. And if I didn't do this, I would be bored and I would drive my wife crazy, even though, she probably would like to see a little bit more of me. If she did, she'd probably say, you should go back to work. I think that I love working with my team, my people. When I look, and that's why I like working, is because, I get to do what I want to do. Nobody really gets to tell me what to do, even though, my shareholders do, like I listen to shareholders and they ultimately get to tell me what I got to do, but I don't do everything they say. So I take with what they, I take their feedback, and sometimes I agree or disagree, but ultimately I'm my own boss. I work with people I like, and I get to do deals. I love to evaluate opportunities, get into the nitty gritty, find overlooked opportunities, invest in them, and do the unexpected. And, so I guess I'm an entrepreneur at heart. Both my parents are entrepreneurs. They passed that sort of drive, down to me. And, as I said, if I didn't like it, I wouldn't do it.
So I made a list. It's family or group, and then the 2 dogs. That's a good list. but and feel free to cut me off if I get too personal, but what keeps you up at night? Like, I guess we all have that. You think about risks. Maybe you can talk to me about the risks of Orefinders or the Ore Group, and just, yeah, what keeps you up at night?
Yeah, risk, understanding and assessing. Like I can accept the risk, and when we fail, I have a bad day, but then I brush it off and get over with it. But like, you know, the first day you receive bad news, it's just a tough day, and I'll wrestle in bed thinking about, okay, how am I going to deal with this? How am I going to communicate this? How am I going to, how am I going to take this crisis and turn it into an opportunity? Literally, that's in my calendar every week, and I move it from every Saturday to new Saturday. It's like, how do I take this crisis and turn it into a positive? Because you absolutely have to do that. And I think it's not just like a, self-help sort of thing. It's real. Like, there is an opportunity in every crisis. And so, and I get crises, mini crises all the time. So trying to solve them and charting the best path or course forward is what keeps me up at night. Thinking about, people. I as a big part of my job as a people manager and dealing with their problems. It's not just my family. It's the people who I'm very close with and I work with on a day-to-day basis. I have to deal with their families and indirectly, but that's how, like, again, like I tell them family first too. And so sometimes they've got situations they got to deal, which, then we have to, band together and support them while they manage certain things. So that's something, dealing with people probably takes up the most of my time. And then, ultimately always thinking about cost of capital and how we're going to raise capital. I think that's how in addition to finding new opportunities and sort of, strategizing them, I think the biggest value add I have is my network, my ability to raise capital at the appropriate time and at the best cost available. It's not always up to me in terms of its cost, but it's something that I struggle with or pay very close attention with. And then and that's what keeps me up at night. But my brain's constantly thinking about what are we going to do? What's best for each of the companies? Where's a new potential opportunity? And how are we going to manage the risks?
That's a good overview. I appreciate you doing this. I appreciate you talking to me, and I like this little, personal bit at the end. And I'm looking forward to talking about Mistango.
I appreciate it, Antonio. It's always good to be interviewed by you. I think you do an excellent job. I really do. And like Mistango's got a really interesting story to tell. So our viewers for Ore Day 2023 are going to have to stay tuned.
Okay, so gold exploration in Kirkland Lake in Canada on a Abitibi greenstone belt with a huge backing from a huge gold producer. Sounds like a good plan, right? But so what? I mean, gold is dead money after all, right? It's going nowhere, and the future is in gold-backed NFTs, right? Well, Robbert Sinn over here might disagree with that. So I guess let's hear a more realistic outlook on the gold market from a technical and fundamental standpoint. To talk to me about gold and silver, and maybe even try and change my mind with me here, I have a portfolio manager with over 20 years of experience under his belt. His name is Robbert Sinn, aka Goldfinger, aka CEO Technician, aka the guy who's got a bunch of followers on CEO.ca for some reason. Rob, thank you for investing your time in the Ore Group.
Hey, Antonio, I'm happy to be here, and I always appreciate your approach and your sense of humor.
Thank you. But I wanted to sort of kick it off by asking you, how do I become the most followed person on CEO.ca? Like, how do I take that position away from you?
I don't know. It's a lot of work. It started in 2015 when the site was founded. Tommy Humphreys, a friend of mine, co-created it. With a couple people, I think, and he invited me to make an account. I said, okay, I'm going to use Goldfinger as my handle. And I don't know how many posts I made, 20,000, 30,000 posts later. Yeah, I guess I'm the most followed person on CEO.ca, and most people know me as Goldfinger. That's aside from my actual name, that's the thing a lot of people use, and it's kind of a conversation starter, and it's kind of funny because it doesn't really have anything to do with my life aside from the fact that I liked James Bond as a kid and I chose that name for my handle.
Oh no, it definitely works. Yeah, it definitely works. That's sort of how I bumped onto one of your articles, then I read a couple of more. articles that you published. You also publish regularly, so you recently talked about lithium and whatnot, and it was interesting to me that you sort of keep a realistic view of things and where they are, and I like that about your articles and about your work. Can we maybe do that about gold? Like, can we put on realistic? Because I feel like the most people I've spoken to in the last 2 years about gold are sort of your $10,000 gold folks, and that hasn't happened yet. So can we take it all the way from the top and talk about where you see gold and silver being right now?
Yeah, I think that's a really good approach to take. And, I appreciate the kind words. I think a lot of people in the precious metal sector, so-called gold bugs, always have a bullish view. They always have some big price targets. The guy who wrote the, Rich Dad, Poor Dad series, I saw a tweet from him. He's like, what was it? $10,000 gold, $500 silver, $500,000 Bitcoin. And while those numbers get retweets and likes and a lot of attention, and maybe one day in our lifetimes, those targets might come true. Maybe. I don't think that's very relevant to this year or even next year. And it's unrealistic. It sets unrealistic, market expectations and investor, expectations. So yeah, I approach precious metals from a technical and fundamental viewpoint, and I also look at it from the positive and the negative side, like the bullish and bearish case. I try to be balanced in my approach. While I am a long-term bull, I own physical gold and silver and even a little bit of platinum. I am fully aware that markets can do whatever they wish in the short term, and there's a lot of factors that have a big influence on the gold price in the near term. And so, yeah, I think right now is a really interesting moment because we had a very strong start to the year. Obviously, gold was at 1625 in early November of 2022. It went all the way to 1975, the final week of January. And now it's back to about 1850. So it's had a nice pullback, pretty healthy pullback, and it's created more of a wall of worry, right? And there's a lot of worry about a lot of things in the world right now, including that inflation might stay sticky around 4% or even 5% on the US CPI. Obviously, in other countries like the UK, inflation is like 17%. It's absolutely crazy. So there's worry about inflation and that the Fed will have to hike rates even higher, which in theory is positive for the US dollar, might pull long-term treasury yields up, the whole yield curve might shift higher. And generally, those things would be considered negative for the gold price in dollar terms. So that's taking sort of a what could go wrong approach. The Fed has to tighten more, rates higher for longer. Probably not a good thing for gold in 2023 if that plays out, right?
Mm-hmm.
But then on the other hand, the long-term sort of secular tailwinds for gold and silver are pretty powerful, pretty pronounced. I think this de-dollarization theme, so this sort of bifurcation of the globe, West versus East, sort of a maybe a Cold War, but a modern version of a Cold War, is seemingly underway. And these countries like Saudi Arabia, Turkey, Russia, China, just to name a handful, they don't really like the fact the dollar is the reserve currency, and the U.S. gets all these advantages from the dollar, right? So they're going to try to interrupt that as much as possible, and the accumulation of gold is a key part of that process. And we saw China accumulating a huge amount of gold in 2022. And I could go on, but I think that's a good place to start the conversation.
Yeah, it sure is, because it reminds me of two things. First of all, Brent Johnson's point of Santiago Capital was sort of his point of view was, the dollar milkshake that he was kind of right on so far. But then he says there will be a time where the dollar and gold go up sort of together, because when he says dollar, he measures it by looking at the Dixie index. So it would basically be every other currency falling, but the dollar falling the least. So it would appear as if the dollar and gold is going up together. Is that something you would agree with?
Yeah, I mean, I think that's totally possible. The one reference point I have in my life experience is 2008. And while 2008 was a roller coaster year by any interpretation, there was a time when the dollar went boom and gold went boom that year. Gold bottomed around 700 at some point in 2008, and towards the very end of the year, it was well over 900, close to 1,000, and then it kept going in 2009 and 2010, 2011. So yeah, gold went from 700 to over 1,900 by August 2011. So 3-year run, almost 3x. Which for gold is absolutely insane, right? So the gold and the dollar can absolutely have periods of time when they move together, and usually that's during a crisis when the system is under a lot of stress, things are breaking. The dollar is that wrecking ball, as he talks about.
Mm-hmm. I also heard a different point from Dave Kranzler, I believe. He was on Mining Stock Daily, and he was talking about this taking a lot longer than we might expect, the de-dollarization thing, because if China wants to move out of dollars, sell out, basically sell out of dollars or convert their currency to something else, the assets denominated in dollars would also suffer. And they also hold a bunch of those. So they don't want to do that, and they want to create sort of a slower transition. So would that make it what would that make the timeline for that happening for you?
Impossible for me to answer, way above my pay grade. But I think just like the battery metals bull thesis, this is going to play out over years and maybe even a decade or more. So, anybody who thinks that de-dollarization is going to mean gold at 2,500 in May of this year, I think that's very unrealistic. Could it mean gold at 2,500 by 2024, 2025? Absolutely. But these things take time to play out. You got to, remember that gold is a big asset class. It's a big market. And when it has a 10% or 20% rally, there's investment supply that comes on the market available for sale. And obviously, it also encourages miners to mine lower grade ore deposits, right? So a 20% move in gold is a very big move. And it's not something that we should expect, every year for sure.
I had somewhat of a love-hate relationship with gold since the start of my quote-unquote career, which has been just 2 years. Seems funny to call it that. It feels like it's been 20 years, though, if you look at what the years have been in the markets the last 2 years. But first of all, I got hooked on the narrative of gold is money. These bad banksters, they're just destroying our wealth. And I was really big into that. I was completely sold off the get-go. I talked to people, and it was really fun. And then I sort of started looking into more seriously into the supply and demand dynamics of other commodities like copper. And I stopped, I didn't notice that same thing in gold and silver, like not the same supply gaps or not the same expected supply gaps as in copper, lithium, other metals. And so now I'm wondering, which one is it? Like, does supply and demand even matter with gold, or does the monetary aspect of it matter more? What do you think of that question?
I think that's a pretty easy answer. The monetary aspect matters a lot more. The investment side of it is the driver. And, obviously we have this paper price of gold. This is sort of a theme among gold bucks. There's the paper price, and then there's the physical price. And while there is some truth to that, I don't totally buy into that. But obviously the paper market, the futures market, is the real driver of the gold price. And you or I going to our coin dealer and plopping down a couple grand to buy a gold coin is not moving the gold price one bit, right? It's billions of dollars, tens of billions of dollars flowing in and out of gold in the futures markets that is setting the price on a daily basis. And a lot of that is driven by monetary policy, inflation rates, Fed funds rate, economic growth, inflation expectations, and I could go on. It's all very boring macro stuff, but yeah, that's the real driver for gold. And I'm not a big advocate of all the conspiracy, COMEX, blah 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 stuff, and I know that makes me a little less popular as a commentator among the gold bug crowd, but I am still a long-term gold investor, and I do think the price is going a lot higher in my lifetime.
Mm-hmm. It's a good point that it seems like being popular and making money is not necessarily correlated, which is very weird, right? You'd expect the people who actually make right calls to be popular and not vice versa. But obnoxious calls win attention, though, right?
Yeah, it's social media. The more obnoxious you are, the more outlandish you are, the more attention you get. Yeah, it's kind of a weird situation. It's something I was talking to my friend about, how we have such a short attention spans now. We just want this little sound bite that gives us confirmation of our pre-existing bias, and then we will like it and retweet it and share it with our friends, and without any real deeper thought or investigation sometimes. And I think that's not a particularly positive trend for mankind, but I do remain optimistic that we'll get through this.
Which is why Twitter and TikTok works, I suppose, right? Because you have these 140 characters, and then I've never been on TikTok, so I don't know how many seconds the limit is, but then you had Vine or whatever, it was 7 seconds. So if it's something like that, short videos and stuff like that, I always get complaints. Yeah.
1 minute is an eternity in 2023.
Pretty much, yeah. This is probably a 7 or an 8 hour video right here that you're participating in. So we're fighting as hard as we can against that.
Well, I'll try to say something intelligent, or a couple things intelligent that'll make it worth their while to tune in.
Well, I guess the using a crystal ball always gets people watching, right? If we can tell them what's going to happen next year or 2024, but maybe we can talk about. Gold is supposed to run during times of panic, right? So if we have a recession, do we necessarily have a panic, and does gold necessarily run? Like, is that a fundamental law of economics or not?
It doesn't have to be, but more often than not, it is. And so if we think back to the late 70s, that was a recessionary time, but it was also a stagflationary time. So it was a recession with high inflation. Gold went from, I don't know, what was it, $35 an ounce in the early 70s to $850 in early 1980. So that was a tremendous period for gold. 2001 dot-com bust, gold was 300 an ounce. And we know what happened over the next decade. It went from 300 to over 1900. And obviously in the middle of that was the 2008 financial crisis. I don't think we had a recession per se in late 2015, early 2016, but definitely there was a little panic, a little fear that the economy was about to dip. And it caused a little bit of a Fed pivot. Same thing happened late 2018, early 2019, all good times to own gold. And then obviously COVID, crash, panic, the global lockdown, March, April 2020, another fantastic time to buy gold. So I don't think it's 100%. I don't think anything is 100%. And there are times when it's different, a little different, even though that's a little weird to say that. But I think usually when the economy is flowing rapidly, it creates the incentive for central banks to stimulate. So monetary stimulus, which is the rocket fuel for precious metals.
And this might be a silly question, though, but I guess what else? Like, do you have a checklist of things that, I mean, if it's not supply and demand, what does influence the movements of gold? Real interest rates, but what else?
Real interest rates, for sure. And I think central bank buying. So, I talk to a lot of investors on a pretty regular basis, attend good amount of conferences every year. And I think back to September, October 2022, just, less than 6 months ago, most people were pretty negative on gold during that time. A lot of well-known faces, I'm not going to name them, but you know who they are. A lot of well-known people were saying, "Hey, I think gold could drop under 1,600. I'm worried. I sold my mining stocks." And the gold price kept bumping down to that 1620 key support level. It tested it 3 times at the end of 2022, and it held every time. And looking back on that, although I don't have any actual evidence to prove it, aside from the fact that China accumulated over 400 tons of gold in 2022, I think central bank bids were putting that bottom in place. And so real physical accumulation by the biggest buyers there are, and that is central banks. I mean, they actually make the money, so they can buy virtually, an unlimited amount of gold, and we've seen, I mean, the Fed doesn't buy gold anymore, or at least not officially that we know of, but the Fed does a lot of other things and expands its balance sheet to $9 trillion, buying all sorts of things, including corporate bonds and, mortgages. And obviously all of that monetary expansion, balance sheet expansion does have impacts on precious metals, right? When the Fed balance sheet has been expanding, generally it's had a pretty good correlation with the gold price, a positive correlation, with the gold price and stocks, to be quite blunt, right?
What do you think that is, by the way? Like, why are some central banks buying gold, first of all? And second of all, why are some central banks not buying gold like the Fed?
The Fed is running the show for the whole world. So they don't need to buy gold. And also the US is already the largest, holder of gold, dating back to the 40s, 50s, and 60s, when we were actually accumulating gold. And why are countries like China buying gold? Well, there could be a lot of reasons, and I don't necessarily have all the answers, but maybe they see sanctions coming. Maybe they're about to do something that would cause a severing of the, relationship, with the West, and they need that gold to back their currency, to back their economy. Same with Russia, already being sanctioned quite heavily for the invasion of Ukraine, right? So there's a lot of, and I think Turkey, for very similar reasons. I mean, Turkey is clearly not stepping in line with the West, even though they're a member of, NATO. There's a lot of reasons, but I think the main reason why all these countries like China are accumulating gold is the de-dollarization theme.
That makes sense on a fundamental level. But you also did mention a couple of moments ago some of the technical supports that you had seen in the last years. Is there something special that you're seeing in gold right now in terms of support, resistance, or any other chart patterns?
Yeah, I actually published a blog post a few days ago. I think it was Thursday night, and the title of it was that gold and silver approaching key support after a pretty big drop so far in the month of February, right? So, platinum is down $200 an ounce since the beginning of January. Silver down about 10% year to date. It's one of its worst starts to a year in history. Not the worst, though. A couple of years have been worse. And gold, obviously, as I mentioned earlier, down about $130 an ounce since peaking a few weeks ago. And I think all these metals are either at important key support levels or very close. So gold I would say about 1825 to 1830 is a very, very big level. And while people talk about 1800, that's just more of a round number, psychological level. I don't necessarily think that is technical support. I would say around 1825 to 1830 is key technical support. Then 1780 would be my next big level. And, you know, when I talk about levels, it doesn't mean that it's that exact number. The price can't drop 10 cents through that number or a dollar through that number, and it's still not support. Very often these levels are tested and they could be, you know, price could go through them for a very short period of time, maybe 3 minutes, 30 minutes, a couple of hours. It's more about daily closing basis or, you know, weekly closing basis, right? So, for example, with gold, I think that the 1850 level is actually an important level on a weekly, you know, chart, you know, basis. And last week it went under 1850 for some period of time towards the end of the week, but it ended above it at the very, you know, at Friday's close. So far the 1850 support in gold is holding. And I think that from a technical chart standpoint, as a bullish, you know, investor, I would rather see gold work off some of the overbought through time. So that $350 an ounce run from 3 months ago, if gold is a consolidation between 1850 and 1880 over the next couple of weeks, I think that would be fantastic. Even if we did come down to test, you know, in the 1820s for some period of time, as long as that holds at the end of the month, I think that would be fine too. Gold climbs a wall of, you know, worry, just like all markets do. And the more frustration there is among gold investors and the worse the sentiment is, usually that's a better time to actually buy.
How do you measure that? What do you use to measure sentiment?
Well, I mean, I have some secret sauces that I don't want to really talk about, but there's plenty of sentiment gauges out there that are available that you can either pay for or you can find. So yeah, there's multiple sentiment gauges. There's multiple, and I look at probably 5. And also, I mean, social media is a pretty good one, and that's, you know, it's a little emotional and a little bit short-sighted, but you know, when you see tweets from people, a lot of tweets on the same day talking about how bad gold is and how poor of an inflation hedge it's been, that's a pretty good sentiment tell that people are too bearish. And just like when people are talking about, you know, $5,000 gold price targets, or the you know, rich dad guy seeing $10,000 gold, $500 silver. I mean, I don't take those targets seriously, but when you see more of that stuff, that can be a sign of euphoria. People are just too optimistic, and especially when you see that after a 20% gold price rally in less than 3 months, it's probably time to get a little less, you know, a little cautious, you know, a little less, you know, optimistic, and maybe if you are in high risk gold stocks or something, it's a time to hedge or take some off the table. And it's not a perfect science, but I generally have a pretty good feel for turning points in the sector.
I'm happy you're mentioning the high risk gold stocks, because that would be my next question. What are you using to leverage this fundamental and technical knowledge? Like, is it the producers, ETFs? You told me about physical, but explorers, what are you doing?
Well, I mean, so I have multiple time frames, you know, that I look at. I do have a portfolio of explorers. Obviously, that is pretty high risk, and the allocation to those kind of stocks should be much smaller than large caps or, you know, physical gold. So long term, super long term, I own gold coins silver coins and bars. And that's something I just don't really touch. Yeah, so that's ultra long term. It's also a form of savings because it is kind of annoying to go to the safe box, pull it out, go and sell it to either a private investor or a coin dealer, and go through all that, hassle, and then including taxes and stuff. So it's just a form of savings, and it's a long-term investment. It's a way to express a long-term view on gold and silver and platinum, right? So that's number one. Then number two would be to have large cap exposure to miners like Freeport Mac, Moran, or what have you. And obviously that's something where, if you buy FCX at $40 a share, your risk is probably 20% to 30% downside if the market had a very big downturn or something happened to adversely affect the company. And then your upside, realistically might be 40%, maybe a little bit more, on a 12-month time frame. And then obviously, if you want to get higher risk and higher potential upside, then you go to the mid tiers and then possibly all the way down to the juniors, which actually the juniors don't have revenues. And usually they have to go back to the market to raise capital to continue to explore or do the permitting process for their projects. But with all that financing risk comes the potential for, enormous wins. Like, for example, in 2020, a lot of people watching this probably do recall 2020 because it wasn't that long ago. We had an absolute tremendous washout in February, March of 2020, where many stocks dropped 80 to 90% in a very short period of time. But then the rebound from that over the next 4 to 5 months in many of these stocks was 10x or more, right? So if you're able to time it reasonably well, and you're able to catch a cycle in the gold, silver mining sector, or even copper mining sector, you can generate really outsized gains, but that comes with risk.
It sure does. I, for one, remember that because I was buying all the way to the top. So I still have my scars from that. The Orc group focuses on Canada specifically, and there's a lot of talks of bifurcation of the market, right? And I've spoken to Stephen Stewart, the chairman of the Orc group, as to why he does that. And he just sees a premium in companies that are in North America, but specifically in Canada. Is there any specific part of the world that you prefer to stay in or stay away from right now for gold and silver stocks?
Yeah, to be honest, I am mainly focused on North America, so Canada and the US. I do dabble in Latin America just because the endowment and the exploration potential in certain areas of South America and Central America is still quite enormous. But yeah, I mean, Canada, you could say all you want about Canada in terms of who the prime minister is now, or First Nations challenges. But the reality is Canada is still a fantastic place to operate as a mining company, as an exploration company. You have great infrastructure, first world infrastructure. You have, rule of law. You have all the things that you would really want for a mining company. Obviously, the negatives would be, you have to pay higher costs for labor. Costs are higher in Canada than they are in South America, obviously. But there is a huge bonus in being able to operate in a place where you have some level of certainty. And yes, you still have a huge amount of area that has been either not explored at all or explored 100 years ago, but not with modern technology and equipment. So there's a lot of new discoveries that will still be made in Canada in my lifetime, and they're being uncovered every year.
When you found what to invest in and where to invest in it. I guess the time comes to talk about position sizing. And I really wanted to bring this up because you have a very good article called The Key of Being a Great Speculator is Position Sizing, something along those lines. And yeah, can you maybe talk to me a little bit about that as well?
Yeah, I think I'm glad you brought that up because I think that's really important. A lot of people talk about stock picks, like, oh, you should buy, Freeport, or should you buy this, junior, and oh, I'm positive on that junior, and look how much it's up. But okay, how much, did you buy? What portion of your portfolio did you put in that investment at what price? And how long did you hold it? Did you let your profits run? Like, these questions are actually way more important than just saying, I bought this stock and I like that stock. You need to actually, make a bet. You have to size your bet the same way you would if you were gambling, in Vegas. So when you get lucky, and even though, yes, a lot of, the investment game, especially in mining, is skill and understanding the right management teams, the projects, timing the cycle, et cetera, et cetera. A big part of it is how much are you going to bet? What portion of your portfolio are you going to put into that investment, and sizing it appropriately? So, in junior mining, because it is so risky and because stocks can drop 80% or even 90% in a relatively short period of time, putting more than 10% of your investable portfolio, account equity in a junior, resource stock is generally not advisable. I know some people would argue with me and say, well, I had strong confidence in this company and I knew they were going to make a discovery. And okay, great. I mean, if you want to take more risk, that's your choice, but just be clear on what the downside possibility is, right? But if you put 10% in something and it drops 70%, well, you still have 93% of your portfolio left. So it's not a fatal blow, although I'm sure it's not fun. And it's happened to me many times. It's not fatal, right? There's also times in junior mining, and in this blog post that you cited, I do, highlight a few of those examples. There have been times where it was pretty clear to me that something was happening on a fundamental, level with a company. Like, they were conducting a phase 1 program at a project, and there were some signs, we call it smoke, that they were onto something, or they could be onto something. But obviously, you never know until you get the assays. You get the results back. But there were signs in the chart. It was making higher lows and higher highs in the share price as the exploration program was ongoing. The market was still waiting for the results. The sector overall, gold mining sector, was improving and starting to go into a new uptrend, right? So you had the macro sort of aligning with the micro, and then lightning struck, right? You got the results, you have a new discovery on your hand, and the stock goes from 10 cents to over $1 a share, and you have your 10x at what everybody is seeking in the junior mining sector. Everybody wants the 10 bagger potential, right? And so the more you look at 10 baggers of the past and the setups that led to them, probably the better you will be at identifying them in the future. And just always know that nothing is guaranteed, far from it. So while you may have 10x potential on the upside, just know that you have pretty big downside exposure as well if the results do not meet up with expectations.
Very good point. I don't think too many people talk about that, or at least not the ones that I'm seeing. And I think that's really important. Not only talk about the upside, but talk about what's going to happen if the downside happens. Because, I mean, this is a cyclical industry, not if, when the downside comes, right? So there's that. I'm almost about to let you go here, Rob. I was just wondering if you look at all the commodities that the Org group is looking for, where would you place precious metals? Because they have uranium, they have copper, they have gold, and then they have metals energy. They're looking for nickel. So where would you place gold and silver on your list?
That's interesting. That's tough for me to respond to because I like battery metals, like copper and nickel. I think those have a fantastic future ahead of them. But I also think gold and silver has a place in any investor's portfolio. Maybe 10%, maybe a little bit less, all depending upon your investment time frame and objectives. I would say copper exposure, as you said, it's a cyclical industry. So copper, I believe, is higher risk than gold is, and the same thing that copper explorers would generally be higher risk as well. But I think all those metals have a place in an investor's portfolio. It's just up to your personal objectives and your risk tolerance, how much you're going to allocate to each.
Do you generally do it like that? Like, do you look at it high level where, you look at the metals and then deploy your capital, or do you look at specific companies and you just look for a good company?
A little bit of both. So I want to have like a fifth of my portfolio in battery metals, copper, etc. Then I want to have a fourth, maybe a little bit more in gold and silver, juniors. And then I want to have the rest, maybe a sprinkling of higher, risk stuff that's not relevant to this conversation, like biotech. And then the rest will just be large caps. I do really like the battery, metals theme, copper, and nickel over the coming years. So a company that's exploring for copper with a strong management team, with projects where I can see the scale potential for something like 5 to 10 billion pounds of copper in resource, then I'm going to take a gamble. Sometimes I might allocate 2% or 3% of my total account equity to something that's high risk, but I believe could be a 10x if, as I said, they get lucky, make a new discovery during a time, when the sector is doing reasonably well.
This is a refreshingly honest and down to earth conversation. So I really appreciate you investing your time in the Org group, Rob. Thank you for being here.
Thank you, Antonio. It was a pleasure speaking, and have a great day.
Orefinders, by the way, is not the only gold explorer that the Org group has. They also have Mistango River. Mistango and Orefinders do have a lot in common. They have a few overlaps. But Steve told me that they are still two different companies, which they will eventually go on their own path in the future. So I thought I'd ask him more about Mistango as well. And here's what he told me. All right, Steve, so you're back again. It almost seems like we cannot get rid of the boss here in the office, start having some fun. We've been having fun already. But we're going to be talking
I'm glad you're having fun. Yeah, no, I'm hard to get rid of. I'm paying the bills, so I get the most face time, Antonio.
Fair point. I'm not going to argue that point. You were having fun with Mistango, I assume, too, or not as much. But that's not a company you started, unlike the other ones that you spun off from the Org group. So, what's all that about? What can you tell me on it?
Yeah, well, I don't know if it wasn't fun at the time, but it was certainly an interesting story, and it is unique amongst the Org group companies, and it's the only one that we didn't create from scratch. And the history of it, for those who don't know, is as we demonstrated our ability to execute some activism investment, which we talked about in Orefinders, and Mistango is a perfect example of that. So, as I noted, Orefinders' original plan was to consolidate and invest in the Kirkland Lake area, and Mistango was a company that had a bunch of assets in that area. We had approached the management into doing some sort of asset acquisition, potentially a corporate acquisition, and we found them to be not amenable to anything. And then I guess that sort of, we started to ask ourselves why. It was just unusual in their approach. And then we just dug around, and without getting into details, we fundamentally disagreed with how they were operating the business. No news, no development of the project, consistent selling of assets to fund operations. And again, there wasn't really a lot of operations that were benefiting the shareholders. That was our position. And so we, at the time, looked at the shareholder registry. We saw that Osisko, at the time, I believe, was owned 31% of the company. We had a relationship with Osisko, and I basically called up Sean and I said, would you rather be an Orefinders shareholder or a Mistango shareholder? And the answer was very clear. They were frustrated, but they were so big that they just didn't have the time to do the dirty work, and doing activism is dirty work. And the odds are stacked against you completely. So anyways, that's how our position started. We acquired the 31%, and then we again re-engaged management and said, okay, now we own a certain position. And so anyways, it just never really went anywhere. We had a shareholder meeting. We requisitioned, or we forced a shareholder meeting. We won that shareholder meeting, but they adjourned it and just didn't act properly. We had to call another shareholder meeting, which, the same thing happened, but we went to the courts and got it basically adjudicated in our direction. And long story short, we took over the company, which at the time was, trading at a half a penny or a penny, had no money, basically only liabilities, but it had some good assets. It had the Omega, which is around 600,000 ounces, very strategic. Again, just sort of some background on why that asset is interesting. So the Omega was a former producer. And that 31% that was owned by Osisko was actually a legacy asset that Osisko acquired when they bought Queenston, which is Charlie Page's company. And Queenston invested in Mistango for that 31% because it viewed the Omega as feed for the Upper Canada Upper Beaver. Now, of course, which is owned by Agnico Eagle. So you're sort of seeing all the moving parts coming together, right? So, it's the Omega is a strategic asset, and ultimately why we went after it originally. But when we sort of got to know more about the company, we learned that it had sparse claims over to the west of Macassa. And then from there, we made a deal with a company that used to be a mining company, but turned themselves into the marijuana business at the time, and basically sold off their entire western portfolio of what was the western extension of the Macassa property for us for really a song. I think we paid 50 grand or something like that for a huge land package. They just didn't know what they had. They were so focused on selling marijuana that they just didn't care. And so so it just sort of, everything sort of came together afterwards. We built out that that land package. We filled it out. We staked some ground. We did some geophysics work, and ultimately built an exploration strategy around trying to extend the western trend of the Macassa, which is challenging, right? But like the thesis is that the Macassa is the seventh mine in Kirkland Lake, and they've all gone from east to west. And so the thesis is, well, there's very good chance there's going to be an eighth to the west, and we are on the western boundary. Now the tough part is, we've done 2 drill programs there. The first one we didn't have much success at all, but we learned something about the rocks and call it lithology, which informed our second drill program, and we actually hit a well mineralized trend. We got some VG, we got some good intersections, but a little bit deep. And now I think that, the next drill program there is going to try and chase that structure a little shallower up. So it's a process. It doesn't always happen overnight. And so but anyways, that's been, the story of Mistango. Out of the gate, called the first year was about, owning that Omega, which we do, developing the land package west of the Macassa, drill testing it, looking, going for gusto, and trying to sort of drill the Macassa. If you can find a nice juicy ore shoot there, you become awfully attractive, but it's hard to find. And we've tried twice, and we'll try, third and a fourth time, whatever it takes, responsibly, of course. And then of course, Mistango has evolved into other things. It like Orefinders, signed an almost parallel deal with Kirkland Lake, now Agnico Eagle, where it's got a $60 million exploration commitment over the next 10 years. We're just getting into year 3. It's going to be spending, or Agnico is committed to spending $7.5 million over the next 3 years. Up until now, it's earned nothing. So it's all of that money from Agnico, who is again a 10% shareholder in Mistango, but all of that money going into the ground is for our benefit. They can walk away at any point in time. We're very happy with them as partners. It covers our downside. That's why we did those deals. People knock us for, you'll never please everybody. And the knock on the deal was, oh, we gave away the upside. And sure, we forward sold 75% of the upside to cover our downside. In a highly risky business, I will take that deal 10 out of 10 times. Obviously, the devil's in the details, but this is a risky business. If you look at it, with 2020 hindsight, had we not done the deal with Agnico and done all those drill holes, we'd probably be in the same situation, except we'd be cashless. Meanwhile, Mistango's got nearly $7 million in working capital. It's cash rich for a junior, and is really effectively in the same position. I mean, it hasn't sold any of its assets, period. As I said, Agnico has earned zero. They don't earn anything until they've spent another $7.5 million. So I mean, in a world of risky volatility, high capital expenditures, I thought that deal was quite beneficial for us to cover our downside. But anyways, from there we've evolved. What else has Mistango done? I don't want to sort of ramble on, but we did a deal with, as a result, just like Orefinders, we are not incented. Mistango is not incented to spend its treasury dollars on the Kirkland Lake portfolio, because that would only benefit Agnico. We have been looking elsewhere. We have made acquisitions in the Chibougamau camp. We're drilling we've drilled and await assays on the Ladin project, which is again a satellite deposit that, if it is what we hope it is, would be strategic and certainly accretive to what's going on at the Opemiska. And then there's a whole nother area that we got a project called the Goldie, which is in the Shabandoin, which is in the Thunder Bay area, where there's getting a lot of attention there. I think shareholders need to pay attention to that area. Where we're hitting good stuff on Goldie, I can tell you that. We don't have assays yet, but like we can see what we're drilling, and we can see what area people in the area are drilling. It's really it's a fragmented area, so what is going to be required is consolidation. Something that I'm a big believer in. Is going to be required of a big substantive drill program. But I think there's little doubt that the mineralization, there's an ore body there. It's shallow, flat lying, and has a huge strike, and it's a significant width where and grade. It's going to be low grade. It's going to be like a 1 grammer, but it's big, and that's exactly look at the most profitable mines in Canada. Both owned by Agnico, of course, are the 1 grammers, and so the miners love the 1 grammers. It's consistent. So that's the type of potential that is there in the Goldie and the district as a whole, of which we are one piece. There's other people there, but again, Mistango has been diversifying its exposure primarily in gold and copper, in addition to obviously the deal with Agnico, and out of the blue, if people saw our press release, we also announced that we've been doing a little bit of buying of a strategic company that we've spent $2 million on, and it's completely arm's length to us. But again, it's a strategic position in a publicly traded company where we think could add a lot of value down the road.
You made a very good point about the upside and the downside. I'm going to try and quote Rick Rowe, but I'm probably going to fail. He says something like, you can take away 90% of my upside if you also take away 10% of my downside. And that's a lesson that he always tells me he learned late in life. Seems like you're employing it already. So I like that part. I like that. It's a note for one's personal portfolio too, I guess.
Well, as I said before, it's we have to take a long-term position, right? We don't get in and out of these trades in a daily basis like some shareholders. And so while I cater to the day traders, absolutely, you have to pay attention to every style of shareholder. When you're sitting in the C-suite, you need to think long-term. So long-term is about managing risk and managing your allocation of capital and making sure that you're in this business when the tide turns. So when, gold's lithium frenzy comes, you're in the game.
Long term. I hope that does not refer to the assays that you're waiting for on Ladin and Goldie, though. So, what's happening there? Is that any day now too?
Yeah, it's any day now too. Effectively, like both those programs were on. We talked to the same thing about Orefinders. Both those programs were almost being executed at the same time. So towards the end of December, something may have trailed over into January. I can't remember exactly, but they're still fresh programs. Now, just because you finish drilling, then you got to cut the core, you got to send it to the lab. So I mean, these things take time. So I mean, we're what are we now? Almost 2 months past finishing the drill programs. So it should be, I don't want to say any day now because I don't want to mislead. Again, I'll be very candid. I don't know if I knew when they were coming out, I'd tell you, but they are coming, soon enough.
Soon enough. Okay. You said basically there's almost nowhere to spend the money. I mean, there's always places to spend the money, but you've been, you mentioned that some sort of a secretive, almost $2 million investment, 1.7, if I'm not mistaken, in your latest update. Into, I quote, an arm's length publicly listed company. What's that all about? What can you tell me?
Well, I'm not much because I don't want to show my hand. But those are the facts. We have invested. I think we spent 1.7 thereabouts, which is now mark to market around 2. But that ebbs and flows. The objective is not a trade. The objective is to do a corporately strategic action, which we've done many times in the past, and I think that's something that sets us apart from our peers. Certainly, some of our peers do it, but it's few and far between. Most companies, raise money, drill, news release, rinse and repeat. What the Ore Group and our team has developed is creativity. And the ability to look at things holistically and come at it in different ways. We certainly raise money, drill, news release, and keep our fingers crossed and look to discover something. But there's lots of ways to make noise, make money, create value in this industry.
Sounds like you're going to be the Carl Icahn of the resource space.
I read the book King Carl. Over the summer, which is an interesting read. He's an interesting character. There's no doubt about it. No, I mean that's not our overall strategy. I don't want to become the activist, although you never say never. But there's a huge opportunity to, and this may or may not be an activist position, but there's a huge opportunity to realize value by making small changes in companies. And again, as I think I've already mentioned, the small changes most often management or the board, who are for one reason or another obstructing, or they are themselves the reason for the value not being realized. So if you can take these positions and force some basic change, that is a way to unlock value. Additionally, as I've mentioned before, projects or areas are fragmented. There should be less fragmentation of ownership. More consolidation has all sorts of benefits from understanding and exploring the geology, and also the ability to raise capital, and also streamline corporate G&A, including salaries. So, and as I've said before, not every project, like especially early stage projects, for them to have a CEO and 3 VPs, it's not necessary. So again, it's especially they do one exploration project a year. I mean, it's so there's a lot of waste in this industry, or shall I say, there's a lot of opportunity to realize efficiency.
To bring up Rick Rule again, he always says that there's just one too many junior management teams for the number of projects that we have. So he says the ratio of companies to projects is just too high, I guess. So I take your point there. How does your...
Yeah, well, look, I can't go toe to toe with Rick on one-liners. He's a master of the one-liners, and which comes from his incredible insights and his intellect. But oftentimes there's a few nuggets of truth in his wisdom.
It's true. It's true. I suppose he might eventually make his way to Orde, or at least I hope so.
Sure. Well, next year, 2024, I'd love to have Rick as a guest. He's a great guy. I like him. He's got a great sense of humor, and he's a supporter and a critic of the industry, and we need both.
Agreed. How does your, I guess we almost have to be wrapping up here, but how does your 15% investment that you made in Metal Energy through Mistango, how does that fit the strategy of those two companies going forward?
Sure. So it was a function from Mistango's perspective. It had flow through that had to be spent by December 31st of 2022. And if it didn't spend that money, there are penalties associated with it. So it had, quote unquote, an issue it had to address. We could have we spent some money on Goldie, we spent some money on Ladin, but we had some excess. And so conversely, Metal Energy has been drilling its Mana Bridge project, which I think is completely overlooked. Probably our most overlooked asset in terms of our ore group. It's probably 2 years behind the Opemiska in terms of us developing it, but it's a reinterpretation of an old nickel mine in the Thompson Belt. We're drilling 80-meter intersections at ore grade nickel. And it's getting no love. Nickel exploration juniors had a particularly difficult 2022. And I won't get into the details of it, but nonetheless, it was having a tough year. It was in the middle of a drill program. We were drilling great stuff, and we wanted to expand it. So it had a problem. Mistango had a problem. We took these two problems and made a solution, a win-win solution, to be cliche. So what did Mistango get out of it? It reallocated $1 million, or I think $1.5 million of flow-through dollars, which it had to spend by that point in time, and didn't want to waste it or over drill on something else. And it made a deal with Metal Energy, whereas Metal Energy will repay that principal plus 50%. At any point over the next 18 months. So it was basically, a 50, again, just like the Orefinders and American Eagle deal, exact same structure, exact same thesis, exact same circumstances, different valuations, etc., but, same structure. It's effectively a loan, and that Mistango will get 50% of its money back. So it was a creative deal. It helped both companies. We tried to, obviously sitting on both sides, tried to do it as fair and transparent as possible. But those are the circumstances. And Metal Energy's delivered. I mean, it put that money to use. Look at its most recent drill results. As 60, 70, 80 meters, multiple, intersections of really nice nickel on the highway with a mill up the street, a mill in operation. Doesn't have to build a mill. So Metal Energy is really interesting. So Mistango, until Metal Energy pays that back, Mistango owns 15% of that asset.
Steve, this has been a very good overview. I've had a lot of fun so far at Ore Day. Thank you for organizing this. I think this was the last interview in the group. So thanks a lot for doing this, and thank you for having me. Thank you for the trust. I mean, I still don't understand why, but I am appreciative.
It's why because you do a great job. I watch your channel, Resource Talks. There's a plug for you. I've been on your channel before. We met a year ago. I saw you again in person in London. I think you do a great job. You try to be as impartial and as upfront as possible. So I trust you, and I think you do an admirable job in a sea of people who do okay jobs. And you made my life easier by facilitating this, and I hope you enjoyed it. You got the opportunity to interview not just the Ore Group leadership, but also some pretty interesting folks. And I'm looking forward to hearing Zoltan and Lobo and Justin and all the guys from Torck and our lithium expert Koby speak. So it's going to be a great day, and I appreciate all your efforts, and I appreciate everybody listening to me go on and on. But that's all for now.
Well, friends, and people who are shorting commodities for some reason, we've come to the end of this journey, which I imagine for you is good news, as you no longer have to listen to my voice, look at my face. It is bad news for me, though, because it means that I probably have to go do the dishes if I'm looking to have some food today, as my wife is notorious for leaving me in starvation. Just kidding. She doesn't let me sleep in my own bed. That's one thing, but food is always available. Jokes to the side. But here at the end, I normally have to beg you to like and subscribe and mostly share this video with your Aunt Lydia on Facebook and all the people you argue with on Twitter, since I am a YouTuber and that's what us lot do. But this is not even my channel. So instead, I'll just apologize for you having to look at my face interrupting the otherwise interesting and useful content that the Ore Group has brought you this year. And I thank you for watching, listening, or forgetting to turn off the computer as you fell asleep. And I wish you a very happy, healthy, and a successful 2023.